You can control your volume on the headset and you'll be able to hear us only through the headset. A quick shout out to our partners, our theme partner WhatsApp, co-powered by Amazon Pay, spend management partner Encash, in association with Perfios, payments partner Cash Free Payments, and CEO's dinner partner HSBC. We start with the first panel. We have a panel on the stage. This panel discussion is on democratizing access to private market investing. Our moderator for this session is Amol Dethe, editor, etbfsi.com and etcfo.com. And on the panel, we have Pranav Mahajani, President Trika, Ravi Ravulaparthi, CEO and co-founder of Capita, and Ms. Visa Kannan, partner, Sison Capital. Over to you, sir.
Thank you. Good morning, everyone. I hope I'm audible. Can you just make your thumbs up? If you are audible, great. Thank you so much. So I think the proliferation of technology, here is the evidence. It gives a feeling that I'm driving a helicopter, but, it's a great feeling that the proliferation of technology has brought us so connected and brought us so together that everything and anything can be shared. We have never thought that even payment could have been shared just like that. I meet a lot of private equity investors and a lot of fintechs and startups. And let me tell you, the fintechs or the startups have received the funds without even meeting the founders, without even meeting the investors. I think that's how the technology has shaped up. I'm sure you are enjoying the Global Fintech Festival, and you must have learned a lot, copied a lot of notes from the remarkable sessions that were lined up here. So this particular session is specifically about democratizing access to private market investing. I feel this is a very, very interesting topic because all over the world today, when there is a rally in the fintechs and the startup space, what will actually empower that rally is where the money is coming from, whether private equity investors, angel investors, or whoever is pouring the money. And are there major avenues to, empower and, add layers in terms of investing into that? That is what, partly we'll try to discuss here. And, we're supposed to have Maninder Singh Juneja also, but because of some emergency business meetings, he couldn't travel to Mumbai. But I have three panelists here. I will quickly start, with some basic questions, and then I will get into some specific. So, Ravi, let me come to you first and, try to learn from you. Is when we discuss about and when we think that this space need to democratize, why is it important to improve this space or democratize this space?
Good morning, everyone. Pleasure and privilege to be at the Global Fintech Festival, and thanks, Amol. Very important question from my perspective. In fact, we bet on this space, and the why question is really important. Why do we need to democratize access to private markets? If you generally look at historical track record, I was a banker for 17 years before starting Capita, and the average time to IPO when I started my career was 6 years. Today, the average time to IPO globally is 12 to 14 years, and it will be longer in this part of the world. And if you look at what value creation happens before a company goes to IPO, one could easily argue that significant portion of value creation happens before the company goes to IPO than after IPO. And there's sufficient evidence for that. You can look at some of the biggest companies in the world today and so on. And so if significant value creation is happening before the IPO when the company is in a private stage, how does the rest of the world, not just the VCs, not just the private equity investors, how does the rest of the world get access to that wealth creation? And that is the why. And that is just one aspect of it. Look at it from an employee perspective as well. And employees are participants in the private markets. All the fintechs that you see around here, all the startups that you see around here give significant share of employee pool. And they're participants in the private market too. And they need to see value creation before the 14 years to IPO. Right. And therefore democratizing is, it's a pertinent topic.
Okay. Yeah, I think good to begin with you from Ravi, and I think the timeline and everything is really meaningful insights. Visa, let me come to you and take your perspective in terms of why this space needs an improvement.
Yeah, I think Ravi so articulately put it. I don't know if I have anything to add, but the only thing I will say is that even from a retail investor lens or an accreditor investor lens, it's all about portfolio construction, right? Like you have risk, and then you have risk-free asset classes. And this is just another asset class, which I think everybody should have access to. So like we have mutual funds and stocks and gold and all of that, and you form your portfolio in a certain way, this is a new asset class which has come up. And I think retail investors, as with VCs and LPs and all of that, should have access to it. So I think that's what I would think.
Yeah, sure. Pranav, do you also want to add in terms of why the space need to improve?
Actually, if you look at any asset class which is growing in the country, you can look at crypto, you can look at what is happening in the AIF space and all. I think it's very simple. If the asset class has to grow, you need more and more participants. If companies are going to take say 12, 13, 14 years to really go IPO,
Right.
what's going to happen is they will need investor at every stage of their life cycle to go out, invest, and be with them. So I think more the merrier is what the way we look at it.
Okay, noted your points. I think so. Uh, so as we learned why this space need to be improved, let me try to change the gears and understand more from them in terms of what are the major pain points. And let me come to you, Ravi, again, and tell us more about this space. Currently, when you are investing in some fintechs or startups, or maybe when you want to democratize this space and take it to a next level, what are the major pain points do you see? I think the audio is really low. Is there any issue with the audio? Can we? Okay, please go ahead. I think the audio video team can do something here. Or can we change the mic?
Check. Yeah, this
Yes.
should be better.
Yes.
Yeah. So when you think of any market to function, essentially you're getting buyers and sellers together. I'm just breaking down to the fundamentals. And for any asset class to trade, like Pranav mentioned in his previous response, you need to have you need to have more number of trades happening in the market, which means buyers and sellers need to interact and trade goods, and that's how the value of an asset remains, and you're creating greater access. That means three things basically. You need access to the markets, and that is rare in the private market assets. Only a few select angels or few large family offices get access to this asset class. Second, you need transparency. When you think of a public market and why shares trade that freely is because you have access to information. So information asymmetry is a problem to solve. And third, you need efficiency, which means you need systems and processes for these assets to trade, and which is where we are betting that you need, if you think about the public markets or any crypto markets, for example, significant amount of asset systems have been created. And if you think tomorrow the private market will be democratized, you have to invest in systems and processes to make it efficient. So access, transparency, efficiency. Each of these get built, then the market will thrive and the goods will trade.
Okay. Meaningful thoughts, Ravi, once again there. Visa, let me come to you and try to learn more about the risks, which is again a major pain points also. So, what are the major risks that you find while investing, or maybe scaling up this particular segment? And you could add whatever risks, maybe from legal or the portfolio management perspective.
Sure. I think even before this, we were having this very lively discussion because I'm an investor in a fund. Fund investing itself, returning the fund, returning a multiple on the fund is a very, very tough job. So I think, and what that really depends on from a risk perspective is the number of deals you see. The more deals you see, the higher the quality of deals that convert, right? Like, because you just know what's going to work, what's not going to work. So that's kind of how a fund functions. Now, when it comes to a retail investor, I think there are two broad types of risks. There's a business risk, which is that just the risk of not seeing enough deals, right? And not being able to kind of convert the good ones, so to speak. The second risk is also kind of, from a company perspective, is not being able to market your deal properly, because you essentially have a platform which is kind of, showing you a lot of deals. Now, how do you make up your mind? Because a lot of the times we invest basis meeting the founder, spending time with the founder, spending time on an idea, building conviction on a space, right? So I think it becomes very tricky as a retail investor to kind of make these bets at such an early stage. So I think seed, pre-revenue, pre-launch, very, very, very risky from a retail investor perspective. I think maybe other panelists can talk about how Series A, Series B might mitigate those risks. That's a business side of things. Then there's, of course, a legal side, right? I think fund investors, even more mature investors, are unable to understand legal documents to the extent that they should be. So there's something called a liquidation preference, which essentially means that later stage investors end up taking all the money or the chunk of the money in the case of an exit. Now, a retail investor doesn't understand this, right? This is one of the examples of what could potentially happen in the case of an exit. So I think there's a business risk, there's a legal risk, and the lack of awareness on amongst retail investors, and I would say even mature investors on all of these counts, is a thing that needs to kind of be solved for before providing bulk access to this asset class. That's I think the big risk.
Okay. Uh, Quite interesting points. In fact, there is another risk which I have seen a lot of investors telling me is this, that because of you guys have lots of funds and there are a lot of rally from the startups and they feel that the funds are easily available. So one investor told me that a startup came to him and asked for a funds, and the investor asked him, "But show me your product." He says, "No, I will build the product once you give me the funds." So the funds are perhaps available at such a length that anybody can become an entrepreneur and tries to raise a fund. But valid points on their front. So Pranav, since we discussed pain points, we discussed the risks. Now, you tell us in terms of if we are planning to democratize this space and scale up and reach to a next level, what is it that needs to be done, and how can we go ahead and do that? What is your experience?
Actually, we need to learn something from the listed markets. If you go back, we were doing paper trading. With time, there was CDSL, NSDL, DMAT happened. And eventually, you have the exchanges today, BSE and NSE have the best platforms today in the world. I think what that is changing is that anybody who has money is able to go out and invest. So investing basically has 2-3 parameters. Whether you're investing in public market or private market, that doesn't matter. What matters is, one, your ability to identify a good stock, ability to build your conviction on it, write a check, hold on to it, and eventually exit, because we're all writing a check to get the money back, get much more money back. So I'll give an example. In 2013, when we started, can you hear me?
Yes, we can hear you. But I think the audio is a little low, right? Technical team, can we do something here? I think the audio is a little low.
Okay,
Yeah,
I need to hold it closer. Okay.
Okay.
So I think 2013, when we started, at that time, angel investing was like a club affair. If you were a part of the top 4-5 institutions, like Mumbai Angel, Chennai Angels, you were getting access. And again, entry of that is rare, right? Because if you know somebody, they'll get a place in. Come 2018, when the AIF, the revolution happened, things changed significantly, where each one of us whose net worth is more than 2 crores can go out and write a check and be a part of that journey. Today, we are seeing, and you'll be surprised, in 2013, we had India's first Zoom account. That's the first time when we started saying that, okay, we can't go to every house and every party to go and sell. But come 2022, I think what has really happened is everything is on a platform. So the first step is you get everything on a platform. Everybody can see every deal. The moat, again, is your ability to actually identify the deal. And as Visa said it, that, I don't know which deal is good. And that's the reason you have the lead investors as a concept. And I think that's how the journey has started. I think we are exactly where probably 1990s, when the mutual fund revolutions happened in India, we're exactly there today. We're 20, 25 years behind that point.
Okay. Noted your points, Pranav. Ravi, let me come back to you again. You partly mentioned that your, the opening remark about the IPO and all. But do you think that the startups, fintechs, or entrepreneurs should create a significant value before going to public? How should they use private as a, a platform, private investments as a platform to settle themselves so that they can go and, tap the public market in a far more meaningful manner?
Yeah, see, there is a reason why the number of IPOs, the time for when companies have gone to IPO has changed. This is a structural shift in the global markets, not just here. The number of IPOs, the time to IPO in the US has shifted. It's also going to get delayed. Two things. One, for any innovation to happen, funding and technology need to come together. And therefore, that's true.
Unfortunately.
Looks like I lost...
Audio lost.
Hello.
I think it's lost for everybody. I think.
Hello. Hello.
I think it's lost for everyone. The audio from, yeah, I think it's fine now. Is it fine? Yeah, please go ahead,
Yeah.
Ravi.
So two things, like for innovation to thrive, the demands, once you're a public company, the demands that the investors have, the amount of rigor that you need to put in to actually deliver quarter on quarter results and so on is very high, right? And therefore, to give the private company and the entrepreneurs and the founders and the innovators some room, you exist in a private form, so you are focused on the long-term innovation for a while before you go for IPO. And therefore, all these venture capital funds raising billions of dollars to deploy into the markets, and every new fund that is raised is a record-breaking fund. And that is to fuel innovation in the markets. That entire ecosystem happened in the Valley first, happened in China later, is happening in this market now. And the ecosystem is right. Today there are 90,000 startups in this part of the world, 65,000 startups as per Startup India, right? So that whole innovation to fuel, you need depth in the private markets. And because you have access to capital and so on, you are able to innovate, and it takes time for innovation to succeed and true value to get created. So the whole phenomenon of IPOs getting delayed is good for innovation, right? And as a result of the depth of those private markets, significant value gets created when a company is still private. Before it goes public, it's a very large company by the time it goes public today. And the idea of democratizing is how do people, more than a few select angels, super angels, and institutions, get access to this value creation journey. Having said that, it's also important to remember the context that Visa said. This is an asset class. By definition, innovation and all of that means it is in the high risk category. And therefore, you need to participate in the market, but you also need to be aware of the risks that are associated with this innovation. The way I see it is this is fueling the innovation in the economy, this whole private market space. It is very difficult to innovate and take risky bets as a public company because the markets won't give you the room for taking the long-term bets that you need. And therefore, therefore the whole startup phenomenon. And therefore value creation in this space. That's how we see it.
If I can add, actually,
Sure.
see, the listed markets are very unforgiving because analysts are tracking you quarter on quarter, and largest investors in the listed market are actually mutual fund guys who is tracking NAV every day. So they don't have that much patience that you will put some money and something will going to happen in 18 months. So they say whenever you're ready, you come. That time we'll appreciate you. So last year we saw a lot of companies going public. A lot of startup companies went public, and we thought that probably they will sustain their valuations when they go. But that's not true, right? Because again, the markets have come down, and those stocks have been really beaten up. So I think this year and the year after this, so every founder we talk to today is all talking of profitability. And say, once you have profitability or sight of profitability, we'll go IPO, not before that.
Okay. I think very relevant points from both of you on that IPO part because we saw a great rally in the IPO, but the kind of response that the market showed in maybe 2-3 fintech companies which came with an IPO, a lot of them kind of delayed their process. So considering these points, now let me come to a very important point, which is a policyholders or a regulator's point. And Visa, let me come to you and learn from you in terms of what can be done on a regulatory side, or maybe what can policyholders do to maybe push this space? Because if they don't do it, maybe it will not be democratized in a way that the industry wants, right? So, are there any checklists that you have to which you want to share with the regulators, or any points that you have?
Yeah, thanks. As in, for me, actually, again, it goes back to the point of risk, right? Pranav mentioned, like the public markets are unforgiving, and you have a certain checklist, which is pretty big for listed companies. So not that kind of regulatory checklist, but some democratization of information. Like all startups at certain stages need to come to market with a certain checklist on information and awareness that they create with the community that they're reaching out to. But I think more than the regulatory side of it, I think the platforms also, and I think these platforms, I think Capita and all do a good job of it, right? Like in terms of educating also the customers in terms of what is exactly the risk here, right? So if you go to any of these other Angel List and Let's Venture and all of those platforms as well, if you've been an investor there, they will ask you multiple times what is your risk appetite. They will be like, are you comfortable losing this entire capital, right? So I think you need to kind of be very, very reinforcing that point time and again, and bringing in quality of like information needs to be a lot better before having this mass participation from the retail side.
Okay, I think, but considering the fintechs now, maybe Ravi you can add quickly. Considering most of the fintechs are also looking at expanding to different countries, different geographies. In that perspective, what need to be done? Any common policy should be there?
I'll answer your question. Just add to what Visa said. For the regulator, it's always the greater good argument, right? You're monitoring, you're also enabling. Do greater set of investors need access to the market? They need access to the market. But should the regulator monitor what is happening in this space so investors are protected and the wider group of investors are protected? They should. And I think the regulators are doing that already. To answer your specific question, it's already happening. I think regulators are doing a great job. You would have seen that there is a Singapore, India Fintech,
India
which
Fintech
was
for
announced. The Singapore regulator is also here. And so as we build this wonderful technology that is already working in a very large market, it is imperative. It's almost like an opportunity for the fintechs which are creating this technology to take them to other markets. Right. And I think with what the regulators are doing, and this is identified by regulators in multiple jurisdictions, right, and they are working together to create that. So I think that's already happening. And this is a big opportunity because we're creating some technology here which doesn't exist in other parts of the world. And so why think limited to this part of the market and take it elsewhere?
Okay, noted your points, Ravi. So maybe I will take one common question with all of you now, considering the future perspective. And by any chance, if you have any time left, maybe we'll ask audience if they have any one or two question, if only time is limited, if you have any time for a question. But the question for all of you, and Pranav, I will start with you, is, considering now we have to, democratize this space, considering the rally in the fintech and startup space, and we have seen a great evolution, and we're expecting this revolution to continue, what needs to be done on each of the levers to make a private market thrive, maybe in terms of access, efficiency, transparency, or anything else on a policy front? Any quick points that perhaps we missed earlier and you want to add?
Actually, one is I think more technology is required. Two, I think there's a lot of work needs to be done on liquidity, because today liquidity is a massive challenge. Number three is most investors we talk to today, if they have done something in the past, it's fine, but most are very new to it. So I think they know, you have the mutual funds saying that mutual fund investment is subject to market risk. But in angel investing, nobody says that. Everybody say you'll become 100x, 10x. So I think that awareness is something which as an industry leaders will have to do. I think from a regulator perspective, I think we are okay. I think SEBI has done a phenomenal job. RBI has done a phenomenal job. And regulators' job today, especially SEBI's genesis today, is to make sure that the retail investors or the small investors are not hurt. So I think we are there, over there.
Okay, sure. I think we lost again. Audio. Team, audio.
Yeah, I think we are back.
Yes.
So agree with everything Pranav said. I'll add a few points. I think I think companies, founders themselves will realize that providing liquidity and access to liquidity is a necessity for the company as well. You can't give ESOPs over 4 years, give shares to employees over 4 years, and IPO at 14 years and expect expect that ESOP scheme serves the purpose with which it has been set up. And therefore, providing liquidity, providing limited information and access to secondaries will become an issuer or company problem as well. And so company itself becomes a critical stakeholder in this journey of giving access to secondary markets. That is one, and therefore the point that Visa and Pranav mentioned in terms of access to information. If you want this to be on a platform, you want secondaries to happen, or you want a thriving liquidity to be available to your stakeholders, whether it be early angels or employees, you need to give access to information. Second is technology, which is systems. If fundamentally ownership is not managed on systems, your records are not digitized, then how do you create the efficiency? How does this trade efficiently? And we are one step ahead of the rest of the world. Any company today, any startup can dematerialize its shares and actually have it in digital form. So we have systems that work, and therefore we need to use more and more systems to manage this. And if fundamentally records are digitized, then they can also trade easily. And that is the second point. And of course, transparency. I mean, whether it's your ESOP program, whether it's angel investing, how do you actually give your investors continuous access? How many angel investors today can log on to a platform and see what is the current ownership, what is the percentage, what is the price? These systems need to be there for this entire market to thrive.
Okay, detailed one, Ravi. Visa?
No, absolutely agree with everything Pranav and Ravi said. I don't have a lot to add other than just emphasize that I think education and awareness is pretty critical. But we are very early also. That education and awareness is a journey. As with mutual funds, it has happened. With the stock market, it has happened. So with this new asset class, it will happen. It will just take a long time, and I think the depth of the market, I hope, gets created alongside the education that happens. If one happens before the other, actually if depth happens before education, then I think there's just a very high risk profile of bets being taken without knowledge. I think that's the big challenge that we need to overcome.
Okay, noted your points. Can I take maybe one or two questions from the audience if anyone has any specific questions? Yes. Can we have a mic there, please?
My question to Ravi and maybe Pranav can address. You guys are doing, I believe you guys are doing fabulously well work, but I feel a couple of missing points, like in terms of, although you have touched upon broadly, like disclosure and fair price. Like for example, listed space address that. So as a platform to become successful, I think Visa mentioned, broadly we can cover, but as a platform provider, how do you address? Like fair price is very important for a retail investor. And that's a prime objective of a regulator because they wanted to address the retail investor objective. So when you democratize the private market, so this is the prime focus as a platform provider you should focus on. So I know you mentioned about the transparency in terms of the transactions, not in terms of the valuation metrics or rationale of the value of that, all this. And I believe the beauty of opaqueness among the private investors or the VCs are something retail investors, they don't understand. So if you can.
Sir, may I know your name?
Myself, Alok Shashmal. I represent a global technology platform. So we also provide platform to global structured product globally for all the global banks.
Yeah. Alok, very insightful question. So I'll give my perspective. If Pranav can add. First and foremost, the market force is a very powerful thing. And where I'm coming from, if there is a startup A on the platform that is providing certain amount of disclosures, and startup B that is providing certain amount of disclosures, and both of them want liquidity in some form for their shares, right? And one has greater amount of disclosures, that will have greater amount of attention. So as you think about this scaling up, the market forces itself will be very powerful. Now, having said that, I'm not taking away the responsibility from either the platform or the regulation. So I don't think this asset class is still ready for retail investors. Worldwide, this is restricted to accredited investors, right? So, and I think as this space scales up, regulators will also put sufficient restrictions around this, KYC requirements, transparencies, and disclosure. It will never be as wide as the public market. But public market will always have greater amount, and that is continuous liquidity. Just to give you some statistics to give that primary capital, if it is raised, the difference is about 100x in terms of liquidity. If $1 trillion are raised in the private markets, the amount of trading that happens in the private markets is very different from the difference is 100x. 100x is not sustainable liquidity. Liquidity should be on a continuum. So the aspect of this is there will be a continuum here. There'll be some companies that will have greater disclosures and they'll have better amount of access to liquidity. And that will drive, and that market force is very powerful. This is the perspective with which we are building. It doesn't take away anything from the platform to facilitate greater disclosures. The way we think about it, any platform should facilitate the company to provide as much disclosures as possible. And then, the trading happens or buying happens with the investors with their own diligence and with their own risk. And that's how we see this market scaling.
I think just to add to this, every business has 2 or 3 key metrics to evaluate. What kind of growth, what kind of margins, what kind of CAC is happening. If I take a lesson out from the listed space, if you look at the SEBI DRHP or an RHP, it's a 500-page document. There are only 2 people who read it, the guy who writes it and the regulator. Nobody else reads it. My fear always is giving too much information. 2 is fair price is a myth. Even nobody is able to come and say this is the fair price, this is the multiple it is. It's purely demand and supply, just the way it happens in listed space. Some startups, we really see abnormal valuations, like funds will kill each other to write that check. And in the hindsight, we'll laugh at, like what did you see on that day? In some startup, we absolutely undervalued and we'll see phenomenal return coming up. So I think it's a demand and supply. I'll agree with Ravi, this is not a retail product. This is absolutely not a retail product. It's not like you can't write 10,000 rupees and hope that you will make a 100x out of it. It's not going to happen. When you write a check, you should be ready to leave that money aside for the rest of your life. You'll never get it back mostly. And 2 is too much information again is diarrhea, right? You really don't know what to pick up. So what we are trying to do is identify 3 or 4 key metrics on which you should be able to evaluate that business, and rest, we just let it go. That's what we're trying to do. Have we reached that point where 100% disclosure is there? No. It'll take us few years to get there. I think how the market will evolve is what we'll see.
Right. Can we have one more question? We have a time for one more question quickly if there is any question. Yes, please. Can we have a mic there?
So, hi, my name is Sanjay. And you clearly said that this product is not for retail. From a policy perspective, can it be made for people who, let's say, have 10 lakh rupees of income, so that you have all the rights to invest, and probably there's no hassle? Because as of now, we are very skeptical, and there are platforms which allow you to probably invest 10,000, 15,000, 5,000, and as you mentioned, it's a gamble. You really don't know what you are getting into. So on policy front, are you trying to probably persuade the relevant stakeholders to make it a product which I can buy safely? I understand startups, but I'm not sure about the structures and other things.
So actually, the regulator is very clear on this subject. They're saying if your net worth is more than 2 crores, leaving your residential property in primary residence aside, then you are an investor who can look at this. Honestly, I think if you make the threshold lower than this, it will become crazy. Everybody is going to write check and everybody is going to lose. That in the longer run is very bad for the market. See, people come back to the stock market because you're making money. You can do gamble today, lose all your money, none of you will come back. We really want seasoned investors learning over a period of time. And I think just to add to what Ravi was saying, the best investors are actually the employees of some of the best startups which we see around them. So they see the startup growing, they understand how it is happening, they get ESOP shares, they get liquidity, and then they get that excitement and say, okay, I'll go and find another startups. So that's the first generation actually investor who comes in. For everybody else who has a lot of money to burn, there are many other avenues to burn your money.
Thank you.
Okay. Thank you for those questions. Quickly, how do you see this space in next 2 to 3 years? I have just 1 minute, maybe, 5 to 10 seconds each one of you. How do you see this space going ahead in next 2 to 3
I think
years?
we have 100 odd unicorns today. I think in the next 3 years, this number should be approximately 200, 250 unicorns. And probably we'll have another bunch of 300, 400 companies whose value will be more than $500 million. I think we are just starting off a bull run, which probably will have a 2 or 3 decade run ahead of us. We're exactly where China was 20 years back.
Ravi.
He covered all the points. I think this will be a trillion to trillion and a half dollars of asset class, and very rapidly growing. Significant amount of value creation will happen in this phase of the company. So yeah, if you have the investor with the right appetite, experience, and access, ability to diligence, this is a great asset class to participate in.
Right. Visa?
I mean, hugely optimistic. The macroeconomic tailwinds are just crazy, right? There's a swathe of startups which are growing. There's a need for liquidity. There are participants willing, ready, able to, participate in this market. So hugely optimistic about where this is going.
Wow, that's really meaningful, and let's be optimistic. I think soon we will be a $5 trillion economy if we talk about India specifically, and in fact, we are dreaming of becoming a $10 trillion economy by 2030. And the kind of startups that are increasing, I'm sure will cross that number of 200. The question is how many of them will be successful, how many of them will actually hit the capital market. But on a private investing part, there is a small, comment I would like to make. I have been working as a finance journalist and was moderating some market show also in my earlier avatar at TV. And most of the times people used to ask me which stocks to buy. That's the easiest question, right? Where to make money. I used to ask them to invest in my account, which no one did. But meaningful conversation here, I think, and let's hope this space will democratize, the way we discussed, and it will reach to a next level so that more and more people will take benefit of, of this space and, raise more funds and invest more funds. Any of you wants to raise more funds or, everything, whom to reach out, the three, people here. But thank you so much for listening to us very patiently. Thank you, Visa, Ravi, and Pranav for sharing meaningful insights to the audience. Great learning for me as well. And thank you, GFF, for this opportunity. Thank you so much.
Thank you, everyone.
Thank you so much, panelists. May I request you all to please pose for a group photograph. And we're going to start with the next session immediately. And while we wait for the changeover, we'd like to thank our partners, our platinum partners, Google Pay, PhonePe, Visa, M2P Fintech, MasterCard, and Falcon, and our registration partner, Entity Data Payment Services. You all can get up from there. Headsets. Okay. Check. Am I audible? Yeah?
Yep.
All right. Can you hear me? Audible? All right. Okay, everyone. Welcome back to the second panel discussion for the day, which is on will open network for digital commerce, ONDC liberate e-commerce, and we have with us our moderator Supratim Chakrabarti, partner at Khaitan and Co. And on the panel we have Praveen Dabai, COO and Director Payworld, Anuj Khosla, CEO Digital Business at Hitachi Payment Services, and Tanu Banerjee, TMT Partner at Khaitan Co. And over to you. Can you hear me? Check. Yeah? Okay.
Thank you. Thank you for the introduction, and we have a great set of panelists. And we'll be taking over, I think, and speaking on one of the hottest topics of today that is there, which is will open network for digital commerce liberate e-commerce? Many thinkers say that basically it is a reimagining of e-commerce ecosystem, learning from the UPI ecosystem with the objective to actually democratize the market. It is an attempt to switch from marketplace-based ecosystem to a protocol-based ecosystem. So with that, I would pose my first question to Anuj, and that is, how do you see ONDC transforming India's e-commerce industry? Do you think it will live up to the expectations that people have? There's quite a bit of hype right now.
Thanks. Absolutely, I think it's a great idea. And there are two reasons I would like to quote here. Firstly, for any idea to be successful, the timing has to be right. And I believe that the time of launch is absolutely perfect. We are just out of the pandemic, and the consumer behavior has changed drastically in last 2 years. In fact, if we look at ourselves, right now we order groceries at home. We order food at home more than we go out eating. We order our medicines and many more such categories. In fact, I spoke about these three categories is because these were very, very conventional offline categories 3 years back. And now, as we see, everybody is now ordering in. So that is the first reason. Secondly, I would like to quote what Mr. Nandan Nilekani said at the launch of ONDC. So he said there are, for any initiative to be successful, there has to be those 4 or 5 things to make it right up there. So firstly, he said there has to be a real market or social need. And clearly, as we are seeing e-commerce blooming everywhere, small businesses are also looking at avenues to be a part of this e-commerce bandwagon. So ONDC is clearly, that. Secondly, there has to be a government push, and which is pretty much there when it comes to the initiative. Thirdly, the technology has to be right, and the kind of people who are behind ONDC, the entire setup, I am sure these are some great brains, and they are making the technology work there. Fourthly, the adopters who are going to participate in the ONDC platform, clearly where we are right now, we have a fairly good consumer, marketplaces ecosystem is pretty much there. We have a seller ecosystem. So we'll see a lot of these players coming in and participating in the ONDC initiative. And fifthly, and the last one but not the least, there has to be an umbrella entity running the initiative. So ONDC is that umbrella entity which is owning it and will make sure that it is going to be a big success.
Thank you. Thank you so much. Excellent points. I think next I'll go to you, Praveen. And my question to you is, how do you anticipate small-scale sellers to compete with existing e-commerce giants who come with an established consumer base and market recognition? How successful will ONDC be at ensuring that a level playing field is there and an equal discoverability of sellers?
Yeah, so if you see the ONDC platform, it's a network, and there will be buyer apps, there will be seller apps. And the idea is that to the smaller rural areas or tier 2, tier 3 cities also, sellers can be onboarded onto the ONDC platform and sell their goods to the people who want to buy or nearby places. In my view, the ecosystem has to be created to assist those sellers to get onboarded onto ONDC. like when we are comparing with UPI or financial inclusion, you can say it is e-commerce inclusion, where the companies like Payworld, which we are into financial inclusion space, we will through our retailers, we will create infrastructure so that we can help people to onboard onto the ONDC system and create our seller apps, train them so that they can be there can be assistance to get onto the ONDC system. And I think that will be the differentiator between the established player, because the idea of ONDC is not to cannibalize the existing sellers, but grow the seller numbers and get on to the people who are already not on the online digital commerce.
Right. Thank you so much. And I think a tricky one for you, Tanu, right now. Do you think that any incentives are there for large e-commerce players in India to also have their presence in the ONDC network? Will existing e-commerce companies have to remodel their business strategies once ONDC picks up pace?
Thanks, Supratim. No, I think absolutely. The biggest, I think, incentive or an advantage for.
Yeah, I think.
Okay. Now I was saying that no, absolutely. Today, I would think the biggest advantage for even a bigger platform today is just access to more consumers, right, in the ONDC network. And today, typically, an Amazon or a Flipkart, every user, every buyer has to be separately registered to each of these applications, right? I have to be a user of Amazon, I have to be a user of Flipkart, Myntra, and so on. And what I think ONDC would therefore change, and which I think is definitely a game changer in some ways, is that there's access to consumers across these platforms. So there is a larger sort of consumer base to work with. That's one. The other, I think, is each of these apps, if we just sort of look at the current dynamics, there's a lot of expense and a lot of effort that is put into customer acquisition also. Be it incentives, discounts, end of season sales, or whatever. And I think a large part of that can be reduced just because you have access to a larger consumer base. So I feel those are definitely pluses here. Existing models being changed, I don't know exactly how it would be changed, but I would think that definitely, for example, if there's a reduced expense on customer acquisition, perhaps that can be focused towards other niche areas. So yes, some amount of remodeling would happen, but I would think it will only be for the benefit.
Right. Thank you. I think I'll just add on some present-day statistics so that our audience is able to understand where we stand today. Really, our Kirana stores are presently 80% of the retail market. However, only very few are digitally enabled. I think the number is around 0.125%. So you can imagine the situation. There are about 12 million Kiranas approximately. Only 20% of internet users in India are online shoppers, actually. Of course, when we look at it from a different perspective, it's the third largest online shopper base after USA and China. Retail penetration, when we look at the numbers in terms of GMV, it's only 4.3% in India. Whereas in China, it's 25%, South Korea 26%, and UK 23%. So there's huge scope, With this, I will move back to you, Praveen. Sorry, I think let me ask this question to Anuj first. What broad policy consideration should ONDC set out before it becomes operational at a national level?
See, for any entity to set up a pan-India presence, you need to take care of a lot of things. Firstly, this is clearly a more complex kind of a ecosystem creation, because we are talking about a consumer, we are talking about consumer apps, we are talking about sellers, we're talking about seller apps. So clearly wiring them together would need a lot of work. Right from who can participate, so the policies have to be crystal clear. There has to be a regular process of checking each and every seller if they are meeting the criteria or not. what kind of customer issues or grievances are there in terms of a particular seller or in terms of a platform in general. Also, this also, the ONDC also brings in the logistics setup into this. So once we go pan-India, we need to make sure that, we are covering each and every pin code in the country. We are also making sure that we win customer trust at the end of the day. So the biggest metrics for ONDC to really watch out for is how is the customer experience at the end of the day, how many repeat customers are there using the platform, and in general, how are we handling the customer grievances at the end of the day. So closure onto those are important. The UI UX is also important from a customer perspective. So some of the policies around these have to be in place, before we go to a pan-India kind of a launch.
Right. Thank you so much. The next question to you, Praveen. We are observing that several nationalized banks have taken up stakes in ONDC. What is in it for them, really? What do you think? Is this an opportunity for them to make a deeper inroad into the payment and settlement segment of ONDC?
Yeah, so you see, all nationalized as well as private banks now to grow, they have to get into Bharat, or what you say is next half billion. And acquiring customers or SMEs to provide loans is a very expensive affair for especially private banks, or for that matter PSU banks also. So through ONDC, what I feel is the banks are trying to do is that get onto the ONDC, get the data, and because the data is digitized, so basis the transaction done on the ONDC, because most of the people in tier 2, tier 3 cities, the SMEs and the smaller retailers, as you said, Kirana stores 80%, they don't have any credit history, they don't have any means of providing their CIBIL scores. So, and the banks also would like to extend credit to them so that they can grow the business, and with minimum cost involved. So I think ONDC can address that issue because of the data available, and they can give small ticket loans basis the technology and the data.
Just to add there, just to add to your point, so any entity which has a large customer base on the consumer side, so it could be a telecom, it could be a bank, ONDC is a platform which is of interest to them, because then they can open their customer base to the whole seller ecosystem. And that is what ONDC is doing. It is bringing the two seller and the the buyer ecosystem together, and hence it makes sense.
Absolutely, completely.
And Super, just maybe to add a slightly offside sort of comment here. If we just you spoke about Kirana stores and how many they are, and so much of commerce or sort of happens from their retail commerce. And I think one leg that will be vacant, perhaps, we look at all of your Kirana stores, they still work on a account basis. Every customer, every people across will have an account. So I think that in a very micro level, they are all micro lenders to users outside, and ONDC perhaps that will be a vacuum. And who knows, maybe the financial institutions or smaller lending institutions could sort of benefit from that, because that is definitely a space that will be sort of absent in the ONDC network.
Yeah, agree, and fantastic points. Praveen mentioned about data. So Tanu, I think the next question to you is on the data front. Do you preempt any data protection concerns arising with regard to the vast amount of data that will flow through the ONDC network?
Yeah, I think very valid concern for sure. I think, and given data is oil today, but I think ONDC in its statement at least sort of the current strategy is that ONDC itself will not sort of monetize data or hold data. And therefore data will perhaps continue to be on the seller side apps and the buyer side apps. But having said that maybe they don't have access to data, or maybe perhaps they would not use it to monetize it in any way. So it will be a sort of more democratic. Yeah, so I think perhaps ONDC itself will not sort of have control over data. But having said that, I think data leakage, data compromise, security, these are also big concerns. So whether they have access or they do not have access, I think, adequate security protocols being put in place would be sort of essential, is what I would say.
Right. I think so. Some of the broad brush principles have been called out. That probably the data protection related principles would be respected. But I believe that what we have to watch out for is the granular reality that finally pans out and how that is managed. Okay, because considering the ecosystem, it could be a little challenging, and probably for some point of time, it could be a bit work in progress.
Absolutely.
Right. So I think. With this, I'll move on to Anuj, and this is a very important question. Since you're closely associated with the payment and fintech space, how similar would you reckon the ONDC is to the UPI model? We all know that there are similarities, there are far more dissimilarities, and things like those. Would you agree that ONDC network will require a more nuanced approach due to the involvement of various subjective variables you're just mentioning, such as quality of products or reliability of sellers or efficiency in delivery and things like those?
So, I'm sure all of us have heard this. The way UPI has democratized payments, ONDC is going to democratize retail. But, and it is modeled around the UPI overall setup. But my sense is that ONDC is more similar to a payments flow. For example, I'm sure all of you know this. In a card ecosystem, we call something as a four-party model, which is basically, there is a card holder, there is a card issuing bank, there is a network which sits in between, there is a merchant, and then there is a acquiring bank. Same way, in case of ONDC, there is a buyer, there is a buyer app, then there is ONDC in between, which is wiring these all together. There is a seller app and there is a seller. And ONDC is in general, a policy maker that creates the policy, who can come on board. How do we handle the customer grievance? For example, in the cards payments, there is a way to dispute a transaction, which is called a chargeback. There is a way which is the next level of a chargeback, which is arbitration. Same way, ONDC is going to list out these policies to handle some of these. Also, there are value-added services which are available in case of a card network. Same way, over here, the value-added services, the logistics setup, the payment clearing and settlement. So all those things are being put in place by ONDC and all the policies around it. And hence, I would like to draw a parallel to a card network. In case of ONDC, it has a very, very similar sort of rails which they are building here.
Right. Thank you. Back to you, Tanu. The question is, do you see possibilities of open network model proposed by ONDC being emulated by any other sector in India? And this question is also open to others. Feel free if you want to add anything.
I think I'll answer this in two parts. One is, in our heads, typically when we say an e-commerce platform, the first platform you'll think of is an Amazon or a Flipkart, right? So I would think with ONDC, there would be a lot of consolidation of, different sort of e-commerce. For example, food delivery, these sort of parallel e-commerce ecosystems would sort of consolidate into ONDC. So that's one. The other, I think, I don't know if it will happen or not, but I think one sector that could emulate this structure is the content delivery space. Today, just like, you have different accounts on e-commerce platforms, you also have different accounts on, different OTTs, different digital platforms, right? There's some platform for news, there is something for content and something for, web series and so on. And imagine, a network which sort of combines all of these together and accesses, sort of across. So I think that's one sector that could definitely look at it. Of course, there are devices like an Amazon Fire Stick which will, help you access multiple platforms at the same time. But what I'm saying is that ONDC structure is a different structure. It is a network that helps you access consumers and access goods and services bought by different sellers together, and maybe there could be some parallels to that in the content entertainment sector.
I'd like to add, I think credit will be the next one because the work has already started on open network for credit. I don't remember the name, but ONC. So I think that will be the next big step because there also the borrowers and lenders will come on that platform or network, not platform.
Right. So thank you for the inputs. We have some more questions, but I think we will, sort of break now and ask the audience in case you have any questions, and then we will get back to our final set of questions to the speakers. So if you can please raise your hands if you have any questions. I think if you can please pass the mic there. If you can please introduce yourself, your organization, if you're fine, and then ask your question.
Hi, I am Akshay. I just wanted to know if there is going to be some restriction on how many sellers or what kind of inventory and anything like that that will be a part of the system once it is up.
Ideally, it should be a part of the policy. I mean, there are clearly certain items which you can't sell because of various regulations. And that is going to be the role of ONDC, what you can sell, who can participate. As long as you are meeting the criteria, as long as you are following the protocol, I think more the merrier, because if we are talking about a pan-India kind of a rollout, then we need as many participants as possible. And the good thing about India right now is that we have a very, very evolved ecosystem in terms of seller apps, in terms of consumer apps. So ideally, my sense is that everybody should jump into this because of the vast opportunity. And you spoke about some numbers that retail is so underpenetrated in the digital space. Ideally, even a very small mom and pop store, local kirana store should be participating in this through, a partner, and should get discoverable across the country, and every consumer should get that choice of buying from that entity if the price is right, if the quality of product is right. So my answer is that everybody should be there, shouldn't be any restriction, as long as we are meeting the regulatory framework.
No, actually, what
I think what Manoj just I'll second it, that is that you compared it with the card network. So from the acquiring side, there is a list of things which cannot be
Correct.
Cannot be.
Correct.
Yeah. So similarly, a list will be there which they cannot be onboarded onto a own DC.
I'm actually sorry. I wanted to ask the categories. Like there is clothing, there is fashion, there is beauty, there is gadgets, there is electronics. In that sense,
everything except the banned categories.
Yeah,
so
that is
there are
fair.
certain categories which are not allowed as per local regulations.
Yeah.
Other than that, everything, I don't think there is any restriction as far as I understand this.
Also, I think a very interesting twist to this is probably we will get to see some very specialized players coming into play. For example, today Nykaa in the cosmetic space is quite ahead in the race as compared to a general marketplace that we have been observing. So probably this ecosystem will also push these kind of players quite ahead.
See, like I mentioned, pandemic has changed the customer behavior. In fact, very, very traditional categories are now sold digitally. So, 3 years back, we used to buy our grocery from a local, vendor. And now most of us order online. So once that local vendor also becomes a part of the ONDC network, then clearly you can buy from your local street vendor, but digitally would be the journey. So, that is the change that ONDC can bring into the whole,
Interestingly, the first ONDC transaction in India was dhania bought on Paytm.
So to add to that, during pandemic, what happened is that all these kirana stores, they started taking orders on WhatsApp. They started taking payments on Google Pay or Phone Pay, etc. So they were digitizing it. They were doing it, but ONDC will help them to do in their catchment area, do the selling in a more structured way.
And even expand beyond their
Yes,
catchment
okay,
area.
yeah,
So, I
yeah.
mean, that's the beauty that a seller sitting in some remote area can, then be a seller for somebody who's sitting in a large city and vice versa. So, clearly, it's a play which is pan India. And the small businesses may not just restrict themselves to their catchment area, but be a supplier to somebody who's say 1,000 kilometers away. So that is the beauty of the platform here.
Right. Any other question? Yeah.
Hi, Amit Shahani here. My question is related to something that Anuj I think touched upon, which is basically what about customer grievances, right? If I take a UPI, my personal opinion, while I don't pay anything for UPI right now as a consumer, the dispute resolution is far stunted as opposed to using a card association where I pay more for the transaction and I get assurance of the of my grievances. How does that translate to ONDC? I mean, again, you're going to democratize the platform. You're going to bring down the cost. Have many sellers. Right today, if I buy something from Amazon and I'm not happy with it, I just return it. Right? How will that pan out when it comes to ONDC?
So I think, and that is the reason I drew a parallel to a cards network here and not UPI, because the customer grievance management is the most important part of this. And my understanding of this is that in case of a dispute, customer will go to his consumer app, and that will get connected to the seller app and then to the seller. I mean, that is the exact mechanism that happens in a four-party model. While the policies will be made by ONDC around it, how the grievance will be handled, what will be the mechanism, how a refund will move in case there is a refund, how the product will be picked up. But clearly, it will follow, the same mechanism like a four-party model, where you go to your part of, the world and not directly to the seller in case of a dispute.
Also, I think the recommendation has been that dispute resolution should be through Niti Aayog based ODR. That's what has been recommended.
Right.
I think there's another question there.
Hello. Yeah. Good morning to all. Myself Shubham from Kotak Mahindra Bank, and I handle the digital payment alliances and banking alliances. So I just like to add one more point regarding why banks are getting into this is because we missed the UPI bandwagon. So this is one more reason that we want to start up with that and get into the picture at the starting of it. My question is, since we want to break this duopoly of Amazon and Flipkart, mostly of that, so they own the loyalty of the customers, right? Most of us over here have the Amazon and Flipkart app on our phone. So how do you think the banks will break on this on the buyer app of the side? Because initially the banks are getting into the buyer side and then they will get into the seller side. But I am sure that these e-commerce giants will get into the ONDC system. But how do you expect banks to break that duopoly on the buyer app of the side? Thank you.
I think what I feel is that it will be the cross-sell. Like today, bank, apart from financial transactions, they do bill payments, they do travel. Like, for example, for Kotak, you can book a air ticket, you can do a lot of things on that. So it will be, and for banks, that will not be the focused area to do e-com transactions, but they would like to offer the services so that their customer need not go out of their app. I think that's what I can
Absolutely. So in this way, you are going to create engagement on your own app. Your customer is initiating that transaction through your consumer app which you have, and then the consumer goes on towards the seller ecosystem. So it's a great way of keeping your engagement going with your customer base on the app that you have.
Right. Any further questions? If not, then I'd like to.
Suprabh,
There's
we
a
have
question.
one question
Okay,
there, I think.
please.
Yeah.
Hello, my name is Vineet. I'm from D91 Labs in Bangalore. My question was around acquiring, the onboarding process. For example, like you mentioned the immense potential that there is for Kirana stores. So in terms of onboarding, how do you see that process panning out? So like if, for instance, there are going to be assisted models that are going to sort of help small mom and pop stores to be part of the whole network, and what are the implications of that in terms of the cost for these mom and pop stores to basically part
See,
of this?
I strongly believe that it has to be a assisted model, because if you see QR code success or Amazon sellers onboarding, there were always an assistance. Like for putting the QR code by Google Pay, Phone Pay, Paytm, lakhs of people were on the field to put that QR code. Similarly, on ONDC also, to get all these Kirana stores and small street vendors, there has to be assistance. And I think companies like Payworld will get into that space to train them people, help assist them to onboard, assist them to transact. And what will be the commercials is yet to be seen. I think it's too early to say.
I think there's another question. Yes, please.
Hi, I'm Radhika Biani from Narottam Sekhsaria Family Office. My question is that will the smaller players get pulled into price war forcefully because of ONDC?
Any thoughts?
I think great thought for sure. No, I think definitely a great point and concern also. And today, you can't shy away from the fact that the bigger e-commerce giants obviously incentivize, offer discounts and so on, which maybe the local players are unable to do at the moment. But I also feel that in a common network, your general market forces and competition is going to drive the pricing. So somewhere I think perhaps at the beginning it could be a challenge, but it's going to eventually correct itself on its own is what I think.
Thank you. I think then we will move on to our last segment, which is a quick fire or a rapid fire question round for all the panelists here. I'll start with you, Anuj, and then maybe Praveen, you can answer the same question, and then Tanu. The first question is, will ONDC match the success of UPI?
Well, I think absolutely, because like I said, the timing is perfect. And secondly, there is a huge opportunity. We are talking about $1 trillion retail opportunity. If ONDC can get even 10, 15, 20% of it, we are talking about $200 billion. And clearly, it's with the evolved app ecosystem, I think everything is in place for it to be a big success like UPI.
Yeah, I agree with Anuj, but what I feel is it will take time, because UPI also took time. It didn't became successful overnight with push from all players, providers, government. So similarly, ONDC will be as successful as UPI, but it might take some time to reach that point.
I think I'm just going to add to what Praveen is saying that yes, definitely it's a model that nobody else has sort of tried in the world right now, and definitely democratic. So I again think that yes, it is going to be a success, but maybe it's going to take longer, as compared to UPI, just because there are more complicated ecosystems, sort of, and participants in the system here. For example, UPI as a structure or as a product, does not need logistical on-ground support, right? Here you would need that. Similarly, UPI is in the financial space, which is already a regulated, sort of space. The system participants there are regulated entities. They work in a certain regime, as opposed to the ONDC or the e-commerce space, where there are different participants. There are some regulations, some contours for everybody, but there is not a united regulatory front right now. So I think those are just things which is sort of a work in progress. And once we cross over that, I think it will then sort of see success.
Thank you. What is the one thing about ONDC that scares you?
I mean, the only scary part about ONDC is the scale that it can reach. And I'm saying so is because, Tanu mentioned, it's a very complex structure. We are talking about bringing in different stakeholders together. And in such a case where the buyer doesn't know the seller, they could be 1,000 kilometers apart. Handling customer queries, grievances becomes very important. And like I said, user experience is the most important thing. So managing some of those things once you reach scale is a complicated thing to do. And hence, that is a scary part, but I am sure ONDC will handle that well with the policies which will be in place and which are already in place. And hopefully when we scale it up, we are, not facing any of those challenges.
Praveen?
Yeah, I think what Anuj is saying is correct, but another thing is that who will be the responsible in case of the grievances are not addressed? Because from buyer side or from the consumer app side, like he gave an example, Kotak will put it. Now, if a Kotak customer has got a problem, will it hit Kotak's reputation or the bank's reputation or the supplier's reputation? So that has to be addressed because presently the e-commerce platforms, they take the responsibility of satisfying the consumer. In that case, who will be doing it? But I think sure the policymakers must have thought about it and it will be addressed with the correct policies.
Tanu?
I have a similar take, but slightly different as well. One, I think what sort of scares me, so to say, despite all the positives that the network and the structure offers, is we spoke about data initially. One, just the amount of data that's going to flow through this network. And you have so many participants. You have sellers, you have buyers, you have logistic vendors, you have financial institutions into, all baked into the same sort of ecosystem. So that's one. And the other being that, ONDC could eventually, it is one network which is going to sort of stitch together all of these participants, right? So the policies that eventually will come in place will sort of become quasi regulation of sorts, right? Which is where I see this going, which is not a bad thing at all. Any sort of regulation, having a regime around is has its pluses, but so long as again there's some sort of balance, I think it will be fine.
Great. So coming to the last question of this rapid fire round, what is the most revolutionary aspect of ONDC according to you?
I think the idea itself and the way it has been conceptualized, we didn't get carried away with the fact that we should get a super app going. It's not a super app, and it is actually connecting the super apps together. So that idea itself is, I think, great the way it has been thought through. And now execution is the key, but my sense is that that's the biggest part about ONDC.
So I think the network is created or rails have been created. Now it's up to the ecosystem to put a bullet train on it or put a malgadi.
I think what is really revolutionary is, just how inclusive the system could be, from just really micro players, smaller players, large players, sellers, buyers of all types and all stratas. I think is just a very, very inclusive concept, which I think is amazing.
Right. So thank you for your inputs. This is truly an unbundling of various parts of the e-commerce value chain. Let me tell you what is the goal of ONDC by 2027. The goal is 90 crore buyers on the network. India presently has about 14 crore online shoppers. 12 lakh sellers to be there. Around INR 6.5 lakh crore GMV. I think currently it is 2.85 lakh crore. And 730 crore of annual purchase enabled on the network. That's the plan. Hopefully, we will be there. Thank you so much, panelists. Thank you, audience, for your patience and for the great questions. We hope great success to ONDC, and hopefully there'll be more conversations on this very soon. Thank you, everyone.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you to the panel for that discussion on ONDC. Will ONDC liberate e-commerce? And before we move on to our next panel discussion, we'd like to thank our partners, our theme partner, WhatsApp, co-powered by Amazon Pay, our spend management partner, Ncash, in association with Perfios, payments partner, Cash Free Payments, and our CEO's dinner partner, HSBC. The next panel discussion coming up is on competitive collaboration between NBFCs and Fintech companies, which will begin in the next couple of minutes. Our speakers are here. We're just changing the setup, and once we're ready, we will start. May we request everyone at the back to please come forward. There's a lot of space towards the front, a lot of empty chairs in the front if you'd like to come forward. Am I audible, everyone? Yeah? Am I audible? Yeah? All right. Hello, everyone. Welcome back. Welcome to this panel discussion on competitive collaboration between NBFCs and fintech companies. We have our panel on the stage. This session is being moderated by Mr. Bhavesh Gupta, Zonal Manager, Informatics Valuation and Ratings. And on the panel, we have Mr. Girish Chawla, co-founder BizLoan Private Limited, Mr. Satyam Kumar, CEO and co-founder of LoanTap, Mr. Ritesh Jain, co-founder of Flexi Loans, and Mr. Alesh Avlani, founder of CreditWise Capital. The competitive collaboration of NBFC and Fintech, organized by FIDC, which is the Finance Industrial Development Council, self-regulatory organization, that's SRO, and representative body of non-banking finance companies, NBFCs, and Fintech. This is registered with the Reserve Bank of India. All right, over to you, Mr. Gupta, to take the session forward.
Thank you so much. So good morning to one and all present over here, as well as the live audience. So the audience over for this session are around the globe. So to just set the stage right, let me start with India. India, a land of villages where no people thought of buying groceries or vegetables online. They never thought of retails going out of fashion. Similarly, more to India in Bollywood 60s, there was always a part of the story, a favorite character, which was a Lala. This Lala is referred to as traditional looting and manipulating money lender. So back then, understanding a fintech or taking this lending into the digital way of lending someone to a person, not knowing in person or without collaterals or without mortgages, would have been like comparing a complete complex or situation people living on moon. So this understanding of or this journey from Lala lending to the fintech, this is what we are here for. Uh, to the competitive collaboration of NBFCs and fintechs, I will start with my panel speakers. So first question to Alesh ji. So Alesh comes with a PE background and overseas market understanding as well. So Alesh ji, to you, why this collaboration was exactly required, and how you find a need for this to the entire ecosystem, please.
Thank you, Bhavesh, and a big thank you for having us on this panel. Just a little background for those present. We at Creditwise Capital are into two-wheeler financing. It's a unique product of secured, semi-secured, and also a high-yielding product. India is the biggest two-wheeler market in the world. So that's just a little about what we are doing at Creditwise Capital. And you rightly mentioned, right, the journey from Lala to FinTech. India, with its population, it's just on the cusp of the century that it's going to be having. Lending will be the most pivotal part it will play over the next 20-25 years. Every single Indian today will be working towards buying things on loan, and that journey is where we are in the midst of, in the crux of. Like a couple of facts, right? India has about 410 approx unserved, new to credit customers who probably never even tried getting a loan. Even if they did, they must have taken it from the people you mentioned, the Lala customers or the Lala lenders. How do you serve them? NBFCs alone, banks alone, fintech alone cannot do it. Each and every single three of them is required today to serve even 50% of those customers, and you'd still be having more. So, ever there is a distinction, why is it that all three of them need to be treated as competing or treated as vendors, right? Is something that needs to change. India has to start thinking more from a global perspective rather than trying to find um, differences between these three. There are pros and cons of each of these three, like a bank, NBFCs, and fintechs that everyone can learn from. Today, fintechs would not be able to be present without the NBFCs. NBFCs would not be able to penetrate as deep without the fintechs. For me today, NBFCs, fintech go hand in hand. And if India needs to unlock the potential of lending, these two need to have not just healthy competition, but work collaboratively together for the next 20-25 years.
Oh, that was great. So here we are talking about India reaching its potential to the highest where the credit can go. So understanding this, there should have been more. This way of NBFC and fintech, the collaboration has helped the market in so many ways. So it has simplified the market. To understand more, I'll request Girish ji to put some light on this, on how this can actually happen. Girish comes with a rich experience from banking. He has been with ICICI, Kotak, and a lot of retail banking expertise he comes up with. So Girish ji, please, some insights on this.
Thank you, Bhavesh. First of all, thanks for having us on the panel. I represent BizLoan, which is a new age retail non-banking finance company. We are basically using technology to a large extent to reach our customers, but the customers happen to be those who remain underserved or untouched by the banks. Coming to our experience of this set of customers and how this collaboration can take further shape or a better shape, I believe that there are three layers we have. We have banks which come with the lowest cost of funds. Then there's a second layer which is larger Nbfcs, which have slightly higher rate of interest for the customers because of their further cost of funds being high. And then comes the fintech part. So among these, while the banks have branches, but their policies still remain traditional and not so flexible. So these banks therefore are unable to serve the last mile customer, which is primarily say a very small retailer or somebody with no track record or credit bureau scores. So in this case, the NBFCs come in picture. They have much more flexible policies, much more flexible products, and they're the ones who can actually approach these customers through their branch network. But then they also sometimes move slowly. So they need fintech for a much higher reach. They need fintech to reach those customers who don't even have a credit score. As Alesh said, new to credit. So today fintechs are actually serving almost 40%, or they're getting almost 40% of their new customers, which are new to credit. They don't even have a credit score. So this is the market that fintechs are bringing in, which is being further served by NBFCs, and then the top layer of banks comes in. So what happens here is that NBFC is right there in the middle. NBFCs would tap fintechs for origination, and then they would tap banks for co-lending. So it's a three-way process, which is a win-win for all. I think that this is the future of this collaboration, where the lowest cost of funds gets actually transferred to the customer, and the customer who would never be able to actually approach the bank directly reaches the bank's books. That's exactly the way this collaboration should actually look.
Wow, that has been a great insight. So, a lot many stakeholders over here we see. It's bank, is NBFC, it's fintech, it's client, and the moment to moment, how the things are flowing, how the movement is flowing. To understand more on this, I request Ritesh to have an insight on. Sorry, firstly Satyam, to how this implication happens, and how do you look at the future of this collaborations going further, please?
Yeah, thank you very much, Bhavesh. So, at LoanTap, we handle all retail loans, essentially loans between 1 to 10 lakhs. So, we dabble in MSME, extremely retail, and a lot more on a consumer side, which is for personal consumption needs and all. And also, we do some new age products like electric vehicle lending and also. So this is what we do. Essentially, what we see is that NBFC, as Ms. Chawla was rightly mentioning, they have been willing to take risk in past also. What it essentially creates is it creates an ability for an innovator to create a product or create a journey which has a less friction. So a natural partner for any fintech or anyone who is really looking for it to innovate, either on the segment side or on the product side, it becomes an NBFC, which which is always also seen and called as a parabanking, shadow banking. So it has not been called for no reasons. The reason has been that they have been willing to experiment with their distribution. They have been willing to experiment with the segment that they want to lend to. They have been willing to also experiment with the product or the categories where they want to do a lending. So the moment you want to do a innovation, whether it's a tech-led innovation or a particular need-based innovation, then an NBFC becomes a natural partner as far as availability of the credit itself is concerned, which is regulated by and large by RBI in terms of who will be able to create a credit or who will be able to do a credit in the society. So from that point of view, there is a huge space, and what we have been seeing is that we have been seeing a great growth coming in, and particularly it is coming because of one reach, newer distribution which is getting created, which is a data-led distribution from the fintech part of it. And the second which is getting created is that there is a lot of operational flexibility is getting created by lowering down the operating cost when you look at the whole set of the data-led journey as well as the tech-led journey. So two of the most critical part which was hampering the growth of NBFC sector was about running with a high operating cost, which was a branch-led model and all. And now you are seeing more and more NBFC catering from a single branch based out of a Pune or a based out of Bombay or a based out of Bangalore to more than 5,000 or more than 10,000 pin codes across India. So that's a pure reach which has been enabled without having a branch-led network. So an NBFC sitting out of one location is catering from a Kanyakumari to Kashmir, all these locations. So the distribution is what has been brought without putting additional cost to the entire operation. The second which has been bought is the product innovation itself, which is where you are getting more recent data, newer kind of a data, and each of those data are very relevant. So recency of the data, lower cost of operation, and anywhere kind of a distribution on a digital journey, all three of it becomes very important for running an NBFC operation at a low cost. And what is also getting is that post validation of the idea, once you validate the idea, you validate a portfolio, then you start seeing a mid-sized bank or a large-sized bank also come and participate in the risk environment. And that is where a couple of enabling regulations has also come as we in this sector. So what it has done is a fabulous in terms of fraud prevention, distribution, keeping the operating cost low, and institutions' ability to design a product even for a micro segment of the customer. So these are the things which I see a great value add in this relationship when it comes to a partnership between a fintech and an NBFC for that matter.
Wow, that has been a true insight with your expert understanding of the retail market, what you have. So a lot of things where we came across. So Satyam sir talked about the technology. He talked about the new product innovation. He talked about new market and new person adapting to this. So when we come across this newness of new products or new market, there is always a question on how this tech acceptance is there into the market to the people around, and what are the related threats or disadvantage to the customers or either to the from the NBFC fintech understanding as well. So because you come from a technical background, I mean, you'll be the best person to give us the insight. Please, sir.
Hi everyone, this is Ritesh. I'm co-founder of FlexiLoans. I'll just, FlexiLoans as a company, we are an embedded finance player. We empower fintech companies or large companies to become MSME lender. At the same time, we give MSME lending, MSME loans across India digitally. What my fellow panelists have said, like we are doing exactly the same thing, and I'll elaborate on that particular piece, that how we are doing and how it is being accepted by various large players and banks. Like we are based out of Mumbai, and through Mumbai we are capturing, or we are providing coverage to 2,000 cities and 15,000 pin codes. Now this was not possible for a large NBFC or bank to do loans. Now what is happening in terms of partnerships? Now large, though FlexiLoans is also NBFC because we are on the right side of regulation, but large NBFCs are integrating with us to provide loans, and they can access these 2,000 cities without setting up of branches. So this distribution power, so because we are bringing so many customers, there's lot of acceptance. Acceptance-wise, if you see this conference, if you walk around, so much of collaboration is happening between large players and small players. There's no doubt that there's a lot of acceptance between fintech and NBFCs through that particular concept. The second point, I'll take you through 3 points around the acceptance part. The second point is around the product innovation. Like Bhavesh, you rightly started with, like there are money lenders, and if you take example of MSME lending, still only 15% of MSMEs get loans from organized players. And money lenders have been, or family offices or family parents have been financing these needs. And we are really disrupting the business of money lenders through this product innovation. Typically, large banks or NBFCs would provide loans above 10 lakh rupees, and they cannot serve economically viable loan for a small ticket size loan. Now, as Flexi Loans, we have launched various products where, for example, BNPL, like traditionally distributor used to provide 10-day credit. Such kind of products were not possible through NBFCs or large banks. We empower these products where a typical retailer, when they're buying 20,000 rupees ticket size of goods, groceries, that particular retailer, instead of paying after 10 or 20 days, they can take 2% discount upfront and get that finance. Imagine this person was paying indirect cost of 60% per annum of financing, getting finance through distributors, which we are able to disrupt. And through lowering the ticket size, we are disrupting the entire market. So similarly, and this will happen in lending. This has happened in payments also. If you see what has happened, like UPI, before UPI came in, there were 5 million credit card accepting machines. And with the lowering of cost, when QR code based acceptance came in, like the number has increased to 50 million. Now 5 million to 50 million, imagine the kind of coverage it has provided. Who would have imagined that you can pay a milk payment of 50 rupees via digitally? That is happening. That will happen in lending also. That is happening in lending by reducing the sachet size of loans. So that is the second point on the product innovation, which companies like us are actually disrupting the market around this particular player. The third thing which my fellow panelist has said, and I'll give the exact example around this, is lowering of cost. Because smaller ticket size loan was not possible with the high cost structure that was prevalent due to branch-based banking. Now, there's a collaboration not only between Fintech and NBFC, there's a collaboration between Fintech and other Fintech players. Like
Yes.
KYC is the best example. Earlier, KYC used to take 500 to 1,000 rupees if you have to do a KYC or OSV of the person. Right now, you can do OSV at the cost of 5 rupees or 50 rupees, as the case may be, the kind of model you are adopting. There is either 100th or 1/10th reduction in the cost, and smaller ticket size loans are possible. So because of this huge benefits, there's lot of acceptance. We are seeing lot of acceptance between banks, NBFC. There's no disruption. There's no competition around it. We are empowering each other. But rightly said that there are certain threats also which you wanted to ask that particular question. In the process, if you see that those threats in the process right now, if you take a typical loan journey, there are a lot of fintech players and lot of players now are involved in that particular journey. Earlier, traditionally, the customer will walk into branch of the bank and only one player was involved. But right now, because there are multiple players involved, the personal information of the customer is shared with a lot of players, either in the process of KYC, either in the process of document image recognition, or in the process of NASH registration. So there are fintech players involved in the process of loan journey, and personal information of customer is being shared with lot of players.
Data security is what you are trying to say.
So data security over
that
there
is a stake.
is a cause of concern.
Yes.
But government is coming on RBI. If you look at the
Yes.
RBI latest paper, they are coming up with right set of regulations wherein consent-based architecture is being proposed. And if the customer is giving consent, and then only the information can be shared. The DigiLockers of the world and other assets will also help in reducing this threat of sharing of personal information or leaking of personal information. Yep.
Thank you so much for that great insight. So we see how the acceptance has been going. We see how the collaboration of NBFC, fintechs and other players in the ecosystem has been handled out. In this is the most, I believe, important part of the sessions where we will explore more on how these things are happening. So, Mr. Shaktikant Das, the Governor RBI, one of the speakers in this GFF, so he clearly mentioned where the fintech is the highest growth segment, and they will take all the ways and means to protect and safeguard the stakeholders and the all related stakeholders. So on this, Satyam sir, I'll like your input on, or your opinion, which is the best move what RBI or the regulator has taken for this collaboration. So please.
One of the issues that we face is the lack of regulation, and what has happened in last 6 to 7 months is the growth of fintech during the pandemic, even pre-pandemic, had clearly made it as a mainstream rather than being one of the development in the economy. That essentially ensured that both the government and the regulatory ecosystem came together to form the initial framework for how to regulate the sector. So having a regulation is one of the biggest thing that you want in a country where you are working at the sidelines of the society, where you are touching people's lives, and in a country where still you have so much of a linguistic barriers, you have so much of literacy or a digital adoption on one end. At the same time, we are talking of data privacies, sensitivities of informations and all. So you have all these barriers coming in. So regulation was the key requirement, because if you are not regulated, then probably anybody and anyone can come and start challenging your authority to operate in that particular domain. So having a digital lending guideline in whatever form it is, so we all have a view how enabling or how better it could have been. But from that point of view, having the base guideline itself is the biggest success story of fintech coming off as an industry in itself, and not being only seen as one of the arms of the whole lending ecosystem. So once that part has been taken care, the second and the biggest enabling mechanism came in was about 1.5 years back, when the bank branches were shut, the Nbfc physical ecosystem was shut. At the same time, the government decided to enable credit as one of the mechanism to fuel the economy during the pandemic. So unlike many other governments outside India, there was no direct credit to individuals other than a certain farmer segment and other segment. That means what was enabled for the businesses to run and the economies to keep on sustaining was ECLGS and different schemes which came from the government to expand the credit in the market, to provide a credit or a support it by the credit for MSME to run. So both in that period, the banking sector and NBFCs realized that they just can't operate without the support of the fintech in a manner where the people are not able to reach branches, customers are not able to reach branches. Branch after branch has been going through a COVID lockdown because of one or another contamination. So the whole process got augmented. So, pandemic brought a big shift in the way the banking system, NBFC system saw the technology participating or co-participating with them. So that was one, was the event. The second was two stuff which came as a co-lending enabler, and the second and the first one, as I said, that having a guideline for the industry as a digital lending framework itself was so important for us to know that these are the boundary conditions, these are do's, these are very clear don'ts and all from that point of view. So this is what we have been, we see as 2 to 3. One was enabling event, which fast-tracked the whole stuff, the way demonetization fast-tracked the payment adoption. The same way COVID fast-tracked the digital lending adoptions, both from a customer side as well as collaborative side of the economy. So this is what we see. And a co-lending which frees up the balance sheet, so it allows tech to dip into NBFC balance sheet, it allows an NBFC to dip into bank balance sheets in a shared risk environment from that point of view.
Oh, that's great. So understanding this, we are talking about regulation, we are talking about sharing, co-sharing things. So we are a diversified country, we have different type of NBFC, we have different type of fintechs. Some might be into auto loans, some might be into personal, some might be into labs, and so on and so forth. So this regulatory boundaries we are talking about, and the um, moves we are talking about, obviously there might be. So this one is for Girishji. So to your understanding, what regulatory move impacted NBFCs and fintech in an adverse way? Because everyone has some pros and cons. So what are the moves as per your understanding that might have impacted on the adverse way? Please, sir.
So, you know, using the word adverse actually might start some controversy. So I don't think that there's anything adverse in the regulation that has come. To start with, there's only one part of the entire regulation which is still being discussed. I try to harp upon all the parts of the regulation that has just come in on September the 2nd. So out of these, it is only the FLDG part which is still being debated within fintech and NBFCs, and even the banks are a bit worried about how would they get covered on risk side. Uh, while the governor himself a couple of days back in this forum stated that the issue is under examination, so I don't think that I need to speak much about this, and only the time will tell how we all as finance players do a round around on this particular issue. Other than this, if you look at the entire regulation, it covers a few points. So let me break it into two parts. So one, it talks about customer data management. We just discussed how important it is to secure the customer data, and we all wanted a regulation around it. Two, localization of cloud data, which again is an important factor. We've seen that how cyber attacks have made our customers so vulnerable, and the data security, if it's kept locally, is much better. And three is KYC. Now these 3 points have already found buyers within the industry, and a recent BCG study also revealed that almost 90% of the respondents, which are from NBFCs and fintech, and even some participants from banks, accepted these regulations and they welcomed them. The next part of the regulations are more operational in nature. So one is setting up a nodal office or appointment of a nodal officer. In my view, it will only reduce the customer grievances, or if not reduce, it will help in resolving customer issues in a much faster and better manner. So that's again a good guidance to have. Then we have cooling off period. Now there have been issues when the customers actually feel misguided. Uh, you know, just coming back to the first point that you started, there have been certain players or apps which actually played like invisible lalas, so to say. So the customers did not have a choice. Once the money comes in their bank, they would not have a choice but to but to understand, but to
Obligize with the whatever the terms and
exactly,
conditions were there.
and there were actually no terms and conditions. It was whims and fancies, so to say.
Yes.
In certain cases. So
Okay.
it is good to give customer an option around
Mhm.
this. It is always better that customer kind of
Right.
has a visibility around what terms has he gotten into it, and if he wants to reverse his decision of taking the loan, he can be allowed. That cooling period can be of 3 days also, which
Right,
is what
right,
the
right,
regulator
right.
has said, which I feel is good enough. Then another part is reporting of loans, all loans. Now we are in micro segment, and we come across a lot of customers where their loans from the so-called credit societies or pathpidis are not even reported, so we don't even get to know how their loans have behaved.
Right.
It is always a good idea to get everything reported. At least the customers would have a bureau score, right? they would become, they would get into the organized segment. A lot of these micro enterprises which are there in tier 4, tier 3.
Giriji, sorry to cut in between. If you can just shorten up because we are running out of time and we have two more important questions,
These were the
please.
two parts only. So
Acha.
this was the last one among these. So this regulation also, in fact, helps us all in taking a better credit underwriting decision. So in my view, I don't think there's anything adverse. It
Good.
can only be a short blip, but nothing adverse around the regulation.
Obviously, when regulator is coming out with 4, 5, 6 notifications for a particular sector every month on month, that has been consistent, though it be March, April, May, every month at least 5 to 6 circulars, notifications, FAQs you see over there. So obviously there might be some glitches, but the things are been taken care on the long run. So coming to this, on the so there has been a mushroom growth on technology. Yesterday, the governor for Mumbai, he was here. So he clearly, Devendra Fadnavis, he clearly mentioned and declared Mumbai as the Fintech capital as well as the startup capital. So this one is for Ritesh. Ritesh, we will need to keep it short in 3 minutes. I will not take much time. So your advice to the startups and fintechs, that is one. And no, we will keep it to this. Your advice to fintechs and startups, please.
I'll have 3 advice to them. Think about customer, think global, and think about security. Think about customer because customers' expectations are evolving. Traditionally, what has been happening is this sector, people were thinking not regarding customer experience as paramount, but customer experience is changing. Earlier, customers were getting deliveries in 2 days. Right now, they're getting deliveries in 10 minutes. So that might be in e-commerce. Now they're questioning why can't they get loans in 10 minutes? So that kind of focus has to be there on the customer side. Secondly, it is very important to think global. Right now, every company is thinking about India only, how fintechs can serve banks or banks can have relationship with fintechs as a vendor kind of relationship. But both fintechs and banks have to think global. Like UPI is going outside India, why can't fintech solutions go outside India? Why can't banking services go outside India? The way Apple products are being distributed across the world, why can't banking services or fintech services be launched across the globe and India become a leader in fintech services? So think global. And lastly, this will not be possible if there is a self-governance governance on the security part. Fintechs have to level up their bar on the security part of it, and then only this will be possible.
Hello. That's a great insight for every upcoming startup and fintechs over in the crowd and to the audience. So this will be no doubt duly noted by our audience. Coming to our last final point of the discussion, which I like Alesh ji to handle this. So ministry is listening, regulators are listening. They have been proactive on how the fintechs need to be handled on the regulation side, on the boundary side. As per you, what will be the suggestion if as a fintech to the regulatory body? And after this, I like if you can sum up a total understanding of the total session, please.
Sure, Bhavesh. You've given me the concluding ones, the most dangerous ones, straight to the regulatory department. But my request straight to like FIDC, the regulators, is just don't let a couple of bad apples define the entire basket. Yeah, we do understand that there have been a couple of fintech players who have misused data, misused KYC data, but that cannot be the norm. You cannot let India reach its $5 trillion economy by like putting brakes. lending will be the one of the biggest parts, right? As you rightly said, fintech is the fastest growing ecosystem in India. Lending will continue to be a major part. If we want to grow together, FIDC, regulators, all of us need to understand one thing. Maybe we can have stricter norms while onboarding, for example, now and maybe NBFC licenses, right? Today, you get an NBFC license with a net worth of 2 CR. NOF required is 2 CR. Maybe we can increase that limit. So fintechs probably who are just about starting off, early stage fintechs, not everyone gets a license. Maybe we can only look at those companies that have raised some kind of equity, they have that capital, they have some kind of corporate governance in place, and then they start applying for licenses. Maybe we can have, as most of the co-panelists also said, that focus on security, focused on data. Those things need to be factored in even more. And like complaint redressal issues, right? Yeah, okay. As Satish ji rightly said, right? There have been challenges where customers don't know what they're getting. Maybe have some policies coming into place that you check exactly how communication happens with customers. But straight away putting brakes, the circular coming every 4-5 times a month, it just confuses the entire ecosystem. Doesn't allow us to focus on our core focus, which is servicing the customers and providing them something which they can grow from. For example, like a two-wheeler loan, which we are focused in, or a consumer loan. It's probably the first product individuals take on financing in India. Like it's an average young age, 27, 26-year-old who's taking a loan. If you put a challenge for him to not be able to get a loan, the first loan itself, he's going to struggle for the next 5 years. He's not be able to build credit history when he wants to take larger, bigger loan products. So it's just aspects where maybe we can make it stricter on who we onboard, how we onboard, and have those checks in place. But straight away putting in brakes, banning certain things like prepaid card, credit cards, BNPL cards, it just confuses the entire ecosystem. And I'm sure that in Harmony and Fintech, NBFC and Bank, for me, they all three are not separate entities. For me, they are India's Fintech ecosystem and needs to be evaluated and looked at as a collective rather than an individual entity.
Thank you so much, Aleji. You have been a face to NBFC and Fintech at this summit, and you are, your no doubt, regulators are going through this. So let's see how this is accepted on point. Quickly, I will like to take some questions from, or one or two, probably a question from the audience. Anyone?
Hi, this is Abhiram from India Partners. Thanks to all the panelists for sharing their insightful comments. Just one question I had. Where do you see as the end game for the fintechs? At some point of time, for them to become large and impactful in the ecosystem, do they need to become NBFCs or banks? Or can a fintech survive and be a large entity without being an NBFC or a bank? Thank you.
Fintech has no limit to grow. I mean, sky is the limit on point. But I'll open this for panelists. Anyone?
If you see, what you definitely need is an RE ecosystem because of our data sensitivities and all issues that institutions comes across. If you do not have an ambition of making a big on the interest or risk income, then having an AA ecosystem is the best for a fintech. So where you are able to hold the data, you are able to share the data, you are able to analyze the data. So an AA license from an RBI is the best one to operate with. Otherwise, an NBFC or in any other manner, the same can be achieved.
I'll just add to this, like fintech is a very broad spectrum. They could be technology companies. Like if you see, walk outside, there are companies who are just doing like reading documents efficiently. There are companies who are improving certain processes. Those they are creating IP in itself. So those IP or technology companies can grow without getting into regulatory umbrella. People who are just who are distributing loans or who are distributing services, they will have to get into regulatory umbrella in form of NBFC or getting into license. That's the yeah.
Thank you so much for the inputs. A big round of applause for all the panels. I see a full house session. And thank you so much for the panelists for joining. Thank you so much.
Thank you, Bhavesh. Thank you.
Thank you.
Absolutely. Thank you to everyone.
Last but not the least, FIDC, thank you for giving us an opportunity on this. Thank you.
Thank you so much. May we request everyone to please pose for a group photo? Our photographer is ready. Solo. We'll be starting with the next panel discussion immediately. So may we request everyone to kindly be seated. It's the war of the super apps coming up. Check. 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 All right, may we request everyone to kindly be seated. We're getting ready for the next panel discussion coming up, which is the war of the super apps. May I invite all our panelists to please join us on the stage. And before we begin, while they come up on stage, we'd like to thank our partners, our theme partner, WhatsApp, co-powered by Amazon Pay, spend management partner, Encash, in association with Perfios, payments partner, Cash Free Payments, and CEO's dinner partner, HSBC, our communication partner, Kalera, banking partner, Standard Chartered Bank, our diamond partners, PayU, AWS, Kia.ai, and Paytm, and our networking partner, Buddy Loan. All right, everyone. We begin with our next panel discussion, which is on War of the Super Apps. Moderating this session is Mr. Nilesh Gupta, Head of BHIM and NETC, National Payments Corporation of India. And on the panel, we have Mr. Naveen Chaluwadi, CDO of Yes Bank, Mr. P.R. Rajagopal, Executive Director, Bank of India, Mr. Abhijit Kamlapurkar, Managing Director and CEO, NSDL Payments Bank, Mr. Sandeep Ubre, CGM, Digital Transformation and E-Commerce at State Bank of India, Mr. Akhil Handa, Chief Digital Officer of Bank of Baroda, and Ms. Deena Jacob, Co-Founder and CFO, Open Financial Technologies, Bank Open. Let's have a round of applause for this distinguished panel that we have on the stage. And over to you, Mr. Gupta, for moderating this.
Thank you very much. I hope I'm audible to all of you. So the topic for the day is War of Super App, and when we hear this term Super App, somewhere we go back to 2010 when it was first spoken by Mike, who was the CEO of BlackBerry, and since then the term has become Ferrari of app, as announced by Gautam Adani in one of the recent communication. So we have seen this journey in last 12 years, right from the Chinese market where we had the Alipay, the WeChat, and then South Asian countries where we saw Grab and Gojek kind of creating that kind of aura of super app. And now in the Indian context, we are actually seeing this war happening, right? With Jio coming into the picture, with Tata's coming into the picture, with Adani's getting into it. We also have heard the recent announcement by by Shriram Group and by Muthoot Group. All of these guys are also getting into the super app kind of ecosystem and trying to kind of serve their consumer. And for this, again, if you look at the last 12 years, we have seen a lot of bundling, unbundling, and rebundling happening. So with this, I'll start off with the same bundling, unbundling, and rebundling, and I'll request Mr. Sandeep to please let us know what are the possible strategies that the banks are looking at in terms of super app and when they look at from the perspective of bundling, unbundling, and rebundling. Sandeep, sir.
I hope I am audible now. I am Sandeep Ubale. I represent State Bank of India. So when we talk about super apps, what exactly it means? What we try to do is that on one app, we try to bring in our in-house services and also some third-party services. Now, where to strike the balance? Because when it comes to third-party services, there is no limit to it, considering that there are around 5.7 million apps available on app stores, around 6 million. Which services to bring, and how do we align our in-house services with these third-party services, whether there is any relation between these services, and how do I manage my back-end systems when I am talking about so many apps in my single app. So it becomes a challenge from the technology point of view. Because when we talk about super apps, it's not only about bundling of multiple services in one app, but then you have to also take care of the customer experience, and the apps should not reside in your app just for the sake of it. There's no point in having 100 apps in your one app and then 50% of them either not functioning properly or functioning only with limited capabilities. Besides that, if you have a user base of say 1 million, then you come to know that though you are having, is there some disturbance? So if you are having say around 100 services on your app, but 70 to 80% of your users are using only 40% of them. The remaining 60% perhaps don't use the other services and they remain there, which clutters your infra and only gives you an illusion that you are having a super app. So all these things are there. But this is something which has come. We did launch our super app way back in 2017, and it had been a grand success. But in last 5 years, we also came to know that we have loaded our app with certain functionalities, which perhaps need not be there, and we also took a conscious decision of removing them. So, so with these opening remarks, I will leave the forum open for the other speakers.
Sure.
Thank you.
Thanks, Sandeep sir. So with this, I'll take the question to Akhil. What are the value propositions for a super app which can give consumer the convenience and the better consumer experience?
See, overall, if you look at what Mr. Bala just mentioned, right? You need to find, you can have a super app, but what is the core proposition? And is it the objective cannot be that you have to bundle in 100 apps for 100 different things and bring out one app. Does it really make sense to mix banking, grocery, music streaming, shopping, everything into an application? Maybe, maybe not, right? To my mind, there are only 2 apps globally who've been able to do this to an extent. And the most successful, of course, is WeChat, which is probably the granddaddy of super apps. With about 1.3 billion users, monthly active users. I think everybody else can have that as the North Star. It's a nice ambition to get there, but it's incredibly hard to really design an all-encompassing super app without cluttering, without alienating the consumer, getting him actually disillusioned with the experience. It's not easy to bundle in so many things. There is, without naming anyone, I think there's a player in the country who's attempted to do that. Putting in close to about 4,000 crore rupees into the application, getting in about 425 mini apps, in bundling it into the mother app. Ultimately, it just did not take off.
True.
Because the consumer needs to know what he's getting in an application, and I don't think it makes sense, for example, in our context, to merge a TikTok-like experience into a banking application.
Absolutely.
Right? So to that extent, our view is when we rolled out Bob World, which is our super app, we take it only as far as a financial superstore. Financial superstore plus a few other adjacencies, which would make natural extensions to the banking experience.
Right.
Beyond that, I think it is not our remit to start bundling in different things, because quite frankly, one of the things that you mentioned is, other than just alienating the consumer, it becomes just too heavy to start bundling in so many things together.
True. And sometimes also wonder whether it is the consumer who needs the super app, or is it whether the fintech who needs the super app, right?
Yeah, you're absolutely right, and I think it also, to an extent, reflects a lack of clarity.
True.
Where if you're trying to bundle in everything, I think you do not know what exactly do you want to deliver to your customer, or rather, what does your customer want from you?
Absolutely, absolutely.
And what we've seen in our experiences, we have 250 services in Bob World application. But the ones that will see 90% of the traction are probably 10.
True.
Right?
Yeah.
So beyond a point, there's a long tail. And there is a tail that you require to be able to test out things, to be able to do an A/B on them, and then be able to keep some of them, remove some of them, embed some of them deep inside. But you have to make it a living experience, not
Right.
just a static experience, and which is why it's incredibly hard to get it right.
Absolutely, absolutely. So with this, Akhil, let me just take the question from a different perspective. The role of fintech, right? I mean, we all are mostly sitting here from the bank, and we see fintech as a very good value-add proposition while we are putting together the super app. So, Rajgopal sir, if you can just bring in your thoughts on what is the potential role of fintechs in helping banks put together the super app for the bank.
Yeah. So thank you, Nilesh. See, basically, I fully agree with what Akhil has just told about super app, and especially in the context of banks. At our level, especially in our bank, we don't really believe that we have a product which bundles everything in the world and then clutters it. So basically, we also see our app experience as extension of whatever financial services we provide to the customers. And I am looking at, as far as the role of the banks in super app, instead of saying that no, they have a great role to play, no doubt about it. But one thing that I'm looking at, basically fintech experience, is in the platform banking. And platform banking is something that is going to take off very, very vigorously in this country. And ONDC as well is coming as a non-profit organization which is going to really challenge whatever proprietary super apps are there in the market. So I feel fintech will have a great role to play in platform banking than super apps. So that is my view.
So with this, Naveen, if you can also, what we have seen with super apps, right? I mean, typically, are they also super quick in terms of bringing the consumer propositions to the market from that sense? So what are your views from that sense? Are super apps really super quick in terms of delivering consumer propositions?
Yeah. So just to tell you that the super apps that we are seeing, it's not just about the quickness or it's not about the technology. I think what they bring onto the table is how well they understand the customer, how well they understand the customer experience. So, for example, I'll tell you, someone wants to build a super app, they pick up a category. They have to make sure that the category, when they are building in super app, is as good as a marketplace. If you look at travel as a category, are we doing better than a Make My Trip or any other name in that particular category? If we are not able to do that, not only in the front end side but also at the back end side, it doesn't really make sense for us to create something which is suboptimal for the customers. So when you look at some of these people who have attempted to make super apps, I think they have gone beyond the tech part and they have also looked at what is happening at the back end. How do we actually manage the customer service piece? Because that's also very important. For example, if someone is actually booking a bus ticket, the common question that you and me would have when you book a bus ticket is, where is the bus stop? On which side of the road? Right? Are we in a position to answer such questions when a super app actually gets such queries from the customer? Right? These are the things that I think we'll have to be taken care of if we have to build a full tech super app. And secondly, I think fintechs also have an advantage over banks because when we look at super apps, it could be for commerce, it could also be for banking and finance, like our friends on the panel already told that I think probably a good area to look at is a financial marketplace or a limit super app to the banking and finance. In that case, probably we'll have to look at a experience that we want to provide to a customer. Can a customer come onto the application and see that he or she would be able to pick up a deposit product from, say, State Bank of India and a loan product from, say, a HDFC Bank? Are we in a position to create that particular experience? We may be in that position probably a few years from now when account aggregator, OCEN or UPI equivalent on liability side come into play. That is when probably we will also be able to look at providing a full-fledged super app experience for our customers. What does it mean? Probably we'll also have to liaise with the regulator to see if current parabanking guidelines can be extended to make sure that there is a collaboration that's happening between the financial institutions to offer each other's financial products. Obviously, the commercials will be taken care of. And secondly, I think we also have to wait and watch in terms of how we will be able to also leverage some of these new networks that are coming in, especially in the OCEN. Can it probably in a half a decade's time, can it actually also solve the customer experience related aspects of it? Like BBPS when it came, it actually took some time, but now I think it's completely solving not only the transaction experience, but also the complaint redressal experience. Similarly, probably over a period of time, we can see the ONDC coming in. So I think it's not about fintech or bank. It's about, again, it's not about the speed of technology. It's all about how well you want to understand your objective, how well you want to deliver your objective, how deep are you willing to go into delivering this particular objective is what I thought is very important in super app being successful.
Right. So somewhere where you're heading, Naveen, is in the consumer life cycle, there is consumer acquisition, there's a consumer activation, engagement, retention, and lastly monetization, right? So what you're trying to say is that in days to come, we should look at a kind of a common ecosystem that is contributing to these 5 goals and leveraging it for their own self, right? Very well said. With this, Abhijit, I mean, I'll come back to you, or rather, I'll come to you. We have seen very aggressive strategies being adopted by some of the newcomers in the space of super app, right? I mean, somebody is doing very aggressive strategy of acquiring distressed companies. Somebody is acquiring at a very, very high level of value. Somebody is kind of consolidating all their channels of distribution into one, and so on and so forth. What do you believe is the right position for the bank to adopt while non-banking entities are taking those strategies?
Hello. Many thanks for the question, and this is one question which I think everyone sitting on this panel and being a banker is answering to their boards and everything, that the fintechs are taking out the accounts and why are the banks not getting these accounts. I think this is a common question which we all answer. I don't think that is the truth, because the image which is created that fintech is agile, no doubt. They are very clear that they want to create something very quickly. They are able to do that. While the bank's image has been that they are very slow, it is a decision-making issue, all those kinds. But in reality, let us look at it like this. It's not about a fintech technology or a bank. It is also about what is the platform banking, and I'm drawing words from most of the panelists. What has been getting created as an infrastructure by the country itself, like you yourself are from NPCI are creating UPI, UPI Lite, BHIM, which you are heading. The other day it was more about ONDC, account aggregator. These are the infrastructures which are getting laid down by the country itself. How much is the bank partnering into this? Most of the banks are partnering into it. Most of the super apps, fintechs are all partnering to it. I think that this is the way to go ahead, and this is the way the country will go. Furthermore, I personally believe that most of these apps, most of this, the noise which happens is more on the metros and the suburbs, which we are seeing all across. I had one data point that, in the last 1 year, there was $1 billion of cashback given only in the metros by most of these guys. Is this the only way to converge? Probably, I think for the country to grow with this ONDC account aggregator models, I think the tier 3 to tier 6 is where exactly we need to spread ourselves and go ourselves. At this point of time, for those guys, it is more of an experience and getting the banking needs. How do we present them these banking needs? I think the platforms, the banks, and the super apps or the fintechs all will have to aggregate and collaborate. I know there is a war, the title is War of Super Apps, but I can promise you that war doesn't result into anything. We are seeing it live in some context, but I think lastly it is peace and collaboration which will actually take the whole thing forward. That's my view.
Absolutely. So with this, Deena, I mean, let me bring you in, right? I mean, you're the possible only fintech player in this panel. So how are you believing that you are helping the banks? I mean, what is the role that you see of a fintech in terms of helping the banks?
So when I look at a super app concept itself, right, we have seen the evolution from there was a times where there was a bundled services consuming, and then there was unbundling which was happening, particularly the time when apps and the consumption, the way in which we consume transformed. And that's the time when we were so used to each of the services being delivered in a particular manner, which to the point was what Naveen was also mentioning about, right? If you want to book a bus, you need to understand which is the nearest bus station. So that's the part where different services got unbundled and apps got created. And then we saw the wave of a rebundling happening because there's the digital native generation which came up, and then people got used to this. And that's where we started seeing the convenience of rebundling happening. And that's where, if you look at it, the current state is wherein we are seeing ecosystems being built. And that's where it's not about the war or a friction, but it's about how different parts of the ecosystem can actually collaborate. And this is where I believe each one, I mean, whether it's app, fintech, banks, each of us have the strengths that we play out on. And it's going to be a collaboration which is going to bring the best out of everything. And the good part is that in the last, I would say that this all started about 6 to 7 years, this trend started. But in the last 3 to 4 years, and there was a time when probably, this topic was very relevant, maybe 3 to 4 years back when there was a war. But now, different parts of the ecosystem understand it's all about how you collaborate and handhold and bring things together. And last 3 to 4 years, I can confidently see that each of the parts are doing their part in terms of what is my strength, whom do I collaborate with, and how do I serve the customer better. And which is where, right from the platform banking to the place where in the embedded finance and where the open banking enables this whole thing of where transaction, understanding the customer, getting this data from multiple places, and giving them, serving them in a platter in terms of what is required for you without having any kind of cognitive load, how you can consume services and how you can meet your end goal together. And that is very important to be bundled along with contextual banking. And that's where fintechs, while they are solutioning for the customer need backwards, bank in the back end is giving that kind of very big collaborative support in terms of how we both can come together to get the transaction completed. And super apps, to my mind, will never be complete unless you are enabling the customer to conclude the transaction, even from a payments perspective, end-to-end banking, and then again the goal for which that ecosystem is coming together. And that's where I believe this is going to be a very interesting era of collaboration, and there is absolutely no war of friction is where I see.
So the word you picked up, right, the collaboration, and taking the cue from the word, the next question, which is, do you believe, and this is for all the panelists, right, I mean, do we believe that there is a role of a possible open source ecosystem for all the banks and fintechs to be created in our country, which can contribute to the common objectives, common feature sets, maybe common platform objectives, and retrospectively fit it back to the individual banking ecosystem and the application. So what do you believe? I mean, Akhil, let me start off with you.
I think overall, if you, what you just articulated could be, again, I think this is blue skies, right? Getting everybody together, putting all their products in the same one. See, in banking, what happens is generally there are two levels of differentiation. One is a product and the other is service. In most cases, banks on the main street would have similar products. What really differentiates is the service levels, and this is what would be able to your pricing power really depends upon service, and of course at the end of it what is your CSAT, etc., and how you're able to maintain it, right? So to that extent, I think sure, at some point, if you want to have a more an aggregated view of a product purchase, product discovery journey, you can have it, no problem. But I think life cycle management of all the products of all institutions together, to my mind, is very difficult.
Yeah, absolutely, absolutely. I get that. Adina, what do you think about it?
So my thought is that this open communities, or rather for themes, this will evolve. These ecosystems will evolve by themes, in fact. So which is where the consumer, what are the different themes that the consumer, it will look more like communities wherein different interests bind you.
True.
Similarly, the different objectives what bind would break out into different ecosystems, which is where the consumption, it need not necessarily be too many, your apps, or rather your ecosystem on wherever you consume would not look like the fragmented ones that you see today, but there will be intelligent bundles which will come up. And that will be defined by the themes which you go by. And which is where there's a huge scope for the best of the best coming together. There again, to the point of the clutter, to the point of what are the solutions to be chosen. And this is where, the open communities and the collaboration would be making a lot of difference. And I believe that's the way in which future would go.
Great point, Dina. Rajgopal sir?
Yeah, I fully agree with what Dina has just said. One thing is actually thematic, move towards thematic way of doing things will happen, certainly. Another thing is, see, one important thing that everybody has to look at is the P&L effect on all this. Okay, so we can have the going forward. No, see, even financial services, I see a lot of commoditization happening in terms of product profiles, in terms of the way services are done. Tomorrow, if the regulator comes and says that there will be a portability of accounts, which account aggregator has already started. So basically, the kind of the service experience matters a lot insofar as retaining a customer and continue to serve the customer. So in that context, open communities will come to me, and then will be able to give us a lot of the avenues in terms of developing and integrating myself with the open platforms that are already going to come up going forward. And especially serving these communities also will help me in terms of managing my P&L better. So in that context, open source has a great role to play than typically proprietary technologies, which are very, very costly for us in terms of actually from the P&L perspective. Okay, that's my.
Great point, sir. Naveen?
Yeah, so I fully agree that category-based innovation will happen, and that is where I think we will have to look at how the frameworks will be there for each and every category. Two critical things that believe are important is it has to be secular, which means everyone will have equal right to participate in those category-based initiatives. And second thing, obviously, the security. The secular and security are the two words that comes to my mind, which will make sure that we have a framework which invites all the open source technologies or open source uh, 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 platforms to come in together and provide services to the customer. And lastly, obviously, like while we may be sitting here and we may be thinking that it's too far, that journey is very tough, but I think it's matter of another 6 to 7 years where we'll be able to figure out in terms of how the entire, not only the front end orchestration but also the back end and orchestration can also be made more efficient to make sure that we actually own up the end to end customer experience.
Issue with am I audible? Yeah, very interesting topic, open source. What my view is that yes, open source has to be there because there are some generic requirements which are common across all banking institutions or financial institutions. These generic requirements, if they are available at one place, then the individual banks or financial institutions, they did not invest individually for these services. They can be pulled from this open source, and then at the front end, you can customize your product the way you want, the way your board allows you to do, and the way regulator wants it. And then you already have an established customer base who can use these services. Like we are going ahead with Indian Bank Blockchain Infrastructure Corporation, where the blockchain technology, which is a generic technology, will be available on a single platform. And then there are around 18 banks which are going to use this technology, but they will be using it on their own individual trade platform. So this is where we are moving. This leads to individual banks not investing on their own in the blockchain infrastructure, which is very costly. When we talk about payments, when we talk about asset product, liability products, there is definitely a scope where the generic services are available at one place, the infra is available at one place, and then the players, the identified players, they can hook onto that and consume those services, but at the front end they will decide how to make these services available to their customers. Because every bank will have their individual customer experience policies, other things, and they would like to make available all these things in a different manner. And as our friend said, there is always a P&L element. So what your CFO allows and what your various credit committees allow, that also comes into consideration. So it's not that on open source something is available and all banks start giving same service, and then it's only the customer service which becomes a differentiator. Customer service, of course, is something which has come in last 10 years. Before that, it used to be only pricing, which used to differentiate from one bank from another bank. But now, of course, customer service, the kind of service that we are able to give, anywhere, anytime banking, and how easily you are able to provide. That differentiates one bank from another bank. But then at the back end, if you are having some open source from where you can pull the services and make available to your customer in a seamless manner, then that is where we are moving. And collaboration is the key for this. How big or how small the player may be, but at the end of the day, some collaboration has to be there so that it's a win-win situation for all players.
Right, sir. Just to add, so the online dispute management is something which is also very similar on the lines of creating a standardized customer service handling process, right? So with that, Abhijit sir, to you, what are your thoughts on the open source community for overall goods of the consumer handling for the banks?
Yeah, I think the panelists, I completely agree with them, especially with Rajgopal sir when he says that, P&L has to be the main thing where you actually see what exactly you're going to spend. I agree with Akhil also that when he says that, it is about the product and the service. The amount of time you get into creating a product or, innovating or getting a change into the product, and this can be even regulatory required, like, NPCI also mandates certain changes in every of the product. Each bank has to invest and get these products live. That product live itself takes a lot of energy and time, and then it naturally affects something which is called as the service to the customer. If you don't serve the customer rightly, and as Sanjay Ubale sir said, if you don't serve the customer rightly, nowadays it's not the pricing power, it is more about the service power. If you don't have the service power and if you are stuck with this, then you have a challenge. Look at yourself. You yesterday launched UPI Lite on which application? On Bheem, right? So you are also trying to create Bheem as an open source technology where every one of us can link up to. I think these institutions, infrastructures which the country is creating are going to be very useful to us. So we don't keep on doing the individual changes as our end, but we actually hook on to this and we are able to provide the right service to the customer. Essentially, it is not about we providing service to the customer. Essentially, it is more about the last mile guy getting the right service which is expected from a bank. And then, there is no friction available over there. So that's my simple thought.
Great point, sir. So with this, Akhil, I'll come back to you. We have seen we are leveraging both the banking and the fintech ecosystem to kind of create new technology innovation to help our own banking consumers. What is that banks are thinking of to bring in new consumers who are not existing consumers to the bank?
See, again, when we talk of banks, not every bank is in the same position, right? And there is a State Bank of India, which is banker to half the country, right? And BOB is reasonably large, right? And then there are banks which are still young and nascent, right? Now, so the strategy really first depends upon how mature are you in terms of your own customer base. Now, if you have we have a customer base of 16 crore customers. So yes, for me, NTB acquisition is important, but it is far more important to be able to service and sell to my existing customer base. And frankly, it's a lot easier as well, right? So today, if you talk to any fintech in say lending space, the biggest issue any fintech has is the CAC, and the CAC has gone through the roof. And unless you're able to control the CAC, your unit economics do not work out at this point in time. And in this day and age, when unit economics has become de facto, the pole star, right? You have to get these things right. So there are new models emerging for. So if you're a younger fintech, younger bank, the models is you have to my mind, piggyback on a larger distribution base, and that's the way to effectively be able to manage your CAC. You cannot purely bank on a D2C kind of a model because the CAC is just very high. And at the same time, there are also established large distributors available in the industry who can help you get there, right? So, for example, we partner with a lot of fintechs and other providers where, if the service is useful for the customer, but it is not core to my own business, I would still want to get that service off. So case in point is, let's say, a tax payment, right? So every consumer needs to do their tax filings end of year, right? And it is becoming more and more complex as years go by, right? And this is a service that it's not core to the bank, but every banking customer needs it in one way or the other. So we've partnered with 3 tax providers, right? And depending upon silver, gold, plat, you can just pick the service levels, have a CA engagement, etc. And that's really what it is. Now imagine if that guy were to actually acquire a taxpayer and then serve at a 200 rupee price point. He would have ended up doing more CAC just than just getting the revenue out of it. So it makes a lot more sense to partner up in that way. And I think again, at the end of the day, every institution, organization, entity has to figure out what their reason of existence is, and then the way to the market.
Sandeep, on this same point, right? I mean, continuing it further, Yono currently serves both existing to the bank consumer as well as new to the bank consumer. So, what has been the strategies that or the thought process that SBI has been having in terms of looking at both of these consumer sets? Like Akhil rightly said, you are probably bankers to half the nation, and yet you are trying to kind of have a product super app which is trying to acquire another half of the nation.
No, it's not like that. New to bank, NTB. This is something, this term has been talked about in last 2-3 years only.
Right, sir.
The bankers, means my generation bankers, when we joined bank, this was something which was never talked about. We used to talk about expanding our existing customer base by bringing in new customer to the bank. But now the buzzword is that a customer may come and use your services without becoming your actual customer.
Absolutely.
Even you are not creating a CIF, and then still you are allowing that customer to use your infra. So this is a new trend which has come in. And at SBI we are also, since we are part of the banking system and very active player, we also have our own strategies on how to acquire these NTBs without having this condition of they becoming a traditional customer of the bank in a traditional way, like opening of account and things like that. But having said that, do I really need to do that? And am I doing it by compromising with my existing customer base, which had been loyal to me for over so many years? So I need to draw a line somewhere.
True.
How much I am going to allocate for those set of customers who will be coming on my platform only to use it for a temporary period and then they will exit. What revenue I am going to get out of it and what business sense it makes to me. And then what happens to my existing customers? It is possible that while I am deriving some satisfaction that so many new to bank customers, NTBs, use my platform, I might not be knowing my own customers might be using some other bank's NTB for some other services.
Absolutely.
So this is something a very tricky issue. But yes, as it happens, some concepts, they do come in, they become popular, there's a lot of noise around it. All banks try to have a share of their own in that pie, whatever it is available. And at SBI, we are also going ahead with it. But of course, we are going ahead in a very cautious manner. Because what matters for a traditional bank like SBI and maybe Bank of Baroda, what Akhil was trying to do, that what infra I am having at the back end to serve all these things. And am I going ahead and mindlessly investing in infra just to cater to certain concepts which are being talked about and I need to be part of it just for the sake of being part of it.
Okay.
So that we need to take into consideration first. Whether I really have the ability. Being a big bank doesn't mean that tomorrow some 1 lakh or 2 lakh customers who are not actually my customers but are trying to use my platform on daily basis and my transaction per second suddenly goes up. Do I really have that capacity? And do I really need to further invest in my existing infra to cater to this segment of the customer who perhaps may not come back to me after using my services only for one time and may not generate any revenue also for me.
Correct.
So, and of course, then there is a compliance, there is a risk which is involved, then the regulatory guidelines are there, which I need to adhere to, whether I serve to these customers one time, two times, or three times. It remains same. The investment remains same.
I get that.
Thank you.
I get that. So Rajgopal sir, I mean, what is the view of Bank of India? I mean, while we heard Bank of Baroda and SBI, how Bank of India you are looking at this opportunity, NTB and ETB?
See, it's a great topic. First of all, Akhil has perfectly pointed out what is the customer acquisition, especially customer acquisition cost. And cost of customer service is also very, very important, which Mr. Bale was referring to from the SBI perspective, saying that first is acquire a customer, you incur cost, and then service the customer, you incur cost. From my perspective and from our internal discussion that we continue to have on a daily basis, I'll just borrow the words that Dina was referring to about bundling, unbundling, and rebundling. So what I'm basically seeing, in the financial services is there is a lot of unbundling that has already happened with respect to revenue streams of banks. See, traditional banks had very, very specific revenue streams. In terms of fees, if I actually give a demand draft, I used to charge money. If I give a checkbook, I used to make money. Okay, if I give a one folio charges, also I used to make money. There are a lot of fee income that we used to generate in good old traditional banking, which has completely dried up. So what has happened is many of these revenue streams today are unbundled by fintechs. Now, the question is whether on the basis of whatever revenue streams that have been unbundled, whether they can scale up, and there is a business proposition over there. There is a business proposition that we can continue to actually be there in the business is something that is seriously in doubt, because the traditional banks are also coming back and then pushing back all these fintechs who are actually taking away their revenue streams. So what is happening is slowly there is a scaling issue over there, there is a funding issue over there, and here loss of customer issue over here. So what is happening is the partnership being forced by the ecosystem. So again, borrowing what Dina has said, partnership is forced by the ecosystem. So going forward, what happens is it is not about new to the bank or something like that, or existing to the bank or something. Basically, what we are looking at is what I would call it as a new to service customer, because I have, say, 12.5 crore customers in our bank. How many services my customer uses on the basis of whatever infrastructure I have and what kind of partnerships I have, whether my customer uses all the services or not, is something that I have to really look. Bug for the customer, like exactly what Akhil said, unit cost is something that I need to look. It is not only fintechs who have to look at the unit cost. I also have to look at the unit cost and see how many services that my customer consumes from me in terms of being, from the point of perspective of surviving in the ecosystem. So that is very, very important from the point of view of, you can call it new to bank, or you can call it new to service, or whatever it is. Basically, the fact is, ultimately, what matters is, my investment has to match in terms of protecting the customer base today. That's what is happening. That is my view.
It's a great point. Let me just quickly take the views of Naveen and Abhijit as well. And I'll come back to you, Dina, as well for this particular point. And I want to have the conclusion with you. So Naveen, what do you think? You've been sponsoring some fintechs in this space to kind of acquire new consumers and new services as well, right? So what do you think?
Rightly pointed out, it all depends on which phase of evolution as a bank you stand in. We are definitely a younger bank. We definitely want to make sure that we have more and more opportunities to engage with these customers. So for us, any platform, when we build, we look at both serving ETB, and we also are eager to have more and more NTBs coming into the platforms. For a simple reason, because our existing bases are not as high as the larger banks on this panel. We should also understand that evolution of UPI and some of these concepts like tokenization, etc., we have actually come in very handy to make sure that we have a start proposition to the new NTB customers also, to make sure that they can experience what is available on this platform using a UPI or using a PG or a tokenization kind of thing going forward. So what it helps us is to advertise our service levels or service quotients to these customers, and then hope that a part of them will also try to make their choice to bank with us in a longer term. So for a bank which is young, this entire properties that we built, we not only built for our existing customers, but we also hope to make sure that these properties are well equipped to invite new customers to experience our overall service levels, and make sure that we have an opportunity to engage them with a longer term.
Get that. Abhijit, some last thoughts from you?
Yeah, so I am actually confused because 3 million bankers sitting over here owning 80 crores of the customer. I just did a total of what they said, and you are asking me who is a payment bank, having zero asset side to the balance sheet. And we are saying that, we want to acquire a new to bank customer. Sanjay sir saying that, we have to be very careful of what infrastructure we are spending, how much cost to the customer is going, which is the service that we are doing. I am a thinly wafer thin margin bank. I need to be very, very careful and selective of what I am doing. I cannot just go ahead and say that, I'll open crores and crores of account, and people have done that and bear the brunt, which we don't want to go into. We are very careful. We are genuinely very careful. We want to judge the reason, as I borrow from Akhil. It's the evolution stage of the bank. We are very nascent. We might be, hardly 3-4 years old, 5 years old in this, 4 years old in this ecosystem. So we genuinely want to build ourselves. Now, the build ourselves is morely with the partnerships, morely with our own digital framework, which we are trying to do, looking at a particular segment and the target of the market, looking at the needs of the market, deriving where exactly the thought processes are going for all the customers. That's where we want to make our thought process on. And naturally, tendencies to first look at the P&L, first look at where exactly we want to be of an ability to serve the customer with, being able to survive yourself. If we are not able to survive ourselves and we are saying that, we'll serve the customer, we are lying. So, none of us will be doing that. So we have to survive ourselves and we have to serve the customer. That's where we are. I appreciate this. They have a larger challenge of managing these 80 crore customers. I am a few lakh, and we should be there in some time to do something better. Thank you for that.
Thanks. Nice point, Abhijit. So Dina, conclusion with you. You are probably one of the neobanks acquiring consumers without differentiating between the ETB and the NTBs. So how you look at the consumer acquisition from your perspective?
So we are primarily SME focused, and from this perspective, both from a banking or rather acquisition of them coming into the banking perspective, the way I look at it is, even what we do is, for anybody who wants to bank or anybody who wants to run their business, it could be currently, say they are doing it on cash or they are doing it on different systems. So when they come into the system, how do you make the entry exceptionally easy? Which is through digitization, make it so universal now, especially with the kind of digital infrastructure that we have, how the country has progressed in terms of, even for that matter, digital penetration, and even for that matter, the internet penetration. It's exceptionally easy to reach out to them at a very low cost if we are doing it the right distribution manner, in the way in which they understand, in the way in which they want to consume, which is where the customer first kind of approach. So that's what we have done as well, because banking is a contextual banking we provide, while we provide an operating system for them to run their business, which brings more and more people into the formal financial ecosystem, so to speak. So that's where, from a platform perspective, they come in, the banking becomes a layer wherein all other things of managing the compliance, automatically not having the headache of understanding how do you reconcile, how do you take money, how do you transact on different systems, disjoint systems, how do you put it all together. So imagine you just doing your transaction, you're understanding your customer, doing the transaction, coming to the platform, and there is a bank who is going to help them with the entire banking scenario. So that's where I would say that digitization is the lead. And then we have to go by the customer need, and then about creating the ecosystem, and that's where all of us collaborate and go ahead. So I would still conclude it with collaboration is the key, and ecosystem is what's going to lead us.
Absolutely. And with that, I guess we have the Times Up board also coming up. So thank you very much, co-panelists. We have some very enlightening thoughts coming in from each of these panelists. I once again thank everybody. Thank you very much.
Thank you very much to the panel. Let's have a louder round of applause, everyone. And may I request the panel to please pose for a group photo. And on the other side, we have another interesting panel discussion coming up on the future of cross-border payments in rapidly evolving world. We'll start that immediately. Check. PA. Check. All right, may we request, check. Yeah, may we request everyone to kindly be seated. We're getting ready to begin with the next panel discussion. May we request everyone to kindly be seated. And may we request you to have your networking right outside the hall in the pre-function area. And for delegates sitting at the back, we have a lot of space towards the front. You can come forward and be seated. May we request everyone standing in the front to please be seated. We're about to begin with the next session. Everyone standing in front of the stage, may we request you all to please step to the side so that we can start with the next panel discussion. We'll wait for them to get on stage, but till then, we'd like to thank our partners, our theme partner, WhatsApp, event co-powered by Amazon Pay, spend management partner, Ncash, in association with Perfios, payments partner, Cash Free Payments, and the CEO's dinner partner, HSBC. Everyone sitting at the back, if you all want to come forward, that would be better. Please come forward and occupy the tables towards the front. Lot of space in the front. Your headphones so we can get started. Music down, please. All right, welcome everyone to this panel discussion on the future of cross-border payments in a rapidly evolving world. We have our esteemed panel in front of us. This panel discussion is being moderated by Ms. Gitika Raheja, Executive Director, Payments Transformation at PwC India. And on the panel, we have Mr. Vishal Motwani, Head of Customer Solutions, India and South Asia for SWIFT. Mr. Neil Tamrakar, Director, GPS. Mr. Rishi Patel, Founder and CEO, Interpolitan Money. Mr. Nath Parmeshwaran, Senior Director, Corporate Affairs and Board Member, India for PayPal. And Mr. Amit Talwar, EVP and Head Transaction Banking Sales at IndusInd Bank. Let's welcome them with a round of applause, everyone. And over to you for the panel.
Good afternoon, everyone. I'm sure we are all very excited to be standing in between you and lunch, or hopefully you've had lunch, and we can keep this interesting enough for you all to stick around after lunch. So our topic for the day is future of cross-border remittances and how that is going to look like a few years from now. We have a very exciting panel here. We're looking to, explore themes like innovation, collaboration, regulation, and of course competition as well, right? India is clearly poised for a lot of growth right now in this space. We're the largest inward remittance acceptor in the world. Outward remittances are also growing at a steady pace. Lot of tech initiatives being launched. We're looking at bill payments which are accepted cross-border now. We're looking at UPI, which is starting to get accepted. Swift is coming out with new innovations regularly. So all in all, I think it is an inflection point for the Indian payments ecosystem with respect to cross-border payments. But let's find out from our panelists if really there is a lot to look forward to in this space. So let's get started. Neil, over to you in terms of lot of talk around CBDC, lot of discussions around how that will probably be the game changer, right? How are you looking at this space? Do you think it really is what it promises to be?
Thank you, Geetika. Glad to be here as a panelist to speak about a few words that I know. CBDC is being talked about globally. It is going to be a game changer for sure. But in Nepal, we are struggling to get into the digitization of the payment system. Like 16 to 18% of the total transactions actually happen in digital form in Nepal. Only 16 to 18%. So we are still to go a long way for digitization, complete digitization. And GPS, Global Gateway Payment Service, as a company, we are trying to get into the business so that we can, demonetize the economy in Nepal. Like we are trying to provide a network which is secure, safe, hassle-free, and easy for all the stakeholders in Nepal. In the process, we are really very happy to have NPCI International to collaborate with to bring in UPI system in Nepal. You see, the digital payment system in Nepal is being hindered by few obstacles like standardization, interoperability, the innovation, reach to the consumers. All these obstacles, the reluctance of the people, consumers, for the security purpose, and all these hindrances we intend to overcome by deploying UPI in Nepal, which is already proven in India. So once we have the digital payment system like widely accepted in Nepal, then only we can think about CBDC. So CBDC, obviously, we're gonna eradicate the gray economy from the world. It's gonna eradicate corruptions and the money laundering, of course, the criminal funding. See, all these the dark sides of the society is going to be overcome by this CBDC, we hope, but we still have a long way to go. Thank you.
Thanks, Neil. So I think we spoke about some of the other innovations, right? Like UPI, ground level changes that are happening. But I think there are a lot of fintechs which are doing a lot of work in this space. We've seen, corridors springing up. We've seen new innovations coming out in this space on the customer experience side, on the trust side. So let's find out, I think, from Rishi. How do you see this space evolving globally? Also, how do you see it India vis-a-vis the global counterparts?
So first of all, I mean, I represent Interpolitan Money. Thank you for having me here. We've been operating across the UK-India corridor in particular over the last 3 to 4 years, and it's been evolving at a rapid pace. At the beginning of this year, we opened our India office, and I'm delighted to say, in the recent weeks, we've decided to really double down on our investments here. We see the India outbound corridor as one of the most exciting payment corridors in existence today globally. It's full of challenges. It's certainly not straightforward, but ultimately it's an evolving space, and there seems to be significant capital looking to enter the international markets, and we really want to be here to service that requirement. It seems that policy is also evolving. It's again, we've seen from the RBI's perspective, it's never been straightforward. It's a fairly conservative approach, but ultimately we think that change is likely to happen in the near future. So we're looking forward to being part of that.
Great. But I think you made an important point there, Rishi, in terms of there's a lot of talk about inbound so far in India, but you're saying that outbound is equally exciting, and that's another space that you're very keen to explore in the future, right? Great. Vishal, from your perspective, like SWIFT has been synonymous with cross-border, right, for a while now. What does innovation mean to you? Like, what are you all looking at in terms of enhancing, in a system that's been around that long? So,
thanks, Kritika. Hi, this is Vishal. I lead customer solutions for SWIFT for the India subcontinent. To me, I think this is the most exciting time to be at SWIFT. A lot of things are changing. The way we are looking at business is changing. There are a couple of initiatives that we are working on as incumbents. One of the biggest challenges that we realized when we stepped back from our BAU and we started looking at what is it that we can change on the customer experience side. And what was revealed to us was that at least 5% of all transactions fail on STP, and that costs bankers a lot, to the tunes of $2 billion. That's big money, just because of failures or because of STP, right? And that's something that we feel can be solved with pre-validation. So just by checking that an account exists, there is a account holder to it, the account is active. Just by those simple checks, you could bring those losses down by almost 60 to 65%. So that's one of the big initiatives where we are trying to nudge our banks to use pre-validation. The second thing is something which you might already be aware of, which is GPI. Now, GPI is, we are bringing GPI to low-ticket transactions, which means that your traceability, observability, transparency around these will improve. We've seen numbers improve in terms of the time it takes for transactions to get completed. We've seen that improve drastically with GPI. We see a good bit of transactions being completed within 5 minutes, and most of the transactions being completed within 30 minutes. And our hope is to see the same effect with the small ticket items. The third is ISO. It's a large transformation that's happening in the payment space. I think everybody is gearing towards the November 2022 timeline. And if you look under the hood in terms of where SWIFT is going, we are going API. We are dominantly message-based, but you will see that shift very soon towards API. We've already started with the new services. And then from an infrastructure perspective, our ambition is to go plug and play, which is clearly not the case today, but that is the vision, and hopefully in the next 5 to 10 years, you will see that getting executed, that bankers have those options, do a plug and play with SWIFT.
interesting insights there, Vishal. Thanks. Amit, from your perspective, we're hearing a lot about UPI going global. We're hearing about cross-border bill payments being enabled. We heard about a lot of tech initiatives from Vishal here, right? So there is a lot of talk around tech, right? But how are you looking at the customer aspects around this? Are you seeing new corridors emerging? Are you seeing the traditional corridors just picking up more traction? US, UK, Singapore, or how are you, Middle East? What do you think is the next few years hold in terms of customer migration?
Yeah, thanks, Ritika. So I think I'll take the first question first, which is around the innovation and how it impacts the customers who are typically the users in the cross-border space. So The key considerations that that come to mind of a remitter when deciding on a cross-border payment typically are what does it cost me to send money? How quickly can I send money? Is it safe, secure? How convenient is it for me to do the transaction, etc. So these are 3 or 4 sort of key considerations. And if you look at the innovations, a lot of them led by NPCI in the last few quarters, all seem to be making or bringing out efficiencies on the points that I talked about. So whether it's UPI, UPI, there are 2 things that are happening, which have been initiated over the last 12 to 18 months. One is NPCI taking UPI global from a transaction completion perspective, in the sense that an Indian who is on UPI with NPCI having tied up with entities outside India can possibly go and use the same facility for making payments overseas. B is enabling payments with UPI as a payout mode in India, which means essentially the remitter doesn't need to, or the beneficiary doesn't need to expose the bank details, the remitter doesn't need to know the complete bank details. Virtual handle is good enough. Now, what does it do typically is, the second part, which is to more around the inward remittances coming to the country, is it's payout mode that is 24/7, 365. It gets in money instantly. You don't have to worry about exposing your bank details. It's safe, secure in that sense. There is an opportunity for the ecosystem to be able to pre-validate the handles and make sure the money is going to the right account, it doesn't go elsewhere. So, the remitter is at peace when they're using these kind of payout modes, or they choose these kind of methods to send money back into India. On the first part of enabling UPI for acquiring, of course, today, if as a tourist, so we travel to UK or we travel to Singapore, travel to UAE, invariably we either carry currency with us or we carry a travel card with us. But with acceptance of UPI across these markets, one doesn't really need to bother so much about doing that, and that effectively also has an impact on the overall cost of moving money across borders. So that's one part. BBPS, again the same stuff. I mean, traditionally we've supported bill payments under the rupee drawing arrangement scheme of RBI from outside India into India, and it's essentially been sort of a 2-step process where a remitter would first credit their NRE account here and then do a domestic transfer to be able to pay the bills. But with BBPS going cross-border now, I think the remitter has an option and an opportunity to walk into any of the licensed partners that work with an Indian bank and are plugged into the BBPS ecosystem, do a fetch and pay, get to know the exact amount they need to pay. There are thousands of billers that are active on BBPS ecosystem today. About 20,000 plus is what the last number I heard. They can do a real-time payment. They can pay the exact amount right to the last rupee. Don't have to worry about this being a 2-step process. It's a simple, seamless, straightforward process with a confirmation of the payment also going back to the remitter via an SMS and a receipt being available. So it makes life much easier, simple, and also I think the overall cost of doing a remittance would be much lower, considering that's going to be a part of the entire BVP ecosystem as we look at. So those are from an innovation perspective, and it's a win-win from a customer perspective, because if you look at the key considerations, it seems to be ticking all those boxes in terms of speed, in terms of cost, in terms of convenience, etc., etc. Yeah, coming back to the second question around the corridors and changing trends, I think as you guys have already touched upon the fact that while India has predominantly been seen as an inward market all these years, last decade or so has seen a huge jump in terms of the monies that leave the country in terms of outbound from India. I think back in 2012-13, I recollect the overall retail LRS payments, as you know them, were about $1 billion a year. And now if you look at the quantum that goes out, I think 2020 was approximately 18 billion. Last year was a bit of a dip because of perhaps COVID. But if you look at this year again, we average about $2 billion a month. So we're looking at, approximately 20 to 24 billion being sent out of the country, hopefully, if the trend remains and it holds through the year. So that's a big shift. And the primary purposes we see some of these monies going out of an LRS are, education, it is travel, and travel does include a bit of, other purposes as well. There is some bit that's going out as gifting from Indians to their relatives overseas, and there's of course maintenance money is also going out. So essentially, the geographies that these monies are going out today sort of go on and define the corridors that could be of interest to us tomorrow. I mean, we've seen the trend change. I was reading one of the articles recently which talked about, historically, MENA, the Middle East region, had contributed about, in 2017, was about 53% of the inbound coming into India. Now it's less than 30%. One of the primary reasons is because, let's say, about 6 lakh students leave India every year to study abroad. A lot of them go into North America, they go into parts of Europe, the UK, Germany, and then Australia. A is the quality of education. B, I think, is the work opportunities. So people who go as students today and their immigration policies are flexible and welcoming, eventually they go on and they settle down in those countries and they become remitters. So that's the way, I look at things. You are sending a lot of money out of the country. It's going into geographies which are today very pro-immigration. They are welcoming Indian students. And these are going to be the geographies where you will see, far more money coming into the country as we go along, as has been seen in the recent past as well.
Thanks, Amit. Interesting points there on all fronts, on the tech as well as the migration impacting the flows as well, right? And then that's where I think a lot of the innovation also needs to focus then on those corridors. So a lot of the things that we spoke about before this was around retail, right? A lot of focus overall in the payment space has been on retail. But increasingly, we are seeing a shift towards SMEs. We are seeing a shift towards businesses, right? So not who better than you to tell us what's the exciting stuff on the SME and the businesses side. Is that equally interesting, that space? Are we seeing a lot of traction on the tech side there? Yeah.
Thanks for having me here. I think while a lot has been talked about on P2P payments, inbound, outbound, before I make my remarks or share my views, I want to ask the audience here, how many of you have heard about, Sri Ganganagar and Tenkasi? These are two towns in India. So a few people, have heard about them. Okay, what is common about this is Sri Ganganagar is a border town near Pakistan, and Tenkasi is a temple town in south of India. What is common here is MSMEs, freelancers, okay, who either export merchandise, okay, or offer services to the global audience. They are now able to access a global opportunity, okay, sell their goods and services and receive payments like PayPal as a platform, for example, right? So what we are absolutely fascinated and very fortunate to be associated is a few lakh such, small service and goods exporters from India, both exporting goods and services. We are able to work with them, bring in the trust, open up the market for them across our 400, 500 million users worldwide in 200 countries. Okay, that's the opportunity that we are laser focused on. And we believe, we are probably, day one of a test match. The test match has just begun. That is the opportunity that India is sitting on, and we are very early. What we are seeing is, even during COVID, lakhs and lakhs of such small merchants, okay, are able to have come back very strongly and continue to export made in India goods and services. What it is driving, if you see from a larger perspective, is inclusion, exports, foreign exchange earnings, which go back into creating livelihoods, both direct and indirect, okay, addressed to some extent our trade deficit, right? This is extremely, while the ticket size may be very small, this really adds to the SME sector, which all of us know act as the backbone for India's economy. Okay, why I'm saying that we are very bullish is we are seeing very early days. We have about 63 odd million SMEs in India. Okay, a very small percent of them is actually digitized. Number two, ready for international trade. Okay, so that's what we are looking at. Now, another data point which might be very useful for the audience here is, not very well known. Okay, the freelancer community in India, like our big IT counterparts, is absolutely a leader when it comes to exporting services. I don't know how many of you know, there is a latest report of the International Labour Organization. Out of every four freelancers in the world, one of them is from India, which means we already have a 25% market share. When we talk about per billing rate, which is how they are measured when they seek work from overseas gig platforms or consumers, okay, we are among the highest in terms of $80 to $100 per hour of work. So our quality of service, our English speaking skills, our ability to take care of the overseas users and in return get a very good value is kind of, showcased there. So that's the kind of opportunity we are talking about. When we talk about Gitika innovation, we have to give credit to people who generally don't get the credit. Okay, here first start with the regulator. Reserve Bank of India 10 years back, they had the foresight to actually build a purpose-built regulation for small value export of goods and services called OPGSP. Okay, it has allowed these kind of small exporters to link to platforms like PayPal, go through an omni-channel, whether they want to sell through website, social media, overseas marketplaces and get remittance into the country. Of course, there is RDS and another channel for payouts as well. So foresight of the regulator. Not again very well spoken is the role of the government. We, for a long time, have been working with the government. There is a new foreign trade policy on the anvil. Most likely, we are going to see a completely new chapter on e-commerce-led exports. Okay, and this is focused both on B2B and B2C. Okay, so let's wait for what the government rolls out. What they've already done is, behind the scenes, allow small value shipments through couriers, which was a huge problem before. Earlier things used to go as samples, now it can go as a commercial shipment, which means even one sari, one carpet, one piece of jewelry can actually go out through a courier, and these exporters will get the same benefits as any other exporter in the country. Faceless customs, for example, DGFT running 24/7. Okay, IEC codes being registered online free of cost. So a number of innovation and trade, tailwinds are supporting this kind of an export focus the last 3-4 years, which is an absolute welcome sign. So I would say that this is a fascinating area around trade payments, small value exports, and of course there is a whole B2B chapter, which I think in the interest of time we should be covering it later. Thank you so much.
Thanks, Nath. Great insight in terms of all the other factors which are affecting trade and SMEs in India as well, right? And then I think Nath touched upon a very interesting point around regulation, right? You cannot complete a discussion on payments in India without speaking about regulations. So let's find out from our panelists, is it a double-edged sword? How is it working for them? Rishi, I know you're passionate about this. So do come in and give us your views on, MTSS, LRS, FEMA, and are they keeping in pace with all the innovation that we spoke about?
Thanks, Gitika. So right now, I think not, or not quite. We're not quite there at the moment. But it's really important to understand what it is we're asking for. It's not policy change. It's not deep policy change here. What it is access. You've got an environment where banks can play at one level here, and sort of A2 licensed entities or fintechs have to play at another level. And that's the underlying problem. If you really want competition to thrive, you have to enable fintechs and non-bank providers to actually play at the same level. So it's essentially enabling unrestricted access. Great examples are, I guess, in the UK and the EU, where fintechs have been able to directly connect onto, say, the faster payment network, and in the EU on the SEPA payment network. And that's actually where you see significant macro change. You see consumers being able to access multiple products, and you see different markets open up from an economic perspective. So I think it's really important that actually that lobbying continues, and I'm hopeful that in the coming years we will see this change at the RBI level.
I think this has been a point of discussion for a while now, and I think we've seen the regulator take steps in the direction, right? UPI today, there is a concept of TPAPs and entities who can access the ecosystem, not directly yet, yes, although there has been access enabled for other central payment systems for non-bank entities, that has started. So and I think that's how the Indian regulator typically works, right? It works in stages. You may not see a big bang regulation around it, but you may see some steps which may eventually lead to the ask here, right? And that sort of links, I think, Nath. If do you think there's an ask from the industry overall to the regulator in this space? Rishi mentioned something, but do you want to just come and link to the point that he mentioned?
So the way I think I think you were alluding to this point. We have to have a lot of patience when it comes to such developments, right? A lot of work has been happening on this front, but we'll have to work together to kind of be in touch with the regulator, and in most cases they have started responding in a very favorable way. So a couple of things that I see as opportunities for us to work is the regulatory sandbox is already out. There is a specific theme around cross-border payments as an cohort. Now it is on tap now. So if we have any areas for experiment, then we can go in and do it. Now the next cohort is a theme neutral cohort. Again, it is up to us to see how we leverage that. Number two, I think the RBI teams are very much open to kind of engaging the industry and have a dialogue on what is required to kind of enable it, but within the boundaries of, they would say, Rishi, as you would agree, customer protection, safety of the Indian user, cyber security, those things. So I think there is an opportunity for us to have a dialogue. People on the other side are very much open to listening. If you also saw what the FM said, is that she wants actually the fintech industry to come and engage more and more with the government too. So there is an opportunity here for us to kind of go and engage. I would say one area that we have created in Payment Council of India is a dedicated working committee around international remittance and trade payments. Many of you, we are all together there. So if we can kind of use that forum and kind of put our suggestions and also solutions, yeah, I think we have a great opportunity to go and work with and get some sort of a win-win kind of an approach. That's how I would put it.
Thanks, Nath. Thanks. In terms of Vishal, I think the primary objective of the regulator has been transparency and trust, right? And I think in a cross-border segment that is probably more important than most other segments as well, right? How do you think the industry is looking at that? And are there regulations? Is that a tech challenge to solve? Is that a regulation challenge to solve?
So look at the cross-border space, right? The point is that you will have multiple regulators looking at the same transaction, right? So here are a few things that, tech can solve regulatory challenges, right? So if you look at what's going to happen in that space, one thing that comes to my mind is ISO 20022. So what's going to happen with that is that we are moving from a MT-based messaging to a ISO 20022 based messaging. And what that means in layman's term is that it's now much more cheaper to send and receive messages than it was many decades ago. So which means that now the richness in the data will be almost 8 to 10 times more than what it is today. So that, as a byproduct of that, it means that regulators will find it much easier to call upon information from the banks, right? So it gives regulator more control, and it makes it easy for the bank also to demonstrate how they are compliant. And as you mentioned, one of the things that's always on the back of the mind of the regulator is that it will always side with the end customer. It will look for more transparency in terms of rates, for example, right? And that's something which I think can be achieved with GPI, for example, right? So going forward, you will see that a customer sees upfront what are the charges he or she is going to pay, what is the FX charge that he or she is going to pay. So that transparency helps the entire ecosystem. It helps banks to be more competitive. It gives the end benefit to the customer. And it also gives some peace of mind to the regulator that there is a fair level playing field for all the banks.
Great. Amit, how do you think collaboration is working for the industry today? It's one of those segments which has a lot of it's a fairly diversified segment. There are a lot of players. Everyone commands their share in this pie. How do you think it works for fintechs, MTOs, schemes, and banks?
Well, I think there was a lot of talk around banks versus fintechs a few years back, and there's real apprehension around, are fintechs going to take away the businesses from us? Can they operate independently? Do they require banks? Do they don't require, etc. But I think if I look at the cross-border space today, Geetika, and I look at specifically with the reference to India, I think the regulators have done a fantastic job in terms of defining the roles and responsibilities, use that word, in terms of who can do what in this space. And by virtue of having a fairly well-defined policy and set of directions, be it rupee drawing arrangements, be it the MTSS scheme, be it the OPGSP, or be it the traditional wires, etc., etc., I think it's clear that there is place for everybody. Earlier, it used to be predominantly exchange houses and MTOs for sending money from outside. I think fintechs have taken a fair share of origination, if I use that phrase. And they've also sort of acted as aggregators to be able to pump in, and that has made a little bit of difference in terms of the customer experience on the send side. It's made possibly an impact on the pricing, the cost of remittance as well. So all the considerations talked about earlier, I think it's made an impact on each of those. I've seen some of the large MTOs sort of reinvent themselves to be, act more like fintechs. I read somewhere, I think MoneyGram used to get about 2% transactions on digital 10 years back. Today it's about almost close to 50%, some 45% or so. So it's that, the players on the send side are also reinventing themselves. So there is space for fintechs, there's space for money transfer operators who've traditionally been brick and mortar. But banks are pretty much an integral part of the entire journey. I don't think it's a case of fintech versus or MTO versus bank. It is fintech collaborating with a bank or bank collaborating with an MTO, as the case may be. There's still activities that a bank is required to do by law, be it, citing of funds, conversion, FX, the access to local rails here to be able to pay out, etc., etc. So those are things that a fintech or an MTO is dependent, given the current set of guidelines as they are. The opportunity is there for all. I mean, RBI has given some leeway to fintechs to be able to do last mile. Likewise, I've seen a few Indian banks do venture overseas to also capture the origination of these transactions. But I strongly believe, I think each of the players in the ecosystem has their own sweet spot and their strengths, which they are playing to at this point in time. And I see it as more collaborative than competing at this point.
Great. Sunil, coming to you, we can't end a payments discussion also without talking about the shrinking margins, right? Any thoughts around, is that a concern, or are the volumes enough to sustain even the shrinking margins?
Thank you, Geetika. I think the shrinking margin is not a big concern for the service providers, because our main goal is to provide value to the customers. You see, like, let's talk about the cross-border transactions between India and Nepal. There are like 4 million Nepalese living in India. And they are sending out money to Nepal. Like every year, it's around 128 billion rupees. Okay. Now the traditional channels that they are using for remittances, they are like, it costs for these remitters even to access to the point where they are supposed to deliver their cash, their money. And the network infrastructure that the remittance company has to create in India and in Nepal, it's a huge investment, OPEX and CAPEX. So when we do the remittances, with the channel of UPI that we are going to deploy in Nepal, whole of this infrastructure, whole of this CAPEX is going to go down. So the overall benefit that's going to go to is the end consumer. And that is the beauty of digital transactions cross-border. And we at GPS, we believe to collaborate with more and more digital transaction entities in India and abroad, so that we could give more benefit to the end consumers. See, it'll be easier, safer, and cost-effective for the remitters and the receivers. Having said that, like for a company who is providing this service, who is providing this network, we are going to gain on the economy of scale, obviously. On top of that, like, you see, we believe that the margin is a byproduct of the value and service that we provide to our customers. Thank you.
Thanks, Neil. I'm just watching the clock, and I think we're nearing the end of our session. But I think just before we close, we'd like to hear one last parting thought around crystal ball gazing. One trend in the cross-border space, Neil, that you think is really worth looking out for.
Well, I think, Gitika, like, world needs a highway, a digital payment highway for enabling everyone in the world to become digital. And I see that UPI and NPCI and UPI is such platform that can go global. See, it's been so successful in India. Within a span of 10 years, UPI has done magic in India. And now NPCI is reaching out to all different continents and nations. In Nepal, we are deploying UPI switch for the first time outside India. So this is going to prove that UPI can be deployed in other countries, and the network that creates can become a big digital payment highway in the world. And that's, I'm really excited to see that happen. Thank you.
Great. Vishal, your take?
Competition will grow, which is good. Obvious things to look out for is, one, I think the overall cost of doing a cross-border transaction will plummet over the next few years. And also the speed will increase. Today, if it takes days or if minutes, it should take seconds. And I think we are getting there.
Excellent. Amit?
I think I would like to see far more use cases involving blockchain and digital currency, because that is an area which definitely can further bring in efficiencies end to end. And I see cash would continue to decrease as we've sort of seen all along, to be honest. Cross-border, yes. Domestic, it would still be high. Cross-border, I think it's
excellent. Rishi, where are you putting your money?
Look, I do really believe that we will see some pretty significant changes when it comes to access and opening up of the marketplace. Amit made some really good points around collaboration, and the way I see it is, yes, there will certainly be these ecosystems to play with. Collaboration will continue to grow in this area. But ultimately, the access is the key point for me, and I think if we solve that one, we'll see some seismic changes in this ecosystem.
Nath?
No, I would start by saying probably if you take a 10-15 year view, cross-border, you always have geographies to deal with. I guess on the back of real-time payment systems, CBDC, blockchain, geography actually could become history here. It will be as easy as transferring to a bank account within the same bank, especially if you add digital identity to the mix as well. So that's a 10-15 year view. In the meanwhile, it will kind of continue to evolve very fast. In the short term, I think to Amit's point about use cases, I think there is a fascinating area of the diaspora, 16 million plus Indians living abroad, gifting, charity donations into the country. Those are use cases to really look at and exploit. It's kind of not looked at very as focused as it should be. And last, I think for a long time to come, I think again I go back to the test match example. Okay, collaboration between fintechs and banks is here to stay, and slowly I think fintechs and banks will find a balance of who's doing good and then work together.
Great.
Thank you.
Thank you, everyone. I think we had a very exciting discussion today. Spoke about all the innovations around digital currency. We spoke about UPI. We spoke about BBPS. We took the longer term view as well, right? So there is a very strong linkage between demographics and how that changes with how payment flows change, right? So let's watch out for some of these key trends. Thank you, everyone, for joining us. Thanks.
To the panel, may I request you to please pose for a group photograph. Check, check. We have our next panel discussion starting immediately on the digital versus phygital. Reach Indian households for bill payments. May we request everyone to kindly remain seated. Check. All right, we are about to begin with our next panel discussion. Yeah, you can moderate from here. You can sit. Everybody will know. So that's why we've kept this chair a little like this. We can face all of them. Yeah, you need to wear it because you won't be able to hear yourself otherwise. Yes. Can you hear the music? Check. Yeah, am I audible to everyone? Everyone on stage, can you hear me? Yes? All right.
Am I audible? Yeah, okay.
All right, good afternoon, everyone, and welcome to this panel discussion on the digital versus phygital reach Indian households for bill payments. We have a very esteemed panel with us on stage, starting with Mr. K. Vijayakumar, General Manager, DPSS CO, Reserve Bank of India, Mr. J. Venkatramu, MD and CEO, IPPB, Mr. Sanjay Kumar Rakesh, MD and CEO of CSC, Mr. Sameer Nagpal, Chief Business Officer, Spice Money, Ms. Diksha Nagpal, Director, Google Pay, and Mr. Sunil Kamath, Head Cash Management, Corporate Cards and Corresponding Banking at Axis Bank. And moderating this session is Ms. Nupur Chaturvedi, Chief Executive Officer, NPCI Bharat Bill Pay. Let's have a round of applause for this esteemed panel on stage. And over to you, Ms. Chaturvedi, to take the panel discussion forward.
Thank you. Thanks a lot. At the outset, just want to say thank you to all my panel members who've taken the time out for this discussion today. India proudly hosts more than 1 billion telecom subscribers distributed in 800 million smartphones and 400 million plus feature phone users. No wonder, globally we are known as the land of opportunities. However, the story takes a turn with only 15% of this user base being a digital customer as far as payments are concerned. The number grows still thinner when we talk about digital bill payments. Imagine the scale at which digital payments are under-penetrated. Despite a double-digit surge in volume of digital transactions, the cash circulation has only grown up. Does this indicate that the customers prefer digital as well as cash transactions? Or perhaps creates an opportunity for all the physically assisted players? In this panel discussion, we would attempt to understand some of the consumer nuances behind this. To discuss with us, we have the panelists, and a quick round of introduction has already been done. But even then, I would like to highlight the diversity of the panel. So on one side, we have Mrs. Diksha, leading Google Pay payments in India, and the third largest consumer app as far as BBPS is concerned. And on the other, we have Mr. Sanjay from CSC and Mr. Venkatramu from India Post Payment Bank, primarily the physical channels that are available. Also with us are Sunil and Sameer from Axis and Spice, respectively, the players that have an emulsion of both digital as well as physical plays. And I'm really grateful for Vijay Kumar sir to also join this panel, who has been one of the biggest supporters of digital payments in India. Before I start, just wanted to do a quick fire. So for all my panel members, when we say digital, what is the first thing that comes to your mind? Diksha, can I request you to begin?
Instant.
Thank you. Vijay Kumar sir. Sir, can I request you to use the mic, please? Yes.
I would say instant and very convenient.
Convenient. Thank you very much. Sir.
No requirement for wallet, no paper money required.
No paper money.
It's more about the experience.
Experience, okay. Sunil.
planning to say. It's about the experience, right? Today, the customer is not buying a product, it's buying an experience, right? And that really drives him towards the digitization.
So digital is experience.
Convenience.
Convenience. Okay. Thank you very much for that. With that, my first question really to Sanjay sir. Out of the 1 billion plus people using phones, the fact remains that a number of them are still not digitally enabled and not digitally educated as far as payments are concerned. Against this backdrop, what is the role that the physical infrastructure plays to enable bill payments? More importantly, where Bharat is concerned, do you think a physical infrastructure is a must-have? And what role can you play in enabling that?
Okay. Two questions. I'll try to take one by one.
Yes.
The first question that you asked, the issue is I'm maybe digital savvy, but to build a trust with my own hard-earned money to exchange through a medium I'm not comfortable with takes some time. Until that time comes, the physical infrastructure available near the person's home, that helps him in building that trust. So there are stages of gradual upgradation or movement that if first I get a mobile phone, then I get a smartphone, then I use the features, first I use some apps, then I move to a financial payment. So physical infrastructure available in the neighborhood helps in graduating a person to move towards a digital payment. To that extent, it supplements. Then it also complements it because it also provides more essential services. So before you do the digital payment, there is a need for KYC, there is a need for bank account, OTP, so mobile seeding. So physical infrastructure available on the neighborhood helps in completing the procedures that leads to digital payment. So in my view, the physical infrastructure, it's not phygital versus digital. It's widening the choice. Actually, if you get into that, the Amartya Sen's book said that a person's richness is decided by the basket of the choices that he has. The wider the choice, richer a person is. Similarly, a society is rich if its citizens have a larger choice. Now, we have a physical method, we have phygital method, we have digital method. It's for the citizen to choose which he likes the best. And then he takes on. So it's both moves. So this is the first part. And second part, as you said, physical infrastructure is needed. Because in Bharat, there is a lot of issues that comes up. We all talk about the mobile phones, smartphones, and mobile-based internet. But there is an issue of reliability and speed of the mobile phones. And when I do the digital transactions, if internet goes off, there is a problem. Transaction gets stuck, my money refund takes time. And so that moving to a nearby kiosk where you have a reliable infrastructure, fiber-based infrastructure, and do your transaction smoothly. And also you have a trusted neighborhood person who you know, who can help you conduct the transaction, and if you fail or if something unexpected happens, help you in it. That gives the degree of comfort that every person, especially in rural area, would like to have. So that infrastructure is needed, and it's supporting the march towards the digital. Thank you.
Thanks, sir. Similar question to Venkat Ramu, sir. With 1.5 lakhs post offices and 2 lakh plus postmen, you have done some phenomenal work as long as AEPS is concerned. However, the bill payment journey is yet to be started. Just wanted to understand that what are some of the steps that you're taking as you digitize and enable more and more digital transactions with the infrastructure that you have?
Okay. See, before moving to the digital versus physical debate, one thing that we need to understand is that even the transactions that are done through an agent is also a kind of a near digital transaction. That's one point. Second is uh, we need to understand that unlike the salaried class, you and me, who get salary directly into the bank account, I think that's one of the biggest trigger for anybody to get onto digital. Especially if you look at the rural markets, it's completely cash based. So if they have to initiate a digital payment, first they have to digitize the cash, put cash into their bank account, and then initiate a digital payment. That's one aspect. So which is where assisted becomes very important. And as Sanjay ji rightly pointed out, it's more of a convenience, and it also more secure. In terms of promoting these kind of digital payment transactions, one is what kind of experience or what kind of facility that the customer gets also is an important factor. While customer has many choices today, if you look at in terms of category, mobile recharges and electricity bill payments, these are widely used categories in the rural markets. And here again, you have got wide choices. So obviously, customer when has choices, he will pick one of these choices. In order to solve this problem, one is incentivization of agents. What we've seen is that when we went ahead with nil incentive for the agents, probably agents also don't market this. When you have this convenience fee element for cash-based bill payments, yes, there is some inclination of agents for using this as a means of payment, while that's not sufficient. The next aspect, which probably could help us in promote these kind of payments is credit. We strongly believe that bill payments leave a necessary footprint for lenders to lend. And if that data can be utilized, for instance, if a customer uses his money for electricity bill payment and recharges, that gives a certain pattern about his capacity of consumption. If that becomes a surrogate for lending, while banks can use that, maybe if credit can be provided, like BNPL today, how you are getting BNPL, say on e-commerce kind of transactions, if BNPL can be given, that could trigger maybe that 15% will go by few notches above. I think these are some of the factors which we would like to utilize, but there is no definite answer, how we can promote this.
Thank you, sir. I don't think we can move forward without understanding Vijay Kumar sir's view. What are the regulator views where digital transactions are concerned, which are the physically assisted digital transactions? And what are some of the cautions, word of cautions you might want to leave us with as we continue our march towards more number of digital transactions as well as digital transactions, sir?
It's actually a purely digital transaction, just like what actually we have just discussed. We will only see that in a person who has already got money, like what actually sir was saying just now. So we may not actually see a full digital transaction from a rural market that easily. So you need physical outlets there. We can only be actually happy saying that, okay, the agents, from the agent, the flow to the biller, and then it's actually a digital transaction, and the customers there are getting introduced to a digital channel, and maybe slowly they may find the convenience and actually start adopting digital modes of payments. So the caution, what actually I would say is that if the agents actually follow the processes, and I would think we don't have any sort of concern. The only actually some of these actually BCs and BC frauds and all. So that one fraud actually the rural customers are actually, yes, they will not come back to the digital. That is what actually. So we cannot we cannot let any fraud happen in this space. So the entities actually who provide these agent channels need to ensure that the last mile agents are properly, what is it, the due diligence of those agents are done, and they provide a proper service to the rural population, so that actually they are not discouraged from further digital transactions. So that is the only what to say the only message I would have. Otherwise, actually, we are happy with the customers availing the service through agents as well as, because actually it simplifies the channel as far as the billers are concerned. It provides them. It actually gives them a reach which otherwise actually they would not have it would not have been possible for them. So we are happy with actually what's happening.
Thank you very much for sharing those thoughts. Moving on to Sunil as well as Samir. Um, both of you have organizations which have a large physical presence as well as a very strong digital play or emerging digital play. Do you think both the formats are necessary to provide to the customers as a single organization? And do these actually complement each other or poach from each other? What are your thoughts on that, Sunil?
See, let me start by saying that if you look at phygital versus digital, I think it needs to coexist, right? Because India is a vast demographic country, right? So we are catering to tier one, very sophisticated clients and consumers, right, who have got Androids and smartphones, who are able to use payments and are able to complete their digital journey end to end, right, without any use of or need for any physical branch or connectivity, right? But if you go to tier three, or if you go to towns, where you do not have a branch presence, I think that physical aspect really comes into play. And I think the gentleman really touched upon a very important aspect of trust, right? The ability, I mean, you would see that the internet can go down, there would be electricity downtime, there would be challenges in terms of people not having smartphones. So the physical touch point really becomes an important criteria where a person can go to a kirana shop or to a nearby panwala and try to see how he can connect and get his transaction done digitally. So I think it's a combination of both physical and digital. And see, India, if you look at it, if you look at 2021 numbers, right, we have transacted more than 48 billion transactions on the digital side. And if you look at UPI, right, which has been a great success story, end of day, if you look at the UPI transaction, it is a combination of physical or digital. I mean, you may say that the customer is using a smartphone, but end of day, the shopkeeper or the person has to put a QR code which is embossed on a paper and he's putting it on his counter, right? So if you look at that entire journey, right, it is a combination of physical versus digital, where the guy is putting up the QR code on his counter and the other person is actually scanning the QR and making a payment, right? So I think if you look at the transformation of making it completely digital, it will take time, but I think the coexistence will really help drive the volumes. I think we had a good launch on the B2B session as well on the BBPS front. And if you look at the discoms per se, right, today the biggest challenge what a lot of corporates are facing on the electricity bill payment is the ability to see how banks can integrate with different discoms and how the payments can be done. Now that B2B solution which BBPS is embarking on, I think that's a great paradigm shift. The way how we can look at the way how the entire infrastructure can be taken to a different league and the bill payments can be made. The last thing I'd like to touch upon is the cash on delivery. I think cash really runs like a parallel economy, if I may say that. That's my personal view. But if you look at cash, it's a big problem, whether you talk about a corporate or for the banks, right? And so is for the regulators. So how do you really eliminate cash? Today, if you are able to give cash on delivery, right, and the person comes at your house and he gives you the bill or he's able to give you the goods, and if you are able to make a payment instantly, right, that's a big shift towards digitization. And in doing so, you help to eliminate cash. And I think, and hence I would say that, the digital versus phygital really needs to coexist. Thank you.
Your thoughts?
Saying,
Can I request you to use the mic, please?
is it better?
Yes.
Okay. So I agree with Sunil, and let me start by saying it's not one versus other. The phygital channel will get you to digital. I think let's take a step back. That what has happened in the last 5 to 6 years. Why is that we've seen the BC agent or the BC channel kind of growing by 3x to 5x? There have been a couple of reasons behind this. The first is the internet penetration, right? 2G moving to 3G and then to 4G. That's really triggered an adoption. The second is the low entrant of these smartphones in the country. That's really triggered an adoption. And the third point, which is very, very important, is the willingness by these BC agents to come and be digitally literate. And I'll stress upon this point as I move ahead, because something which is really important for someone to become digital is to be willing to be digital, right? Now, what has happened because of this growth, 3x to 5x growth, these BC agents have now gone closer to the consumer. 5 years ago, we used to hear that a consumer has to travel 15, 20, 30 kilometers to get access to very simple services like a banking services or a bill payment or a financial services. Now, possibly that's happening either in the village or in very close vicinity where the consumer resides. I think that's triggering a lot of trust between the agent and the consumer. And that's also a path from this consumer today being phygital and tomorrow being digital and being self-sufficient on its own. I think some of the data points which all of us should stress upon, and then it really also calls out the challenges in the rural ecosystem. Today, look, the smartphone penetration in the country, while it is at 65, 70%, but if you think of the rural hinterlands, it's only 35%. So which means only 1/3 of your consumers have a smartphone and therefore they can be self-sufficient. If you look at the kind of internet activities happen in these rural markets and what percentage of this is used for a financial transaction, that's only 16%, right? So which really talks about that this consumer, while the consumer has a smartphone, they're not really confident. They're not confident of being able to input the right fields, of being able to complete the transaction on their own. And the third point is the trust. A lot of them today, they don't feel confident, or they are confident whether tomorrow if they expose their primary account, is that really safe? They're really apprehensive about it. So these are some of the things that really stop a rural consumer from being phygital to digital, and it's an evolution journey. I was hearing one of the panelists in the other room, and he very rightly said that any big change in this country takes 5 to 8 years. If you look at how the BC channel has evolved in the last 5 to 8 years, there's been a journey. A similar journey has to be for the consumers, and the phygital channel is one channel that will really enable our consumers in the rural markets.
Samir, I can't agree with you more. I think all the panelists have been talking about trust. My next question is to Deeksha, because Google Pay has in places become synonymous to UPI, and even where BBPS is concerned, they are one of the largest 3 apps to process digital bill payments. Now, I would like to ask, what are some of the things that you think Google has done right to build the trust in customers and prompt them to do the digital transactions? Anything from your side, Diksha?
Thanks, Nupur. And I'll begin with a story. My parents worked in the government and in public sector respectively, and retired a few decades ago. And while they use iPads, laptops, they consume content online, they always went and paid their bills physically till COVID happened. Even then, they got some boy to come home and say, okay, you know what, this is the cash, and go and pay my bill physically. It took one of us between the kids to go and stay with them to get them confident that your account will be secure, no one is taking any money out of your SBI account, for them to start getting used to paying bills online. And when they visited me this time after 3 years, I saw them making bill payments online, in fact even filing their tax returns online, and I was like, this is what, to the point it was earlier made, that digital literacy, I'd say, is one, digital payments literacy is the next one. And a lot of the work that has happened and what we've done in Google is, I guess, a little bit building on this customer sentiment. We all worry to some extent that, will this payment lead to a security issue later on where, funds go out or a refund goes wrong and, my money is stuck. And we've built around this to therefore look at few pillars. The first one is simplicity.
Such a simplicity in a user journey helps them build confidence and trust. Second one is education. So a lot of public videos, campaigns, education, alerts to tell our consumers what looks like a good transaction versus what does not. What are good practices to follow when you're doing digital payments versus not. And then the third one, which I'll spend a couple of minutes on, is what do we do in terms of making the transactions themselves secure. And first of all, big shout out to NPCI, because I think the ecosystem brings that together. Whenever there are any issues, when we see emerging frauds, there is a very quick process in getting that information around and to act on it. The second is we have our ML models working on this all the time to see how do we prevent frauds from happening, how do we raise alerts for our consumers. And on the journey itself, if we feel that a transaction is risky, we send an alert out to the consumer ASAP. So those are some of the things which we actively work on. And on top of all of this is how do we work on cybersecurity, which again has a lot of focus from us. So I would say yes, those are some of the. So it's like more a holistic thing which goes on to gain the consumer's trust, and it's an ongoing journey.
Thank you. Thanks, Diksha. Thanks for sharing all those tips. And I would go back to Sanjay sir and ask if the pieces that Diksha talked about around literacy, around security, around education, how important are these for the physical channels as well?
I think it's a basis on which this whole business runs on. Whether you go to a physical channel or you use the digital channel, you must know what is there. So literacy is a must. So when there is a process to be followed, and he must be knowing. Going to a physical channel helps him because there is somebody to assist him with the process that need to be going through. So that, but some literacy is needed for him. It's much less in terms of digital. Trust, yes. In a physical channel, the trust is more. When we do a digital transactions, we are in the space doing the things, and we don't know if my transaction fails, my money gets deducted, or some cyber hacking happens. Where do I go? Who do I approach? But when you go to a physical channel, you have one person you can share your worries. And you believe that he is better equipped to handle such mishappenings than you yourself are. And if the physical channel happens to your neighborhood person who you meet at social functions near in the evening, then the trust factor goes higher. So that way the physical channel, especially in rural area, where it's informal and social interaction that drives rather than the formal, this helps in graduating. And as she has said, her parents, when they was taught by somebody who they trusted, they quickly graduated. So similarly, a neighborhood person, when he teaches him, चाचा आपको अगली बार आने की जरूरत नहीं है, आप घर बैठे ये कर सकते हो, then he takes on rather than a video channel or somebody else. So those factors lead to the journey, and having a physical setup and infrastructure near the place helps in that. And third, which is not that important, but it's still that is that when you have a physical infrastructure, the robustness of internet is better, because if you have a fiber system, it's better. If you move the metro out of a metro, mobile network stability is an issue. I don't know how many studies have been made, but we all find in our experience that speed is okay, but stability is one issue. And while doing a financial transaction, if it goes off, the transaction has to be scrapped. And a fiber network and a person who knows the things, how to navigate with that, that helps. So I think that having a physical setup in the neighborhood with all the facilities and a trustworthy person at other side of the counter helps in the journey towards the digital.
So talking about trustworthy person, I think we've all grown up in an era where we trusted the postman with everything, including money. How important do you think is a familiar face and the vernacular language that the person speaks in is in doing a monetary transaction for the rural India that we are talking about. Venkat Ramu sir, would you want to say
Sure.
something on that?
Sure. I mean, trust definitely plays an important role, as you rightly pointed out. I mean, before getting into that aspect, I'd just like to touch upon, in terms of, promoting the digital payments or the awareness or literacy. I think, especially with regard to bill payments, there is a concern versus convenience, I would say. Why I'm saying concern is because there's one elderly gentleman who did tell me that, I don't want to take any chance with my electricity bill payment. What if it gets failed and my electricity connection gets disconnected on the last day? And same case with the telephone connection. I think these are some of the elements which also come into play. These are the factors which are beyond, say, your awareness or the kind of security concerns. Then the other factor is convenience. As I think Diksha rightly pointed out, I think today convenience is playing a lot many ways in customers' mind. That is also helping us to promote. So coming back to the trust factor that you mentioned about, yes, Postman definitely brings in that element of trust, and more importantly, as Sanjay rightly pointed out, that that helps you to fall back on in case of any challenges or any issues, and even we also keep getting some such concerns, escalations from customers through the Postman, when something goes wrong, and that gets resolved as well. So that anyway kind of builds some sort of trust, and that's what helps you in promoting any kind of ecosystem, and that plays a role.
Sure, thank you. Sunil, back to you. Over the last 20 years, I've seen a period where the banks were pushing the customers onto digital platforms away from the branches. And of late, we again want customers coming into the branches because the branches were certainly empty at one point of time. How do you balance the digital channels that you're providing versus the branches that need to be utilized, that need to engage the customers and keep the human touch alive? How do you balance between these two?
So let me start by saying, customer is paramount, right? And as bankers, we need to be there where the customers are. And if you look at for customer, it doesn't matter whether you are giving him a physical experience or a digital experience. He is expecting a finality of his payment or a settlement that he's doing, right? And hence, it's becoming very important that when a customer comes in either to a branch or he's trying to do things digitally, we are giving him the convenience, right? Giving him a good digital experience, and most importantly, the adaptability, so that the reputation exists because he gains the confidence and he's able to do that. I think the challenge what we see in the economy is about the way how the branches have evolved. So if you look at today at Axis, our endeavor is, if you look at from a biller's lens standpoint, right? What is the billers looking at? The biller is looking at delinquency management. The biller is looking at how am I able to get the finality of my settlement? How am I able to reconcile? From a customer standpoint, he is looking at assurance, right? Which most of our panelists have also touched upon. They are looking at confirmation that whatever payment I have made have actually got and settled. So I think to answer your question, Nupur, if you look at phygital as well as digital, right? I think that needs to coexist. And as a bank, we are trying to make sure that we are able to connect the last mile, whether it requires a digital experience or a physical experience, catering to different masses. So there's no straight answer to say that we will give a digital experience to our client. It purely depends on what the customer is looking at, right? If the customer wants a digital experience, we are there to happy to give them that digital experience. If he wants a combination of digital as well as physical experience, I think that is also something which we as a bank are progressing. I think there is a paradigm shift, right? The way how we are looking at it. And if you look at, some of the things that we have tried to innovate, just to highlight, we spoke about linguistic barriers, right? I think digitization has really taken a huge shift, because today it's not just about English. Now we have given solutions to various state electricity board, right, where we are able to bring up a landing page in a local language where the customer is able to adopt and transact much more easily, right? I think that is one aspect that we are looking at. Also, the entire APIs that we are able to expose, right, in terms of giving him that real-time information about what payments that he's making, the entire billing or the invoicing and the confirmation that he needs, right, which will give him that confidence, right? I think those infrastructure has really taken place, and the branches really complement in a way that if he has any disputes, right, he can always reach out to the branch and get the ratification instantly done. So I think, as I highlighted earlier as well, the combination of physical and digital is required, right? Because India does have a huge rural population, and to give them that confidence, I think that physical presence will be required, and I think we will evolve as a country in the next couple of years. Thanks.
Thank you, Sunil. Sunil, you talked about customer choices. If I were to talk about bill payments, the customers have a choice of self-checkout kiosks at the physical locations, the physical collection points themselves, the bank tellers, and all these businesses have displayed a very different degree of manual intervention for physical touch points. Now, my question to Samir is that what do you think are 2 or 3 technologies that are very crucial for the success of the digital transactions or the assisted transactions? Any specific technologies that you would like to talk about?
Yeah, so I'm audible, right?
Yes.
Okay. So as Sunil mentioned, I think it's also about breaking the linguistic barriers, right? So we at Spice, we've come up with 12 languages which really support our app, both the app and the web option. And therefore, the BC agent that work with us, they have a choice to navigate in the language of their choice. I think that's one intervention which really connects a player to the rural hinterlands and to the BC agents. I think the second technology or the second tool that really helps these BC agents is how seamlessly they can connect with our customer service. In case of a blackout or maybe the transaction is not completed, these BC agents should be able to reach out either to our customer service agent, either through a call, IVR, or a chatbot. I think it's all about they being able to relay that trust to the consumer. So I think these are 2 important tools which really help us and will help the system also immensely once picked up in scaling up the business and ecosystem.
Sure, thank you. Just moving on, Sanjay, anything that you would want to add in terms of the technologies that are helping you grow at CS?
Yes. The technology which I have mentioned is that rapid expansion of internet is one which is helping us a lot in the rural area, and the speed. So that taken care of. Then what we come is the customers and the kiosk operators experience with the processes that we follow. The UI and UX is the one. We find that if it's easily decipherable or easily understandable by a person of average understanding, that system picks up a lot. In our case, as you know, we are a kind of hyper-local. We have a 5.5 lakh kiosk operated by the person in the same village and same locality. And we offer more than 600-700 services, not only financial, the government services and all. So our experience with which service picks up at our center and which does not, when it goes up, when it goes down, it very clearly shows that if we can reach out to my kiosk operator easily, it picks up. Despite there being some hiccups on technology so part. But that means that designing the interface is the technology or the mind that must be applied to. And of course, in that, the language comes the primary because it has to be understood by him. So that we find the design part of it, how he navigates, how he understands, and how smoothly it does. Yes. Third part, that we need not only technology but something that when a transaction is done, especially a financial transaction, and it fails in the process, there we need a quick, in fact, RBI or some system, all system operators to see how do we resolve it quickly to the persons, because he becomes very jittery the moment his money gets stuck. And if it's a large money, we even get call at 2 in the night saying कि मेरा तो 50,000 रुपया फंस गया है, साहब मैं क्या करूं? With the physical channel, there is a more problem, because here there is an intermediary who has been paid by the customer and he does the transaction on his behalf. So if transaction fails, the customer comes to him and says, मेरे तो पैसे दे दो, काम तो हुआ नहीं, but his money is stuck. So some mechanism for these system where refund can be intermediated or processed quickly, so he has the more confidence. Technology would be needed, the regulation would be needed, and maybe even some decision would be needed.
Sure.
That would help a lot for the system to move much faster.
Thank you very much. Completely agree with you. And possibly my final question back to Vijay Kumar, sir. Sir, you sitting at the helm of everything digital payment have a vantage across countries as to the best practices from South Africa's, Brazil and other countries. What are some of the learnings that we can take away today with your knowledge base and enable the digitization journey much, much faster? Any thoughts on that, sir?
Frankly, I not studied actually the other countries. I find that the Indian space is actually very much advanced compared to other countries.
I was expecting that answer, sir.
So some of the things which I would actually I would like to answer to. This failure rates and actually how do you reconcile? I think we already have a turnaround time mandates and all. I don't know if that is actually not working properly. That's something which we will have to examine. So one part I find is actually going ahead where the issues which we have been said, the internet being down and all. So now that actually UPI 123 Pay has been launched, now that's again like a solution which is actually does not run on what to say internet. So I feel actually the players should now look at that particular channel also to see how that can be leveraged more for bill payment, and I find that actually more instant than the what to say the internet based payments. So that is my I do right now we have around I think 20,000 plus billers on this. So you have more use cases of billers actually there out in the market, which need to come on to this. And the bill payment, I think I hardly what to say the amount of bill payment is not actually means the what is it the bill payment space and the channel the payments through the BBPS or system based is actually very low comparatively. So we need actually to do more work and with the help of the ecosystem participants to actually to what to say to increase this and bring in more players and more customers onto this channel. For that, the segments actually the rural segments and all they play a very important role, and these physical outlets would actually be a very important touch point from where actually customers can be onboarded. So we would actually talk with all these entities and actually we will further try to understand what more can be done, and actually we are working on that particular part to again increase more in the efficiency and what to say what more can be done, examining what more can be done in the bill payment space.
Thank you very much, sir. And I completely agree with you. Our next phase of growth will come from the physically assisted channels. And with that, we have a few minutes in case we have a couple of questions from the audience. We would be happy to take before we wrap up the panel. So just 2 or 3 questions in case we have any. Yes, we have a question right at the center.
Hello. Hello. So my question is mainly on the India Post Payments
Sorry,
Bank.
can't hear him. Audio is not
I
working,
think it's
please.
because of the mic. Because of the. Yeah.
No.
Am I audible? Okay. So my question is mainly around the India Post Payments Bank. So we've seen a lot of growth on India Post Payments Bank, especially with government schemes such as the Bima Yojana and the Jan Dhan accounts and all of these things. But there is a different sector which is still waiting for a lot of unlocking in terms of payments, which is the healthcare sector, and beyond payments, the insurance part as well. So right now, with the way Ayushman Bharat Digital Mission and Ayushman Bharat PMJ are moving forward, are there plans or is there any idea on how India Post Payments Bank could potentially become that a service delivery point, or that point where it's very accessible, the insurance becomes accessible, the digital mission, the components of health become accessible. So if there is any idea on this, I think I would love to learn about it. Thank you.
Hello. Yeah. So I'll just take 1 minute to answer this question. One is that we at India Post Payment Bank, we look at ourselves as a distribution company. Though we are a payment bank, maybe 40 to 50% of what we do is actually forms part of core banking. That's number one. And number two, we see ourselves as a universal service platform. So which means any service provider in the country can utilize our distribution network in terms of reaching to the last mile. Okay, so these are the two aspects with which we go and render services to the customer. And coming to the services, these services which are in demand will definitely form the first priority. Second, talking about insurance services and medical services, yes, we are in the process of penetrating insurance, especially with the right kind of products. As we speak, in the last couple of months, we've launched a very sachet kind of a service on general insurance, which is largely, which has really taken off, and where insurance you will normally see as something which is sold, but here an insurance service is getting bought. So that's the kind of demand we are able to see. See, as long as your product, whatever that you launch, has demand, we are ready to fulfill and do the last mile leg work.
Thank you, sir.
With that, I would, yes, sir.
Though uninvited, I would just try to answer it because that's more related to my CSC network. The Ayushman Bharat and Digital Health Mission, in CSC we are doing at a very large scale. We have registered, I think, largest number of persons under this PMJY Ayushman card. And our people in the field are helping people in getting the claims under Ayushman Bharat insurance scheme. And we have seen that Ayushman Bharat has led to the spread of digital health insurance in the area which were earlier not reachable. So that we see the future, that led by the Ayushman Bharat, health insurance will pick up in rural and semi-urban area much faster than it has been in the past. Thank you.
Thank you very much, sir. With that, the time for our panel is over. I would like to take the opportunity once again to thank all my panel members for an interesting discussion today. Really appreciate. Audience, can we have a round of applause for all my panel members, please? Thank you very much.
All right, may I request all the panel members to please pose for a group photo?
Thank you. Pleasure.
May we request everyone to not gather near the stage, please. May we request everyone to kindly remain seated. We are about to begin with our next session, which is a fireside chat on domestic VCs, opportunities of investing in Indian fintech. May we request everyone to please be seated. Check. All right. Am I audible? Both of you? Yeah? Audible? Audible to you? Yeah. All right. We start with our next session, which is a fireside chat. Once again, we'd like to thank our partners, our theme partner, WhatsApp, co-powered by Amazon Pay, spend management partner, Encash, in association with Perfios, payments partner, Cash Free Payments, and CEO's dinner partner, HSBC. Coming up next is a fireside chat on domestic VCs, opportunities of investing in Indian fintech. And we have our speakers here with us, Mr. Praveen Sridharan, partner at TVS Capital, and Mr. Ganpati Venugopal, co-founder and CEO of Axelor Ventures. Over to you, sir.
Yeah, good afternoon, everyone, and welcome, Praveen. Originally, Mr. Gopal Srinivasan was expected to be here, but due to an exigency, he was not able to come. And we have the benefit of having Praveen, who's a partner at TVS Capital. Most of you are familiar with TVS Capital. It's one of the Ps focused on fintech specifically, right? And I made an ideal candidate because at Axelor we haven't done much in fintech. The only two companies that we have done are Encash and Vyapar. So any which way, when the organizers were asking me on what would be my expectation from this event, I was actually telling them that I would like to know what are the upcoming opportunities which we can focus on the new fund. So I made a good candidate for running this fireside chat. So welcome again, Praveen. Just to start out on recap on what has happened over the last 5 to 7 years, right? And TVS Capital has been at the forefront of driving a lot of investments in the financial services space. It's an important area for you. And when we read the headlines, right, fintech investments seem to garner a lot of headlines, and fintech investments are garnering a lot of fintech companies are garnering a lot of investments, right? And every quarter, depending on the quarter you look at, fintech investments are like number one or number two in terms of the sector that is getting the most investments, right? If you were to look at the last 5 to 7 years of the fintech landscape, the investment landscape, right, how would you really categorize these investments? And after you have done that, maybe it will be a good idea for the audience to hear about what have been the hits and misses.
Thanks, Kana, and good afternoon, everybody. So I think what we've seen over the last 5-7 years, and if you look at the overall fintech space, right, probably about 2 lakh crores of equity has flown into the space, and about 85% of that would have just happened over the last 5 years because that's been the uptick there, right? Now, if you look at the overall global position, how where India pans out, India has about 7,500, approximately 7,500 fintech companies, and number third behind US and UK, right? China is at up 2,500, US is about 22,000 odd, and UK is about 8,900, kind of round about that number. We now have 23 fintech unicorns, right? So the highest amongst the sectors. And if you look at it in terms of the overall global spending, India was about 14% of the overall global spending in terms of second in global volumes, right? And it continues to attract both domestic and global capital. In fact, I think 60% domestic, 40% global. So I think that's a broad number. And if you look at the space has always been attractive, right? So even in spite of whatever slowdowns you might call it, if you were to compare numbers between YTD 21 versus YTD 22, broadly we've kind of attracted a similar amount over the last same time, right? So about 35,000 crores has gone into the space. So that's a broad numbers if you kind of look at it. Now, if you were to kind of do a little bit of a deep dive into that as to kind of saying where is the money going, obviously the larger part of the spends of this 2 lakh crores will going into Series D, C and D plus deals, right? About 60 to 80% depending on year to year. So last year was about 77% went into Series C plus deals. Series B was about 10%, Series A was about 9%, and the rest was angel and seed, right? Now, so that's the broad breakdown, and that obviously is logical given that those companies at that stage require certain higher amount of funding, right? But if you look at within that, what are the spaces which have kind of attracted money? I think top one obviously been lending, right? So what if you look at the last 5 years, lending has attracted about 35 to 40% of this entire pie, right? So that's one kind of space where it's kind of attracted that. The second largest space is payments in some sense, right? So you've kind of seen about 25 to 30% of money has gone into payments. And that's evident actually if you look at the amount of payment ecosystem that you're seeing. And if you look at that's actually reflected in GFF itself, right? Payments and lending are the two large themes that you're kind of seeing talked about in different sessions, right? So you have so many payment companies here talking and kind of discussing different kinds of varieties. You have cross-border payments, you have payments on digital, physical payments, credit card payments. So you've kind of got different buckets which are kind of coming out there. So I think that's kind of the second bucket. But I think if you look at a little bit ahead in that sense, right, in terms of the valuation space, I think payments are still ahead in terms of valuations. I think lending companies are still kind of a little bit kind of still lagging. But we hope that will kind of change over time in that sense. Over the next 3-4 years, we hope kind of that to kind of change, right? So that's broadly, I would say, where we are kind of there in terms of the last 4-5 years.
Got it. Just a follow-up question on that. Given about 2 lakh crores of investments, has gone into this sector, how do you think the returns have played out, right? For investors who have been continuing to take bets in this space, right? What have been the hits and what have been the misses?
So I think on payments, I think there have been a bunch of hits where you've kind of seen, right? I think that's on offline payments, you've kind of seen few large exits which have happened in that sense, right? So we've kind of seen that has happened, consolidation has happened. You've seen few of the companies getting listed, like Paytm got listed. So some of them have kind of spanned out where we've kind of got exits kind of set. As I said, valuation curve and payments have kind of played out, and that's kind of led to exits. Lending, I think, is still somewhere there, right? It's not yet kind of played out where you have had large exits to kind of look at, right? And I think players of scale are yet to emerge. I think a lot of them, as I said, is probably over the last 3-4 years we have seen funding kind of come in, right? Still in the early stages, not in the later stages. So I think as they scale up is probably where we will start seeing exits to kind of come in. In terms of the other spaces, if you look at InsurTech, if you look at WealthTech, I think there are some offshoots, right? Insurance has seen a few companies which have come in, have kind of gained scale, like GoDigital has kind of gained scale, right? They listed for a DRHP recently. So some of those have kind of come in. WealthTech still early days. I think even funding wise, even kind of stage wise, kind of still early days in some sense, right? The rest of the segments I would say is still kind of small. The other piece where actually some amount of funding has gone in is banking tech, right? Where you kind of have players like neo banking plays come in, some other digital infrastructure for banking have started to come in play. Those are yet to play out because they all have been kind of probably recent themes in some sense, right? So if you look at a funding ecosystem, it will take about 5-6 years for them to kind of mature and kind of result in something, right? That's why payments you're seeing some results because you're seeing the fruits of what happened about 5, 6, 7 years ago, right? So kind of people invested at that point in time. You had a lot of trigger events like demonetization, which kind of led to all of that. So you've seen some of those events kind of spanning out and kind of exits and all. Right? So yeah.
So there is a popular quote among VCs that every business is a fintech business in some sense. But on the other hand, I read a quote recently which said that every financial crisis has one new credit product behind it, right? So, just in terms of looking at this interest in lending itself, right? We have seen a number of companies, especially in early stages, that have raised inordinate amount of capital, right? Starting out as an app, starting out as an SME or a consumer acquisition channel, but with the whole bet being that they will become a lending business at some point, right? Last week, at Axelor, we have a number of supply chain companies, and one of our companies went in for a Series A discussion with a large fund. And even though it's a supply chain digitization company, right? The first question in the IC that they faced in the fund was, when will you start credit, right? And this seems to be like a very popular notion that every company has lending or credit at the end of its journey, right? Having backed a number of lenders, right? Having backed a number of NBFC companies, many of whom have gone on to list publicly, right? Or gone on to scale, right? As an investor who has some specific knowledge and expertise and a ringside view of how these companies scale, what do you think it really takes for any company to become a valuable business, right? In the business of lending.
So I think the first thing is about lending is that lending is not about dispersals. It's always about collections, right? That's what dictates the success of a lending business. So I think one probably DNA change that a lot of firms which want to look at should kind of look at it, right? And to your example of different companies which are non-related to lending trying to do lending, I think we've also seen a few where we've kind of seen people associated with different businesses trying to say that money at the end of the tunnel is in lending, right? So I think people need to understand that lending is a business in itself, right? It's not kind of just one add-on that you probably can do that, right? And that requires a different DNA, different thinking process, different risk appetite, credit underwriting capabilities, right? So a lot of those factors kind of have to be kept in mind when you evaluate a lending business, right? So when we kind of evaluate lending business, we kind of go deep down into saying what are the credit writing policies, what is it return, how is it kind of ensured, right? How many times are they kind of going by what they have written? So in some sense, a lot of that discipline has to come in lending, right? Else it's kind of a very difficult business to kind of look at. It's in some sense similar to PE, but with a lot of risk in that sense that in PE also you kind of say that you need to kind of have discipline in terms of what you look at, what you don't look at. Some kind of, I think, similar principles as to what you underwrite, how you underwrite, what is the level of risk you will take, and how you will monitor that, right? I think it's also that not that if you kind of risk changes at different points in time. Uh, at the point of when you're underwriting it, the risk may not exist, but companies change, situations change, businesses change, macro environment change. So you need to keep monitoring that and kind of have the ability to have earlier insights into seeing when the business changes or when the drivers are changing, right? So I think that's very key because that allows you to kind of have a little bit of that ability to kind of at least talk to the company and figure out how you can kind of get your money back, right? So I think those are factors that we see when we kind of look at lending businesses.
Any specific views around how a software company ends up being a lending company? Because that seems to be like a thesis that's a dream of every VC, right? You start with the software, you reduce your cost of acquisition, hold on to get access to a lot of SMEs or consumers, right? And then over a period of time, you can make this transition, right? It doesn't seem to be. There are not that many good examples of companies that have made that transition.
So I think from a software platform perspective, it makes a lot of sense to figure out how to monetize that audience, right? I see nothing wrong in platforms wanting to do that. I think there are ways and means of doing that rather than doing lending on their own balance sheet, right? So if you kind of enable a platform where you have multiple lenders coming and then those lenders having access to your audiences and providing them loans, I think that's a viable play, right? I think because ultimately you're kind of trying to see how you can get a higher share of the pie. Being and doing a lending business on their own, I think it's kind of a tough play unless you have a definite DNA, thought process, ability to kind of work through that. I don't think it's just easy as trying to say just because we have 50 million audience or whatever X number of audience, we'll just kind of figure out a lending play and start going there, right? So all of that requires different setup. I would say an easier way to start, as I said, is having a marketplace or some kind of a platform play where you have different lenders having access to your audience and you allow access, figure out how you kind of work through that model. And that might be a better way to kind of work through that and just kind of trying to become from a software to an entire balance sheet kind of a play, which is very different in that sense.
Got that. A lot of capital riding on that notion. But that aside, at Axelor, we have looked at this whole B2B commerce and number of vertical supply chain beds. And when we have looked at, how these spaces are emerging, one thing is definitely becoming clear that the last 7 years, the kind of revolution that we have seen on the fintech side, on the consumer side, right? The next 5 to 7 years, with all the digital railroads being laid and with all the formalization that's happening, right? There's almost $1 to $2 trillion of digitization opportunity on the B2B side, right? How do you, as a fund, look at this opportunity, and where do you see the opportunities in the fintech space?
So I would look at it in terms of two different lenses, right? One is the entire macro lens, right? If you were kind of looking at it in terms of just looking at population segmentation and income segmentation, right? So you have greater than 5 lakh salary population, which will probably be around 57 million households to about, which kind of caters to about 310 million people. Now here, I think the opportunity is more in terms of providing convenience, right? In some sense, solutions which make their life easy, right? So I think those kind of solutions will work here. So kind of try and see how we make the entire use case process much easier and convenient. The next bucket, which is between 2.5 to 5 lakhs, you have about 80 million households and about 450 million people, right? Here, I think it's more about how do you empower them, right? How do you kind of make it easier for them to kind of either grow their revenue, kind of have different kinds of capabilities there, right? So I think that's the second bucket. The last bucket is in some sense less than 2.5 lakhs, where I think a lot of opportunities are on inclusion, right? In terms of how do you get into the digital ecosystem, how do you kind of provide them solutions which they currently don't have, right? I think these were the three broad buckets, if I may call it, in terms of from a general macro lens, right? If you were to kind of look at it from a slightly more deeper perspective and a specific perspective, right? I think the point that you mentioned on some of the infrastructure rails which are coming in is very well valid, right? So you have uh, account aggregator framework, the ONDC framework, the UPI framework, Aadhaar, CERSAI, right? Which make a life a lot more easier and kind of have much more inclusive banking. So you have opportunities like I think yesterday the RBI governor was talking about digitized land records, right? Being kind of used to provide Kisan credit card payments much easier. So earlier, what was a 2-week process is kind of now down in half an hour. So some of these are kind of creating opportunities for a lot of use cases which earlier weren't there in terms of how do you kind of make the process more efficient, right? For example, farm households are about 90 million plus, right? So in some sense, you have a lot of solutions which are required around land records, soil records, supplies into farmers, marketplaces for farmers, inputs, outputs, right? Some of them are kind of related to fintech where you kind of create solutions for all these farmers. Some of those can be there. So something like this is something what we call as a rural stack, right? Where a lot of opportunities can come in there. The second, I think, large opportunity that we see is in ONDC, right? Where you're seeing a lot of this micro and MSME kind of entrepreneurs coming on board, right? So these are entrepreneurs which did not have a digital footprint. They are now coming onto the digital side, right? Now here probably you can have a huge set of opportunities where you will have probably some of these entrepreneurs were taking credit via uncollateralized debt, right? They would have kind of put their home on loan and kind of get cash. Now can these be converted into cash flow based lending, right? So effectively once you have become digital, once you have ability to look at the data, look at the receivables, look at how their cash position is, can that become cash flow based lending, right? So flow based lending in some sense, right? Similarly on ONDC, you will have the emergence of a lot of super apps in some sense, right? Where you're kind of providing a different, as in one is as you kind of saying some of the consumer apps who have a lot of audience, can they kind of monetize? ONDC can be one mean they kind of monetize some of these, right? They don't need to provide it on their own, kind of can provide for different people, right? Third piece I think where we see is a little bit of the digital banking infrastructure, right? Because I think we're seeing a lot of opportunity there. We're seeing spends kind of happening there over the last 2 or 3 years. So I think these are 2 or 3 large opportunities that we see. Some of it like inclusion, right? Like we're seeing insurance penetration. We kind of are very low on insurance penetration. Our regulatory authority, I think, wants to kind of drive that. As that happens, you will see a lot of opportunities come in not only in the insurance space but associated space, like insurtech, claims processing, insurance broking. So a lot of these opportunities are coming up as you kind of look at penetration increases in different levels, different opportunities like rural stack coming in, ONDC coming in. So a lot of kind of these opportunities are emerging for us to kind of look at.
Got it. Beyond the opportunities that we have discussed, for a country as large as ours and with the financial services infrastructure which is as sophisticated, especially given whatever has happened in the last 7 years, and with a regulator who's quite proactive, right, and progressive, do you see any big opportunities coming up on the infrastructure and the platform side? Just on the, I know a lot of that has been rolled out by the government itself, but if I just compare the fintech landscape of India with the kind of quality of entrepreneurs here, vis-a-vis what we see happening in some of the other markets, right? Connectors, payment platforms, models like that. What could be the exciting opportunities there?
So I think, as you rightly said, the regulator is kind of focusing on how can there be innovation in this space, right? And they're very much proactive. We heard yesterday the RBI governor talking, the SBI head talking a lot on how they look at principle-based evaluation rather than just rule-based evaluation, right? So as long as entrepreneurs kind of focus on kind of having those kind of checks and balances, right, which is keeping the consumer mind at heart, right? Kind of always protecting those. So I think they'll kind of be well served in that sense. Now, within that, as you kind of rightly said, a lot of this infrastructure guardrails are being put to the government, right? And there are opportunities where you can have. So, in some sense, the guardrails are like the highways where you kind of see, where you kind of have public highways, right? So you'll have probably industrial parks kind of feeding off those highways, right? So we see some of those opportunities, some of the debt marketplaces that we've invested in, some of where we're kind of trying to be interoperable with the public infrastructure, right? So those are kind of platform plays which can come in. So yes, there are opportunities, but kind of we'll have to see how there can be a level built on top, or they be interoperable with some of these platforms, right? Where it makes it much more interesting to kind of look at.
Just one last question from my side, Praveen. If all of these opportunities need to be realized, right? What do you see as the top 2 or 3 systemic challenges that we as investors need to address, and from a regulatory perspective, what needs to be addressed? What could come in the way of realizing these opportunities?
So I think from a regulatory perspective, I think what I think, and probably as I said, GFF is probably we've heard all the regulators talk, right? I think they're pretty much open in terms of trying to foster innovation, right? I think, but as they kind of currently mentioned, right, uh, innovators need to keep certain factors in mind, and as long as they kind of keep those certain factors in mind, I think regulators will kind of be supportive, right? I think one thought process to be kept in mind is as and when you're kind of thinking of solutions, engage with the regulators, try and figure out how they can work within those, right? And they'll give guidance. And we've seen some of the companies where they've engaged with regulators and kind of figured out, because not all solutions are kind of regulatory framework is kind of available, right? So some of them are kind of evolving as we speak. So as they engage with the regulators, I think they're able to figure out what works and not doesn't work, and that at least allows them to kind of not have surprises when you kind of look at it later on in that sense, right? So I think that's one broad thought process that I would kind of say would make sense in some sense, right? The other one where we kind of say is that effectively systemic challenges, I would say that uh, one way to look at it is that there are a lot of focus in terms of looking at platform plays, right? And I think probably we should look at it, but look at it whether is it just a additional format change, right? For example, BNPL, right, is no different than a credit card loan or an EMI loan, right? So we kind of, there is a bit of a format change, but it's kind of not nothing new different in that sense, right? So to that extent, I think probably keep those factors in mind when you kind of evaluate solutions or think of solutions for the product market, right? Whether is this a fundamental change or is just a marginal product or a format change that you're kind of driving at, and therefore how does it kind of look at and how you kind of look at it. Apart from that, I think, as I said, systemic wise, I think there are macro challenges in terms of how do you kind of look at inclusion, which we kind of already discussed and kind of looked at and all that, right? So those are all challenges that we could kind of look at. There are certain other things which the government keeps working in some sense, like the health stack, right, which is coming in. So some of those are systemic improvements that the government is trying to do, which can kind of lead to solutions in terms of how the health insurance works, how different kinds of intermediaries work, etc. So those are all factors probably which we need to keep in mind as we look at some of these challenges.
For that, thanks so much, Praveen. I didn't have any more questions from my side. So just ending on a positive note, given that this is the global fintech event, Praveen did mention that 23 out of the 100 possible unicorns in the country have already come out of fintech. Given the amount of opportunities and the excitement among investors in this space, when we look at the next 100, I don't think that number is going to be any less. As an early stage fund, we have set aside 20% of our corpus for fintech. TVS Capital is raising its next fund as a PE. I think their allocation for financial services will be even higher. I do hope that newer models beyond payments and lending becomes possible, and the real opportunity that is out there, whether it is on the credit side for SMEs or whether it is for the underserved segments on the consumer side, right, will be met by newer models enabled by technology. And hopefully, when we meet maybe after about 2 years for an event like this promise would have been addressed. Thank you so much.
Thank you, Anna. Thank you for taking this time.
Check. 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 No, thank you. Check. 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 Yeah. Check. Check. All right, check. Check 1, 2. Check. All right, we're going to start with the next and the final session for this hall in a couple of minutes. We're just setting up. May we request everyone sitting at the back, if you all want to move forward, you all can come and occupy the chairs in the front. We're about to begin with the final session, which is a panel discussion on how can regulators enable digital financial inclusion. We're just setting up and we'll be ready to begin in a couple of minutes. This is the final session of day 3 of this world's largest FinTech Fest, the Global FinTech Fest 2022. And once again, we'd like to thank our partners, theme partner WhatsApp, co-powered by Amazon Pay, spend management partner Ncash, in association with Perfios, payments partner Cash Free Payments, and CEO's dinner partner HSBC. Check, check, check. Check. Can you wear your headphones, please? Yeah. That's it. Yeah, we're ready. Check. Am I audible? Yeah? All right. All right. Good afternoon, everyone, and welcome to the final session of the Global Fintech Fest 2022. This is on a panel discussion on how can regulators enable digital financial inclusion. And we have the panel ready with us on stage. The moderator for this session, Ms. Dipti George, Deputy ED and Head of Strategy at Dwara Research. And on the panel, we have Mr. Alok Mittal, Managing Director, Indie Technologies. Joining us virtually is Mr. Nick Cook, Head of Global Strategy and Partnerships, AIR, that's Alliance for Innovative Regulation. Ms. Arundhati Ramanathan, Deputy Editor, The Ken. And Ms. Amira Karim, APAC Public Policy Lead, Payment System Services at Amazon Pay. Over to you. Yeah.
Hello. Okay. Hi, everybody. And we have a great panel here. This is going to be the last, but not going to be the stuff that you didn't miss. So it's really, we are going to be talking about digital financial inclusion. And basically the question is, what does that mean? It could mean multiple things. It could mean, you could take a very narrow definition to it, or as broad as you want. But nothing escapes the fact that there is now going to be a digital angle to everything that entails financial services, all the way from lead generation to underwriting to sort of pre-sale, onboarding, post-sale processes, servicing, and so on. And so what does this mean for... I'll just take off my mic. So what does this mean for the lives of sort of low-income households and even their livelihoods? And by livelihoods, we mean really things like farming, nano and micro entrepreneurs, the gig economy participants, the self-employed, even slightly larger entities like those that fall under the MSME definition. They will have to deal with this shift, right? This digital shift, whether or not it's going to be done well for them. So if we are to take this view that digital financial, inclusion must meet the needs of these target consumers, then this sort of implies that that we need to kind of sort of overcome some of the market level imperatives such as cost and risk considerations, and therefore the context and the environment matters, and that's why the role of the regulator and the policymaker, and that's why this panel. So quickly, I'm going to kind of get into the specifics to the questions. We have with us, of course, the panelists that you see here, but we also have Nick Cook, who is unfortunately not sort of able to join us through a live session, but we have his sort of recorded videos, and we're able to play, and he was kind enough to give us these recordings, so we're going to play those. So to begin, my question is first to sort of Amira. Before we come to the how of enabling digital financial inclusion, a more basic question to consider. Must regulators and policymakers enable digital financial inclusion, right? And so, and then that goes to sort of Amazon Pay. Do you make a distinction between the financially savvy, the financially comfortable, or the digitally savvy and digitally comfortable versus those who are new to credit, new to digital? Do you treat these as two distinct segments? And is it too much to expect sort of financial institutions, fintechs, and big techs to take on this responsibility for financial inclusion? Or would you agree that there is a need for the government or the policymaker and even the regulator to play an enabling role? Without it, it might be too may not be too lucrative for private actors. So, Amira, over to you.
Thank you so much, Deepti. And as we talk about financial inclusion, I think it's really important for us to think about it not as a monolithic concept, but as a spectrum, right? There is a vast spectrum of underserved needs when we think about, communities that are financially underserved. So on one end of the spectrum, you could have, for instance, communities that live in rural areas that may have struggles to access even basic transaction accounts, to even begin that financial sector journey, right? And then as you shift towards the spectrum, you might also have, other users who may not have access to credit systems for whatever reasons, either because they don't have access to identity systems, they don't have access to collaterals, or they just are not financially literate enough to understand how they could gain access to things like credit to build their businesses or to take education loans and things like that. But as you shift into more urban markets, the financial inclusion definition could also, implicate a lot of people who might have a very sophisticated understanding of existing products, but may not know how to access them for, out of fear or out of, the lack of access to technology. So when we think about financial inclusion, I think it's really important to take a customer-centric approach and to look at all of these customers as bases, as segments where product innovation as well as improvements in processes have to be very, very targeted. So looking at them as very distinct segments that we can address and solve for, individually. But one thing that I've been thinking about as part of Amazon and as part of the broader industry grouping is how do we then ensure that innovation doesn't happen in a vacuum? And a lot of the times, technology companies and companies that are really engaged on financial inclusion need supporting policies, but also supporting partners, whether it is governments who can be, very facilitative and build digital infrastructure, or regulators that set the tone by having very clear regulation. But I think interestingly enough, one underlooked or overlooked partner is really civil society and academics like Devara Research, right? The ones that can help us build behavioral insights, can help us make sense of data. Because data is not just about big data. Data is also about sort of many, many things like cultural and behavioral aspects that have to come together to culminate in making those products and services and innovations actually worthwhile. So as we think about financial inclusion and we serve customer segments, we need to establish an ecosystem approach, and that involves governments and governments playing an we build good governance structures, and we are very collaborative across all of the different segments that I just mentioned.
Thanks, Meera. Turning to Arundhati, we've read all of your work out there, and you've been tracking how sort of DFS has been interacting with the real economy as well as the real digital economy. What are some of the big issues that you're seeing where you think an intervention by the regulator and not laissez-faire maybe a better path to take if we were to keep consumer interests in mind? And, but what do we lose in the process? So if you can just talk about two sides of that same coin.
Thank you, Deepthi, for the question. I think if you look at the steps that the regulator has taken to keep consumer interests in mind, some very tangible examples come to mind, right? Like be it 2FA, which RBI has almost taken it to the world stage to show that it can prevent frauds, it acts in the consumer's interest. Similarly, when it comes to, say, laying down collection guidelines for the recovery agents, thinking of the last mile and laying down guidelines there, that has been in the interest of the consumer. And even something new like a P2P lending guidelines that they laid down even before the industry kind of took off, saying that if you want to invest more than 50 lakhs across platforms, show your net worth to the platforms, right? Which again shows that it cares about potential lenders, investors not losing their shirt by lending irresponsibly in the, thinking of returns. So I think those are great examples. But when you think of customer interest, I think access also needs to be a part of the conversation, and how whether fintechs are enabling access is something that should be an active part of the conversation. Because today it's all about, fintechs are bringing in growth and valuations. That seems to be the narrative. But how can we bring them into, bring them to be a part of the financial inclusion narrative is, I think, something that is missing. And I think there, say take payments, for example. It's still a very 150 million user phenomenon. We know credit is an untapped market, right? So, can the regulator, like we have priority sector lending guidelines, can we maybe think of a priority payments, right? Can we establish payments as a priority for fintechs and get them to be a part of that conversation? I think that piece will go a long way in regulatory interventions for in customers' interests.
Must policymakers take the responsibility for enabling digital financial inclusion, right? So in this context, we should maybe speak about sort of public goods and subsidies. And the latest is today in terms of UPI, right? It certainly has a public good character to it. But then it becomes murky when we are thinking of can providers charge for offering services that add value add to the UPI base case itself. And then when we look at sort of the other existing more well-established subsidies, like for example, interest rate subventions for small farmer agri loans or for MSMEs. So what must the rules of the game be when we have to consider sort of government support as an option?
Yeah, I think the first question here really is, should the government be doing this, right? And I think financial services does have significant externalities, which are not captured in the transaction. If you remember, the initial purpose of Aadhaar was to make sure that benefits can be delivered more efficiently, right? So it wasn't just a lever to say we'll drive financial inclusion or give every Indian an entity. It was driven by a very, core business purpose of avoiding 30 to 40% leakage in transmission of benefits, right? Similarly, getting more digital payments out there is driven by the desire to be able to track payment flows, enhance tax revenues, reduce money laundering. So I do think that there are very good reasons and tangible reasons why the government should be playing an enabler in the financial services area. I think the converse question to that is where should the government stop, right? And in my mind, a lot of that is where do you want to start tapping into the power of innovation and competition, right? So sure enough, UPI as a platform is now established, right? Is this time ripe to bring in competition and innovation on what kind of services get offered on top of UPI? Credit on UPI being one of the things that is, being talked about. And I think at the stage where you start realizing that now the infrastructure is in a reasonably good shape, and you want to start services being developed, competed for, customer to have choices on how they consume these services, that is really where, in my mind, the government role stops. Right? The second key element is, where is the market failure, right? So to your point, I think in the agri loan space, right, the reason why those subsidies have existed for the long time, apart from whatever the political rationale of that might be, is because there is genuine failure of the private sector to go out and deliver in that area, and it is considered to be a segment of the economy that needs to be supported. Just if for nothing else, sheer number of people who are engaged in that activity. So I do think that there is a good framework which is not just to be developed but has been adhered to, even in the past, in terms of where is it that the government should participate, and then where is that rough boundary beyond which entrepreneurs, innovators, private companies should be allowed to function.
We have a question for Alok. Nick, who has shared this video. So let me just read out the question because I think that's important. We asked this question to him, right? Must digital financial inclusion be enabled? And the question here is, what is the prerogative here? In whose interest is this, right? How must one consider the organic way to adoption of digital financial services versus the inorganic? And so what I would ask is to play
Hello, everyone.
Nick's response.
Firstly, I'd just like to express my regret and apologies for not being able to join you in person for this event, and my disappointment that I have had to record some comments rather than provide these live during the session. I hope you have a great conference, and thank you for including me and inviting me. So when we think about financial inclusion, it can be seen to benefit both individuals and economies, societies at large. Access to financial services can open doors for families, allowing them to smooth out consumption and invest in their futures through education, health, and the purchase of productive income-generating assets. Inclusion can also increase security of money over physical storage of cash, for example, giving individuals and families more safety and security around their wealth. Furthermore, access to credit can enable businesses to expand, creating jobs and reducing inequality in society. And I think it was the World Bank that said financial inclusion is the bridge between economic opportunity and outcome. Experience offers us a number of key lessons around enabling financial inclusion. I know the panel will discuss this more, but just to share a few thoughts, we see that financial inclusion must be closely intertwined with the process of financial sector development. If inclusion means access to banking, for example, then those services need to be closer to where the people are, offering deposit taking, payments processing, microfinancing, mortgages, insurance, at the places and through the channels that consumers are comfortable with and have access to. Central banks obviously also have a very important role in creating the enabling environment for financial access. It's their role to get the right balance between ensuring access to financial instruments and ensuring that banks are sufficiently protected from instability and risk. And then on top of that, governments have a very key responsibility to provide the laws and the regulations that encourage financial sector development and inclusion. Regulations around things like the account opening documentation requirements need to be carefully contemplated. Customers might be excluded if they're required to provide, for instance, a fixed address or proof of employment. And so certainly there is a need for government and industry to work together to ensure that the infrastructure backbone is available within a society. One further example, things like the ubiquitous presence of interoperable point of sale devices and the widespread acceptance by merchants of mobile or digital payments. So there may be additional burdens for some consumers, particularly where the regulations have not been developed to take account of the documentation that citizens have available, or where the ability to transact is limited by a lack of merchant acceptance or limited interoperable point of sale infrastructure, or where access to financial services is not proximate and close enough to the citizens seeking or required in some cases to use those services. So there's various things to get right, but if these pieces are put in place, then financial inclusion can be seen to benefit both individuals and societies.
Just moving on, I'd love to hear from Amira, right? So we know that now Singapore is implementing the UPI corridor, and there are many other countries where UPI-based solutions are being considered or implemented, like in Brazil. And then the Monetary Authority of Singapore has been a front runner in really proactively engaging with fintech innovation. So how would you characterize the Indian story with both UPI and the broader fintech ecosystem against what you're seeing in at Amazon Pay or at Stripe or in any of the other jurisdictions that you're tracking, even beyond Asia?
Absolutely, and that's a great question, Deepti. I think that the UPI story is extraordinary for two main reasons. One is that it is testament to the power of public-private collaboration and also in building infrastructure. And then the second reason why UPI is extraordinary is because it provides a really important use case for making access and affordability front and center for financially excluded people. So let me go to the first point, right? The first point relates to how, with the UPI success is really founded on the India stack and how the India stack was developed with inclusion in mind. The first layer being Aadhaar, kind of giving access to identity systems for people who didn't have access to identity systems, opening up not only financial inclusion, but other citizenship services. And I think that had also immense value in ensuring that their voices were heard in the policy-making process overall, which I think Nick referenced as being really critical, the overall economic policy-making process. The second layer in terms of building UPI's common standards so that non-bank financial institutions, traditional financial institutions, and whatever other player that wants to compete can compete on a level playing field. So I think that kind of interoperability, the fact that it was built on common standards, allowed different kinds of companies to compete and innovate on a level, on level grounds, and this created a lot of opportunities for innovation. And so we see the UPI as a starting point to lots and lots of other things that had tremendous value for financial inclusion. The third aspect, which I think is really exciting and is really moving India away from just an open banking-esque kind of economy to one that is open data related. And I think that has tremendous value because if you look at how now the data systems and data fiduciary management is becoming a thing where customers can give consent so that companies, like Alok's company, and lots of others can provide, different kinds of services, whether it is payments or credit and what have you. Those layers are really, really critical. And what's really interesting is that none of these layers are unique, but India managed to orchestrate all of that in a comprehensive way that allowed them to then kind of bring financial inclusion more meaningfully. I think to take a step back, I wanted to also kind of highlight the fact that the reason why developed and developing economies are so interested in studying the India stack and UPI is because of the potential to bring costs down. As you know, payments is not cheap. Making a payment, whether it's digital or whether it is analog, is really an expensive endeavor. And UPI and a lot of instant payment systems like PayNow in Singapore attempts to bring that cost down to zero or as close to zero as possible. Now imagine the power of being able to build services on top of a payment system that is low cost, and how much that can help, bring so many underserved communities to the fold, right? And I'm not just talking about consumers, I'm also talking about companies that want to make payments not only domestically but across borders are now going to be able to do that with all of these corridors. And I think there's tremendous value in that. I just wanted to highlight that I'm very excited that India is going to be the chair of the G20 next year, and I think can really take that work forward. The G20 has a roadmap that looks at bringing cross-border payments to become more efficient, to be more affordable, and to be more accessible, especially to underserved MSMEs that, we have plenty here in India and many parts of the world. And I would really like to see, the G20 kind of lead on this effort. And MAS also has announced that it will start building essentially a technology platform that brings together instant payment systems in a way that makes them interoperable and allows them to connect seamlessly. So kind of building a tech stack, if you will, that allows UPI, PayNow, and anyone else who wants to participate. The power of that for consumers as well as micro entrepreneurs is immense. And so I'm really excited for the UPI kind of model to be studied, especially with India in leadership of G20 next year.
Great. Again, I think it's going ahead. Question to Nick that we had posed was that we all know to different extents that innovation precedes any intervention by the regulator. And at least in developing economies, we see the regulator, play a wait and watch game, and then when it feels that things are getting slightly out of hand, that's when they intervene. But is there really an alternative path to consider, right? Is it, it's not just that we need a proactive regulator on many fronts, because we have seen proactive regulators in India. But what about deciding rules of the game in an ex-ante manner, and really, setting the, the sort of the contours of the market within which. So basically, this is the grand turf within which private actors can act and innovation can happen, right? So, how do we kind of so the question to him was, what are the kind of pitfalls to keep in mind? And there's no silver bullet, right? Like there are all these different models of regulation, but what are the kinds of worries that one needs to, concerns that one need to keep in mind, right? Because if you lock down too much or too many of the moving parts, we may end up really killing market solutions before they are even born. So and so this was his response.
I think, in my opinion, the worst approach is the do nothing approach. Wait and see, if taken literally, is never likely to be sufficient, in my opinion. Waiting until something is significant and impactful before paying it due attention is not a shrewd or responsible approach to regulation. So I'm careful to use the words wait and see. I much prefer the more active but still neutral stance of kind of observe and evaluate. I think that's the bare minimum stance and approach that a regulator can take in an innovating and evolving market. The downside of this more neutral, observant approach is that the response, when it comes in the form of legislation and regulation, may not be fully informed, or it might take quite some time to implement. And if a decision to act is triggered only after an innovation has grown to a very significant scale, one must consider what further risks or harms may evolve and grow during the period of action and response. Determining the time to act can also be difficult. And my former boss, Chris Woolard, once said, the move fast and break things approach that is famously advocated by some technology leaders is just not appropriate when we're dealing with people's money, livelihoods, and security. However, setting rules or specific requirements too early in an innovation's life cycle can stifle desirable future states from emerging, and can reinforce status quo situations, which, if we acknowledge and recognise that both in emerging and mature financial markets there remain customers who are unserved, underserved or mistreated, one should be rightly cautious about maintaining a current state which is itself suboptimal. So you see some regulatory regimes rely more on principle-based approaches, where they set out core higher level standards by which regulated institutions must conduct their business. In some markets, it's said that these principles seek to specify the intention of regulation, so that the market actors are clear what is acceptable and what is not. And these principles-based regimes are often cited as being slightly more future-proof or flexible, but they can create uncertainties and vagaries which may be unhelpful to innovators. Innovators both thrive in uncertainty, but are also stymied by it. It can be hard to raise investment funds in an uncertain environment. So others are now touting a third approach, one of outcomes-based regulation. This is seen as a potential model to address the lack of clarity in principles-based regimes. And outcomes-based regulation seeks to provide a clearer description of expectation or best practice that can provide sufficient direction for business policy, processes, and decisions. So the hope is that such regulations will ensure more consistent market practices and treatment of consumers than is enabled by a purely principles-based regime. So I think there are various options as to how one could go about doing this, and there are definitely downsides of intervening too specifically and too restrictively too early. But a pure wait-and-see approach, in my opinion, is flawed, and the very minimum should be one of observe and evaluate.
So observe and evaluate. So over to you, Alok. What is your reading of what's happening in the regulatory space in India for financial services, right? Both offline and online. You've seen both worlds, pre and post this whole digital wave of disruptions that we are seeing. So do you think directionally the Indian regulators have been able to enable digital financial inclusion, avoid sort of costly mistakes, incorporate learnings from other jurisdictions, both sort of, even before the digital world. So we are seeing business models undergoing swift changes because of, for example, the latest, some of the new announcements by the RBI in terms of digital lending. And this kind of reminds me of a decade back when, for example, Malegaon Committee was set up to start regulating microfinance. And some of those rules have very recently, a decade later, recently been sort of updated or upgraded last year. And this also reminds me of the time when, for example, SEBI had abolished volume-based incentives for mutual fund distribution. So where are we in this continuum? What's your reading of what's happening now?
So I think on a comparative basis, the regulators in India have done a great job of controlling systemic issues, right? Whether we go back to the global financial crisis and how India fared through that. Arundhati made a reference to the peer-to-peer guidelines. Both in the United States and in China, those businesses went through a lot of consumer disruption before regulations could really rectify that, right? So while one could argue that in India regulations came in a bit ahead of schedule, but we have prevented customer harm through those regulations. I think there are 2 or 3 challenges that exist in the regulatory space at this point in time. One is that the regulatory architecture, and Nick referred to some of those issues, isn't quite out there, right? So today, RBI is having to regulate customer data. The PDP, isn't seeing the light of the day. And so that burden of consumer protection, consumer data protection, which ideally should be at a different layer in the regulatory architecture, is falling on a financial services regulator. And I think that there's a conflict and confusion that draws, right? Second is, just the ability to exercise supervision in an ecosystem that is spreading fast. So from just the banks to the banks and the NBFCs, and now literally financial services being packaged into any business just calls for a very different supervisory capability. And I think the recent digital lending guidelines, the regulator has tried to balance that by trying to enforce regulation through the regulated entities rather than directly try and regulate literally every company out there. So I think there are some of those challenges, but on the balance, I do think that the Indian regulators have specified the intent of regulations. They are quick to act when that intent is violated, and at the same time, they've managed to control the systemic harm that has been observed in many other geographies.
Okay. Moving on to Amira, right? So what has been the journey for Amazon Pay and more generally for sort of the payments ecosystem when it comes to engaging with multiple regulators and enforcement agencies? Because that's the next, like post-regulation, we are thinking of supervision enforcement. Do you feel that there is considerable duplication of efforts internally, or so perhaps greater interregulatory coordination is required, even supervisory technologies that can reduce the burden on providers? And we're not just talking of compliance, although compliance burden is, of course, or other compliance interactions are one part of the set of interactions that providers have with regulators. But what about like law enforcement officials, cybercrime investigation agencies, other regulators other than the primary regulator? So what's the experience been?
Yeah, that's a great question. I think when we think about technology, I think we need to realize that technology will never be a good substitute or replacement for good policy making, right? And that technology can be leveraged to assist when there's already an underlying system or there's already a lot of clarity as to what the goals of the compliance mechanisms are or what the goals of the regulatory regime are. So technology can be applied ex post when we already have regulatory clarity. I think from my experience observing the fintech industry, both as part of the private sector, but also having been in government before and having been in the World Bank before, regulation is hard, especially for new technologies. And in the payment space, throughout financial services, there's a new technology kind of introduced every single day. Whether it is blockchain technology, whether it is looking at, hybrid systems that bring together correspondent banking with fintech. There's so many new developments that as a regulator, you have to grapple with all of these new developments, but also maintain your eyes on, the bigger prize, right? Like fiscal stability and things like that. So it is a very complex undertaking. And then overlaying that with goals like financial inclusion, it makes it immensely difficult. So I'm not so concerned about duplication when I think about helping companies navigate the complexities of a system. I think about clarity, and I think about clarity from both sides. Having been on both sides, right? How can we help, as industry, how can we help our regulators gain better insight into ways to regulate us more smartly? How can we collaborate with our regulators so that they understand what we're trying to do? And what customers we're trying to also affect. And a lot of that has to do with trust building and also transparency. Building mechanisms, as part of the private sector to inspire transparency and transparent ways of communicating that also then allow regulators to really understand what frameworks to apply on us, whether we are a payments player, whether it is our lending product, or whether it is essentially the e-commerce store that they have in mind. So I think kind of looking at ways to build better transparency and earning trust through transparency so that there can be smarter regulation. I think the other aspect really is, as we think about national financial inclusion strategies and we see, so many different players come to bear, I think it'll be really important for us in the next phase of financial inclusion to start developing very strong concrete metrics. And what you can't measure, you can't really impact and you can't really bring about. So I think what's kind of missing right now in the overall national financial inclusion strategy are goals and targets that allow accountability to be established. And I think this is one area where we can really work more closely, with a regulator as part of industry and as part of civil society as well. Because again, we also need to understand, how the context and the landscape of the people we're trying to affect, is evolving along the way. So I feel like if we bring all of those factors together, clarity as well as having targets and clear goals, I think that will really boost, the ability to innovate, but also help regulators, navigate all of the new systems and maybe reduce duplication, right? Especially as we think about emerging economies or major economies like India, where there are lots of resource constraints. So we need to build that kind of by design, something that can be measurable and inclusive.
So quick sub-question to you, Amira, is do you see, because you've looked at different jurisdictions, do you see certain sort of jurisdictions or the jurisdictional regulators being more open towards providers, especially also from kind of like law enforcement agencies versus others? Like, do you see a good diversity in how practice providers are sort of perceived?
I think there are, achievements and drawbacks in all jurisdictions. So I think in India, to Alok's point, RBI has done a great job coordinating all of the responses to new technologies and grappling with a lot of complex issues. So I think that, they've been really staying on top or in step with the rest of industry. I think that there are some smaller economies that have been able to develop prototype regulations, like Singapore, for instance, a less complex jurisdiction, but one that is very technology forward, that allows for experimentation to take place, and then maybe develop, use case based regulation, right? Kind of not jumping in before, but also observing, as Nick mentioned, and developing regulation based on those use cases. So I think Singapore does a good job of that. And then if we think about how, in the UK, there is a reason why, the UK is also the hub for fintechs, because they also have a strong enabling environment that ensures that fintech voices are included in the regulatory making process. So ensuring that, fintech companies are also have representation within that kind of policy making process is really critical. It may not seem like a lot, but it also helps the regulators to stay in step and ensure that that they are building policies and regulation for that particular diverse interest.
Okay, thanks. So speaking of UK, again, we had a question for Nick that kind of deep dived in the question of what's happened there. And there we know that the FCA really reflects what's called the Twin Peaks model, right? Like basically splitting prudential and sort of conduct regulations between two different regulators, so that both of them are taken equally seriously. And in India, we know that for unregulated entities, lending activities, for example, the RBI and the Indian government are considering a new law to ban unregulated lending activities. And that engages in public lending, right? Anybody who's not registered with the RBI or any other law and undertaking public lending the plan is to kind of ban them. And public lending is not defined today, but we know that a lot of unregistered sort of money lenders have been lending for centuries. And then we have sort of non-financial corporates who have been lending. They just don't meet the 50-50 criterion of the RBI, and hence do not require any license from the RBI to undertake lending. So, so we asked Nick how he could, to give us a sense of how the UK FCA has tried to obtain maximum coverage of all forms of lending, while keeping fairness of all actors in mind. So just, and retail credit's biggest worry is really sort of over indebtedness or over borrowing, and this can become a systemic concern, and so the worry is really valid. So just to kind of deep dive into what's happening in the UK.
In the UK, generally retail credit is regulated, and businesses which offer credit or financing to customers must be authorised by the FCA. The UK has progressively brought more and more of the consumer credit market under regulation. As the market has evolved with new and different product offerings, the uptake by consumers has changed over time, and new harms and risks have come to light. And the FCA has sought to upgrade requirements and specific rules around particular products and market practices. Generally, it intervenes where it identifies problems and issues. There's been various spaces and ways in which the FCA has intervened since it took over responsibility for consumer credit in the UK in 2014. In 2015, the focus was on things like payday loans and other high-cost short-term credit products. The FCA introduced a cap on the interest rates on such loans. This is one of the most kind of strident and specific rule settings in recent years. And it followed on from earlier measures that the FCA put in place around risk warnings that needed to be made clear to consumers, restrictions on rollovers, and restrictions on how things like recurring payments could be collected. What I would just note is the FCA's intervention on payday loans was based both on kind of traditional supervisory and risk evaluation processes, but also involved a lot of work in the use of behavioural economics, including things like randomised controlled trials to test how different consumer messages and warnings would or would not be effective. The FCA reviewed the impact of its rules a couple of years later and found that over 750,000 borrowers saved around £150 million per year with cheaper loans, better affordability assessments, and fewer customers experiencing debt problems. What I should flag, though, as well, is that the FCA's intervention also led to a significant shrinking of the payday loan market, with a number of businesses basically leaving the market. The FCA introduced further rules in the credit markets, also again in 2014. It undertook what it calls a thematic review of the debt management sector, found that the quality of advice provided by fee charging providers was too low. This led to a series of past business reviews and requirements for specific firms to pay redress to consumers who've been mistreated. The FCA has also intervened with price comparison websites and had concerns around the way in which relationships between the websites and various lenders influenced where and how certain products were promoted to consumers. So in 2016, it placed requirements on these price comparison sites around how they transparently showed products and services that were available. The FCA has also used market studies. These are really in-depth data analytics and competition assessments. Probably one of the most famous ones is work around credit cards. It looked at over 34 million customers' accounts across a 5-year period and found generally that competition was working well, but did identify significant concerns around problem credit card debt holders. This was a group of about 3 million customers who'd been seen to pay more in the previous 18 months on interest, fees and charges than they had repaid of their borrowing. And new rules were implemented to encourage firms and customers to avoid persistent debt and to ensure that customers who couldn't afford to repay were given help and forbearance more quickly. Again, the FCA estimated that these changes would save customers up to £1.3 billion per year. Further changes have been made by the FCA around different aspects of the credit market, looking at things like motor finance, guarantor loans and other products, and other policy remedies and interventions have been introduced. And just to pick up your point around affordability, recently the FCA's focus has been on the rapidly growing buy now, pay later sector, which is unregulated in the UK. And a thorough review of this market looked at how products were promoted to consumers, how those affordability assessments were undertaken or not, and how risks were being explained to consumers. Very significant harms and issues were identified, and so the FCA and the UK government is now in the process of bringing such products within the scope of regulation in the United Kingdom. In the meantime, and I mentioned this in my first comments earlier, there's a need to also protect consumers. So the FCA has been very, very active with its risk warnings for consumers about buy now, pay later products. Thanks.
Okay, we're nearing the end of this panel. So question to you, Arundhati. What might be some of the important trends and issues that you're picking up, and you're looking out for at the KEN, given digital financial services and regulatory interventions? These are really sort of hot topics today. Sort of have our discussions today really added anything new to your list?
Of course, Deepthi. I think given the spate of regulations that we have seen in the last year and a half, right? We've seen that there is no perfect regulation that way that can come. You're either under-regulating or you're over-regulating. So I think that's something that we will be watching for, and the impact of that. I recall this example from a reader when the recent guidelines on credit line-backed PPI cards were banned by the RBI. This reader wrote to us saying that this was a product that was actually seeing traction. People actually found use for it, right? So there was it found that product market fit, though it did not really comply with what the regulator had thought of initially. It didn't comply with it. That part is, there is no denying that, but it did have its use in the market, right? So I think when we look at regulations that come into the system, I think the way we judge it has to be through all the prisms, right? So I don't know, maybe with the help of all of you, I can develop some kind of a scorecard, as to how much of a benefit this has on the user, how much on the system participants, on the banking partners, on the ecosystem. So I think we need to see it from that prism and then see who does this benefit or not benefit so much. The risk with so many regulations coming back to back is, if we are over-regulating, then are we financially actually excluding people? Like the PPI card example that I gave, if there was actually potential for that to reach the bottom of the pyramid who needed that credit, are we now suddenly excluding them? So I think those are conversations that we need to bring about actively. And definitely, I mean, even as a reporter, I've not really looked at when I'm writing about fintechs. It's about the valuation, about the unit economics. We're not talking financial inclusion as much. So I think as we report, this discussion makes me think of so many aspects that I think we can weave into our narratives as well, as to how and judge companies based on that.
Fantastic. Any parting thoughts, Alok? This has been a 3-day fintech fest here, but looking forward, what are your thoughts?
No, absolutely. I think this festival obviously provides an opportunity for players from the industry. And I saw regulators walking the corridors, and that's brilliant to see. So I think it's a melting pot of all viewpoints in this industry. I think at some level, the regulatory task and the policy making task is also split between what is perceived to be detrimental to systemic stability. And I'm not even talking about capital concerns and things like those. Innovation that may disrupt existing players can be detrimental to systemic stability, just by virtue of the players that it tends to disrupt.
That's a whole new panel topic.
And on the counter side, those kind of innovations are potentially the innovations that are going to solve for inclusion and digitization. So I think that's an interesting tightrope to walk. I am very encouraged by the fact that this discussion is happening not purely in a spirit of competition, but collaboration. So a lot of the fintech industry developments, at least in India, are led by fintech bank partnerships. Whether it is in payments, it's in credit, insurance, whichever product you look at. And I think that architecture allows a more conducive dialogue to happen on where are really the risks of disruption and where is the inclusion opportunity. So that is what excites me about this ecosystem.
And you think the partnerships are here to stay?
I think the partnerships are here to stay. As much as fintechs want to grow fast and scale fast, the reality is that there is a product market fit of fintechs with the financial services industry, right? They are solving a problem. They are spreading the ambit of inclusion. We've seen research now done by bureaus and so on, which indicates that a large part of new to credit is getting powered by fintechs, right? So at an industry level, there is a product market fit, and there's no reason why it won't scale with the right regulatory guidance.
Great, thanks. Amira, you have the last word. What are your big thoughts right now?
That's a big responsibility to have the last word. Thank you, Deepti. I think that it's really encouraging that I've been listening to a lot of panels at this GFF, and financial inclusion has come out as a theme in most of them. So it sounds like a lot of people are thinking about financial inclusion and keeping financial inclusion as one of the North Stars, whether it is talking about product constructs, whether it's thinking about regulation, or whether it's thinking about, how can we improve business processes. So it's really encouraging, from my perspective, to hear this be a theme that cuts across so many different discussions today. I wonder if, to Alok's point about collaboration, and I think competitive collaboration is also good, right? We want to make sure that we're not just collaborating to be nice, but to ensure that we are serving the people that we say that we're serving. And I think that's really important to keep in mind, especially as we enter, 2023, which is meant to be a year of uncertainty in many respects, with a lot of economies kind of slowing down. I think there are lots of mutual areas of alignment, bringing costs, down as much as possible so that financially excluded, communities can still benefit from digitization. I think that's going to be, an important kind of guiding principle underpinning what we do at Amazon. I think the other thing that I've been thinking about and, always love coming to India for this because there's so much, energy surrounding fintech innovation. How can we ensure that the fintech community is able to ride the wave and become more resilient and then have spillover effects that are not just centered on India, but also over the rest of the world? Kind of ensuring that fintechs in India can go global so that the lessons that they have, learned, that the products that they have built in this market can be externalizable in other places that have very similar kind of constructs and needs. So I'm very excited about that, and I'm hoping that 2023 brings that for us.
Great. Okay. All right. So with that, we're going to wrap this panel. Thank you so much to the Global FinTech Fest and their organizers. Thank you so much.
Check. All right. Thank you very much. May I request our panelists to please pose for a group photo? And with that, everyone, we come to the end of the Global FinTech Fest here in this hall. There's one session still going on in Jasmine 1. If you'd like to attend that, we invite you to attend that. We'd like to thank our partners for the Global FinTech Fest 2022, our theme partner, WhatsApp, co-powered by Amazon Pay, spend management partner, Ncash, in association with Perfios, payments partner, Cash Free Payments, CEO's dinner partner, HSBC, our platinum partners, Google Pay, PhonePe, Visa, M2P Fintech, MasterCard and Falcon. Our registration partner, Entity Data Payment Services. Our communication partner, Kalera, banking partner, Standard Chartered Bank, diamond partners, PayU, AWS, Kia.ai and Paytm. Our networking partner, Buddy Loans, our country partner UKFCO, Kingdom of Netherlands, our credit score partner Paisa Bazaar, conversational commerce partner Carix, P2P lending partner Faircent, VIP lounge partner Cred, and InsurTech partner Cover Genius. Thank you very much to each one of you for having been a part of the Global FinTech Fest. For updates about Global FinTech Fest 2023, do check our website. We will be updating that regularly. Thank you very much. I'm your host, Chaitanya Rathi, signing off. Have a safe drive home.